Good morning and welcome everyone to ABG Investor Days. My name is Jesper Birch Jensen and I work as an equity research analyst here at ABG in Stockholm. Today we have about 40 companies presenting, starting at 8 o'clock in the morning and ending at 5:30 in the afternoon. And the first company that we have today is Awardit, where we have the founder Niklas Lundqvist here to present the company and tell us more about the business. So I think with that said, please go ahead, Niklas.
Thank you, Henrik, and it's always great to be first. I love that. My name is Niklas, and I'm the founder of Awardit, which I started around 20 years ago. Nowadays, my role in the company is focused on M&A and investor relations. On a more personal level, I'm an addict to loyalty points, which I believe is a great tool in behavioral finance. You can move on to the next slide, please. And the next one after that, actually. Looking at Awardit today, we are the largest company platform for loyalty, incentive, and gift card programs in the Nordics. We have a revenue of approximately 300 million. And if you look at our recent acquisitions of MBXP and our ongoing acquisition of the Inspiration Company, our pro forma turnover is well above 500 million. We have a very long history of organic growth and profitability. Looking at it from our customers' perspective, we are a one-stop shop. We not only provide a platform on a software as a service basis, but we also make loyalty programs attractive and successful by providing a market for example, loyalty point spending and a market for partnerships enabling additional point spending, earning in such programs. Today, we're divided up into 3 different business areas. We have loyalty, gift cards, and partnerships. We operate more than 150 programs, reaching more than 15 million members in the Nordics. Actually, those figures are probably a lot higher today, taking into account our latest acquisitions and ongoing acquisition. This makes our platform and business model extremely valuable. Normally, programs are set up and operated on behalf of our customers and under our customers' brands, but we also operate a handful of private label programs that we actually own. Looking at our long-term ambition, it is to become one of the largest players in Europe, and we believe in combining organic growth with an aggressive acquisition strategy. And since our IPO in December 2017, we've completed 8 acquisitions, and right now we are working on our 9th since a few weeks back. You can move on to slide number 4, please. If you look at the driving forces for our customers, a loyalty incentive gift card program can target consumers, businesses, resellers, and employees. There's a place for our solutions in more or less every type of business. And our customers use our platforms to increase revenue and profitability. And they obviously want to achieve a greater share of wallet. They want to decrease price and discount focus. They want to increase customer lifetime and decrease churn, and establish more response and cost-effective customer communication, etc. You can move on to slide number 5. Looking at our business model, it's my favorite part of the company. It's fantastic. It's extremely scalable. We could probably double our turnover from current levels without adding employees. There are some slight variations depending on the business area. And if you look at our loyalty division, we typically charge a one-time setup fee, a monthly fee for access to our platform on software as a service basis. But then most importantly, we provide a marketplace for members to spend points and or fiat currency on thousands of different products, physical and digital, and also on digital gift cards. When it comes to our gift card division, we also charge a fee when a gift card is loaded with value on our platform. So we function as a gift card processor for different types of brands on the market. We charge commissions when gift cards are resold in our distribution network of more than 12,000 stores in the Nordics and 25,000 stores in Spain. And our latest acquisition, MBXP, has put us in a position where we control around 80 to 90% of this market space in the Nordics. So it's a very, very good position to be in. When it comes to gift cards, we also have a business model based on breakage. When it comes to our own gift card brands, it's when a gift card expires, the value that's left on the card is profit for us. When it comes to partner networks, we implement such networks in programs that we operate for our members. And these networks then enable members to earn points or cash back at hundreds of different stores online or offline. And we charge commissions on all such transactions, and those commissions are also used to finance points or cash back that are given to them, that are used as rewards to the members. And to illustrate the extreme value potential for our platform and network, we can use a relatively fresh example, and that is Supergift, which is our own private label multi-brand gift card. In other words, it's a gift card that can be redeemed for 100 other different gift cards. We launched this product in the middle of last year, and since then we have generated sales of around 60 to 70 million krona with 0 krona in investment in marketing and organization. Obviously, if you would try to do this as a startup, you would be looking at years of work to reach that position and tens of millions in capital to make it a reality. You can move on to the next slide, please. Looking at our financial history, you can see that we've seen steady growth in revenue and profits. In 2017, when we went public with our acquisition strategy, since then we've seen more dramatic growth, both organically and through acquisitions. But in 2020, we saw a negative effect on our revenue in exposed customer segments such as travel, hospitality, and experiences. At the same time, we maintained growth in other areas, but our indirect price for the pandemic, we estimated at 50 million in reduced revenue and 7 million in reduced profitability. But as you can see, our actual revenue decline was only marginal, and the profitability was more or less the same from 2019 to 2020. So when I say the price for the pandemic, it's what we expected to have seen, and on basis of the turnover in those customer segments in 2019 versus 2020. In the last 15 months, we have closed new deals worth around 100 million krona per year when fully launched. Most of this business has yet to show up in our books, but we're pretty confident that the development will be swift after the pandemic. We're a company that has been paying dividends for the past 12 years, and we've raised the dividends 12 years in a row. So we believe in combining paying dividends with organic revenue growth. So that's our continued goal, so to speak. You can move on to slide 7, please. This is just another view of our financial history. Again, you can see the slide effect on 2020 due to the pandemic. But this just goes to show the profitability per share in Awardit. Slide 8, please. Looking at the first quarter of 2021, it's been a very exciting quarter. We signed Saint-Gobain Distribution Nordic, which is a new customer, and it's our biggest new customer deal ever. It's actually worth around 50 million krona per year in revenue for us. We also closed our acquisition of MBXP, which is the leading transaction platform for third-party distribution of gift cards in the Nordics. And a few weeks ago, we signed a term sheet to acquire our competitor, the Inspiration Company. But at the same time, we've had to continue to operate under the effect of the pandemic, although we start to see the light in the tunnel. Looking at our turnover in the first quarter, it increased from 60 to 63 million. At the same time, our profitability decreased from 8.8 to 6.6, and that has to do with lower gross margins, in turn due to changes in revenue mix. We've sold more super gift products, and that is due to the pandemic. We lost some of our business models have been wiped out during 2020, but has been compensated by super gift. And the value of this on profitability level is approximately 2.3 million krona during the first quarter. We've also invested in our IT organization. And also, if you're looking at like the comparison I had in the earlier slide, if you look at the indirect price for the pandemic during the first quarter, we estimated at 10 million kronor in lower revenue and 1 million kronor in lower profit. So if you would add it up, and it was a normal year, we probably would have seen a profitability of around 10 million. Supergift continues to be a great success for us, but it's important to note that initial margin when selling Supergift is initially lower. And there's also an accounting model to be aware of. We recognize the revenue from Supergift when it's not when it's sold, but when it is redeemed. And it's also important to note that we have a business model on breakage, that is expired cards. When we distribute a Supergift and it's loaded with a value, it has an expiration date of 12 months. And after 12 months, if there's any value left on the card, that will be profit for us. But from an accounting perspective, we can't forecast that profit in our books. So we'll be seeing profits from breakage in our books from second quarter, slightly, then more in the third quarter, and probably a lot in the last quarter. We don't know yet how much profitability this will total to. We can move on to the next slide, please. Looking at our gross margin development, we've had a positive trend over time. And we believe that this trend will continue. We've seen a decline in the last quarter, but that is, like I said, it's due to Supergift that reduces the average margin. Like I said, it's important to take into account that we will incur breakage starting slightly this quarter and then increasing over time. This has to do with the volumes of Supergift sold and when they've been sold, and most of them are sold in the fourth quarter, or were sold in the fourth quarter last year. Next slide, please. Some information on our ongoing acquisition of the Inspiration Company. It's a company that was founded in 1999. It's actually Awardit's largest business-to-business loyalty program competitor and incentive program competitor. It has an identical business model. which more or less guarantees great synergies and cost-saving potentials in this acquisition. If we look at their figures for 2021, they had a turnover of approximately 97 million. Their profitability was around 11 million. They actually they saw organic growth during the pandemic, which was higher than ours in the same area, which is great. Looking at their forecast for the coming year, the revenues is expected to be a bit lower, but with a higher profitability. 2022-23, it's expected to be around 25% lower revenue and profitability, which is due to a loss of a major customer to Awardit. It was the case that I mentioned earlier, Saint-Gobain, which we signed a few months back. That has been a TIC's customer for a very long time. That customer case will remain with TIC the full year of 2021. Thereafter, they're switching to the Awardit platform, and that revenue will move over to the mother company. Please move on to the next slide. Looking at the future for Awardit, like you know, we have an aggressive acquisition strategy, and right now we're working on completing the acquisition of the inspiration company, and our aim is to close that deal and take control of the company July 1st. We're also working on the initial integration of MBXP. We've set a so-called 100-day project to do the initial work. In the middle of April, at which time we will be in our books from the middle of April, and TIC, if everything goes well, will be in our books from July 1st. And let's see, I have some issue with my screen here. All right, now it's better. We expect to see increased organic growth regardless of the pandemic. When we entered into 2021 in January, we actually saw that January started on the same note as the last quarter last year ended on a negative note. But then growth actually speeded up during the first quarter. So we saw a growth of around 5% in the first quarter. And starting out the second quarter in April, we've seen a growth of around 10% in all our areas, which is great. We expect the growth rate to increase over time, and we're in a very good position after the pandemic, the way I see it. We obviously continue to work on all business-oriented synergies within the group. That's mainly has to do with cross-selling. We have a bunch of products in our portfolio, and it's important that all parts of the business that we do all that we can to make sure that all customers are aware of all our products, and that they get the opportunity to see the upsides for adding products. We are working on building a partnership network based on open banking, so-called account and card linking, which we believe will be great in the future. That will be added to loyalty programs that we already operate. We'll be continuing with our acquisition strategy. We're obviously looking at different acquisition opportunities all the time. It's a very fragmented market in Europe, so it's the market is perfect for our strategy. And in the long run, we want to be one of the absolute leaders on this market in Europe. With that said, I think we have spent 20 minutes, so we can move on to questions if you have any.
Yes, thank you, Niklas. And a couple of questions. I think I'll start off with your recent acquisition here of the inspiration company. What is the competitive landscape looking like now in the Nordics after you bought your largest competitor within B2B loyalty programs, and how dominating is Awardit now in the Nordics?
Well, I would say when it comes to business-to-business loyalty programs, through the acquisition of Tech, we will have a very strong position. It was our largest competitor. When looking at business consumer loyalty programs, the landscape is still more fragmented, and there are a lot of small companies out there. We're obviously looking at some opportunities, but I believe that moving on, it's more interesting for us to look into other Nordic companies and looking south to for instance, Germany. I mean, Germany is the largest market in Europe.
Right, thank you. And you touched upon it briefly there in your presentation, but what types of synergies are you expecting through this acquisition? And if you could say anything of the size of the synergies, that would be interesting as well.
Well, I mean, we are looking at simple stuff, low-hanging fruit, such as just, premises, certain warehousing, and so on. That's easy synergies of probably 1.5 million to 2 million per year that can be put in effect more or less in a few months' time. Obviously, there are business synergies such as us implementing our private label products into their programs. Supergift is such an example. It's today I believe they're using products from a competitor of ours in Denmark, so that will be replaced very quickly. It's a great synergy. And obviously, looking from an organizational perspective, we expect to also see some synergies, but that obviously takes some time to get to know the company better over the next 6 to 12 months after we take control of it. But probably the best case for synergies and more business so far.
Thank you. And just on that same topic, through the acquisition, is it mainly, are you mainly getting obviously the synergies you mentioned, but also a larger customer base, but are you also getting some type of new technology or product which you're not offering in the presently? Or?
Well, we could be adding some on the tech side. We'll see. They obviously they run their own platform. So we'll be looking at if that platform is better in some aspects, or how we should handle that in the future. But that would take some time, 6 to 12 months before we know that fully.
I understand. Thank you. And just lastly, how many more acquisitions in this size are there in the Nordics within B2B then? And or you mentioned you're looking outside of Europe. Would that be the natural next? Outside of the Nordics. Is that the natural next step for you now?
I believe we can do a few more acquisitions in the Nordic, but I'm very interested in moving south.
Okay.
I can't say anything about the numbers of companies that are on our list, but there are a few.
Understand. I think we're running out of time here, so I'd like to thank you, Niklas, for joining us today and telling us more about Awardit, and for the audience for listening in. Thank you both.
Okay, thank you. Bye-bye.
Bye.
Good morning and welcome to ABG Investor Day. My name is Simon Jönsson and I'm an equity research analyst here at ABG, covering the IT sector. Next up, we have the CEO Johan Nordqvist and CPO Emil Eriksson from Briox. After their presentation, we will have a short Q&A. Johan and Emil, the floor is yours.
Thank you very much. And let me start by saying thank you to ABG for inviting us to this event, and welcome to all the viewers and listeners out there. The ones who will be presenting today are myself, Johan Nordqvist. I've been the CEO of Briox for pretty much exactly 1 year now. And I have alongside me today our Chief Product Officer, Emil Eriksson. Next slide, please. What we had in mind today and what we'll present to you is to give you first a brief introduction to Briox, focusing on our products and the markets where we are present. I will then go into a bit more in depth about our business model. We are in a scale-up phase, so I will tell you a bit more about how our product is and our business is intended to scale. And last but certainly not least, we'll have Emil, who will give you a bit more substance to what we're currently focusing on when it comes to product development and where we are planning to take our product in the coming months and years ahead. So next slide, please. So giving you an introduction, if you move ahead one more, please. For those of you who are not so familiar with Briox, we are a SaaS company. We're present in the ERP business. We work in close partnership with predominantly accounting agencies, where we try to help them implement a more effective way of working and more effective way of collaborating with their customers, who are typically small to medium-sized enterprises. We provide, and our product is a cloud-based SaaS platform that is focusing on various activities that help the users with accounting, invoicing, time management, and other related tasks that are relevant to the accounting agencies and their end users. We have our head office in Växjö in Sweden, where we have all of our product development in-house. This is also where we run most of the marketing activities and finance. But our main markets and 100% of our sales take place outside of Sweden, specifically in Finland, where we've been present for some time, and as of about 1 year back in the 3 Baltic countries. We currently have partnerships with close to 200 accounting agencies in this region, and together they make up a potential ARR base of close to 8 million euro. And I will talk a little bit more about how we're intending to capitalize on that. So moving ahead, please. As I mentioned, we work in close collaboration with partners. We both have partners, of course, on the accounting agency side, working both with some of the biggest and most renowned agencies such as BDO, Leinonen, which is a regional player, Norjan, and other leading accounting agencies in the region. We also have many very important integration partners. For example, several of the leading commercial banks, such as Swedbank and SEB. And we also work with other integration partners where we who help us fill our product and services with more value. Moving ahead. I'd like to give you a brief introduction to our board, both because it's a relatively new board, but also because it's a very, very experienced board who is a critical element as we now scale up and accelerate our business. Firstly, we have Johan Rutgersson, who's been previously the CEO of Briox. He is also the chairman of other SaaS companies. As of about 1 month ago, we have an important addition in Mikael Lindblom. He's the founder and the CEO of the invoice automation company Medius, and he is now present as an investor in many important leading SaaS companies. We also have a very experienced person, Daniel de Souza, who maybe one of the most experienced people in the ERP and accounting field, as he was the previous CEO of Visma SBCS. And we also have a leading PR and marketing profile in Helena Westin, who's had many important operational roles within marketing and is now on several boards, including the Swedish television. And we also have a representative of an owner representative in Martin Jönsson, who's a tech investor. So this is a very important group of people who are now critical as we are expanding and we're scaling up as a company. Go ahead, please. Very briefly about our product. As I mentioned, we have a SaaS platform which is intended to promote collaborative accounting. And what we mean by this is that it's a system where the accounting consultant and the end user, typically then a small business owner, is working together in real time in the same system. Although the user interface is the same in all our markets, the product is adapted to fit the local needs and requirements in the 4 markets where we are present. Many things are similar, but there are also differences in what's needed to power these companies when it comes to accounting and to live up to the local regulations. It's a module-based product, so the accountant and their customers can pick and choose the functionalities that are just right to fit their needs in their collaboration. Next slide, please. Briefly then about our markets. As I mentioned, we are focusing and where we are commercially present in Finland and in the Baltics. And I've put up here just for comparison Sweden, just to highlight that it's about the same size when it comes to population, the same number roughly when it comes to small and medium-sized enterprises in the region. But in the past years, the growth in these markets have been considerably higher than in Sweden. Why we have chosen these markets, there are several reasons. First of all, we feel that the competitive landscape is not as fierce as in perhaps Sweden and Norway. But more importantly, 3 important things that these markets have in common is that the digital literacy is very high. I would argue that to some aspects it's actually even further ahead than in Sweden, although that the accounting industry has probably not come as far in this regard as in Sweden. We also see that in these markets, companies typically work in the same manner as in Sweden, where they have a close relationship with the accounting agency. This is a model that we know, and that's a model that suits us, meaning that we believe that there is room to grow for us with our business model in these markets. And also, importantly, several of especially the big accounting agencies, they are present in the region as a whole. So there are also commercial synergies in that aspect. So we are focusing, as I said, on Finland and in the Baltics. And in these markets, we have people on the ground, so local presence. Next slide, please. I'd like to give you a better feeling about our business model and also where we think, how we position ourselves and where we are strong. Unlike several of the other players in this industry, we were born in the cloud. We've been a SaaS company from the beginning, whereas some of the other players came out from a history of having an on-premises solution and now are moving into the cloud. We are truly cloud-based. We have very strong belief in an open API, meaning that we can easily integrate with other players that can provide value to us, and we see a win-win in helping each other winning, focusing on the same customer segments. We do believe we have a very strong product, and as I just mentioned, we operate in markets that are highly digitalized. So all in all, well positioned. And I will very shortly show you how our business model is intended to scale, because it is a very scalable business model as we work through the accounting agencies. We have partnerships with close to 200 accounting agencies already. And since we have pretty much all of our product development and in-house, and we own our IP. We have by default a high gross margin, which is of course very positive as we scale up. We have a subscription model and a very high degree then of course of recurring revenue. And last but not least, we have a platform that is that can very easily be adapted and expanded into additional services. So all in all, we feel that we're quite well positioned as we now enter a more intense scale-up period. Next slide, please. I'd like to give you an example of how we typically start a collaboration with an accounting agency, and also an example of how our product and business scales up. So typically, when a new accounting agency partners up with Briox, they typically have other systems before, and many times they work with several systems in parallel. So it's not unusual that they start quite small with Briox, letting one or a couple of accounting consultants try the product, and they introduce a handful of their customers into the collaboration and into Briox. And as you can see, the annual revenue with such an initial startup is quite relatively small. But as this collaboration continues, if you move on, please, you can see how it quite quickly scales up. So going from 1 to 5 consultants, and each consultant perhaps then adding 10 of his or her clients, quite easily, as you can see, the revenue stream scales up quite significantly. And as this moves on and the agency feels more comfortable working in the system and is happy with the services we provide, adding more consultants and in their turn adding more of their end users, you can see how this scales up quite quickly. And finally, in this example, if you move on, please, you can see that, and I would say that this is not a very big agency, but not a small one, in the case where we would have Briox being used by, let's say, 10 accounting consultants, and they in turn let 20 of their customers work in the Briox system. You can see that the revenue from just this particular partnership is quite significant. And oftentimes, the end users especially, they use several functionalities in Briox, adding to the revenue stream for us. So my point is that with this scalable, this business model, it very easily scales up together with the accounting agency over time. Moving on, please. Rounding off, before I hand over to Emil, I'd like to show you here the progression of the number of agencies that we have signed up that are now working and operating within Briox. Having a partner agency, it's of course an important metric to keep growing the number of agencies, as that's the sort of the fundamental base from which we then accelerate end user sign up further. So we do feel that we're on track to start growing at an accelerated pace together with the accounting agencies. And if you move on, as we see it, for us to really scale up and to accelerate our growth, which is our focus, we think there are 3 major sort of barriers or challenges that need to be overcome, where we feel that we have overcome 2 of these and are now focusing on the final one. First of all, and it's of course quite significant, you need to have a platform that is powerful enough to do the job, meaning that allowing the accounting agency and their users to be working in the same system in real time. And this is something that we have built now for the past year, where we are now very confident that what we have in place is working as intended. Secondly, having a partner agency is of course critical that we gain the trust of the accounting agencies that we partner up with. And with close to 200 agencies already signed up, we feel that we have the proof of concept and that we're on a very good route to scale things up further. Meaning that our big focus now is to work together with the existing agency customer base and the ones that new ones that we are acquiring, to work with them to start an accelerated onboarding of their end users. And this work is what we're focusing on. It's in progress, and currently we have a bit more than 6,000 active user licenses in place. Next slide, please. So finally, just for you to get a feeling on what are our key priorities at present to deliver on this. First of all, as some of you may have heard, we very recently, or just as we speak, pretty much, are launching Briox Academy. This is an online learning platform that we have developed with the objective to help the accounting agencies and their end users to, in a more scalable and a more efficient way, onboard and get going with Briox and use the system the way it's intended. It's been very well received, and it's something that we believe will help us significantly as we scale up our business. Secondly, and also something that we have just recently done, and what I believe Emil will comment briefly on in a second, we have launched new product packages intending to deliver on the specific needs of certain customer groups. We have previously offered our functional modules standalone. Now we've packaged these in an effective way to make it easier for the accounting agencies and their end users to work with Briox. And last but not least, being a SaaS company, we're of course continuously working on improving the user experience with a specific focus on ease of use so that the end user, specifically these small to medium-sized enterprises, find it both easy and fun to work and prosper with Briox. So with that, I hand over to our Chief Product Officer, Emil Eriksson.
Thank you, Johan. So now that we've had a look at some of our short-term key priorities, I'm going to share with you the future of our product. Moving on to the next slide, we're actually going to start off by having a look at some of the industry megatrends. That is, of course, the accounting industry, because I think it's valuable that we actually share with you how we at Briox view the world. Because I think we can all agree that the accounting industry is undergoing major transformation, which of course has been accelerated due to COVID. So moving on and looking at the first trend, I really want to stress digitization. And I think, you know, the industry has been undergoing change, but that's been more specifically about digitization. That is the move from paper to digital documents. Here we're actually talking about a fundamental change of how the accountants do their business. So it's about changing business models thanks to new technologies. Secondly, on the next slide, we see automation. Now, of course, automation is being enabled by the increased number of digital tools out there. But what I really want to highlight here is that with the help of AI and machine learning, we can actually remove a lot of the repetitive tasks that accounting professionals are faced with on a daily basis. The third megatrend I would like to highlight, and Johan mentioned this a bit previously, but it's all about real-time collaboration. We see that with the prevalence of new tools, web-based solution, SaaS, accounting tools, we see that the collaboration is ever increasing between, on the one hand, the accounting professionals and the small business owners on the other hand. And this needs to occur in real time. Moving on and looking at what this actually has for impacts and implications on our target audience, because they are many. But I'd just like to remind you, okay, who is our target customer? On the one hand, we have the accounting professional, and on the other hand, we have the business owner. And I really want to stress that these two have very different needs. But I think one thing that they do have in common is that none of these is what you would typically describe as your tech-savvy individual. And of course, that is something that we want to help them with and to some extent change. But I think looking at the accounting professional on the first hand, we do see that these mega trends have far-going implications. I think we'd even go as far as saying that the accounting industry is fundamentally changing, and also the profession is changing. So accountants in the future, they need to learn new skill sets, they need to train their business acumen, and they also need to go from being reactive to proactive. The business owner, on the other hand, given these new tools that we see rolling out, SaaS solutions, web-based solutions, we see that they need to get more involved in their daily accounting. So keeping track of their invoicing and so on. So really what it comes down to is helping the accounting professionals do their job in more efficient ways. And with the business owner, it's about turning complex and scary into something simple and, as far as possible, also fun. So moving on to the next slide. Now, given that we've had a look at these industry trends, how they affect our customers, I'm going to share with you what we are going to be focusing on in the next 18 to 24 months. So if we just click a couple of times more, first of all, we want to start off with user experience. That will be our foundation, a user experience that truly drives collaboration between the accounting professionals and business owners. Secondly, it's about simplifying through integrations. So allowing our accounting professionals to connect to adjacent technologies to really give them best in breed of what they need. And on top of this, it's all about increasing efficiency by getting rid of repetitive tasks by leveraging automation. Finally, if we look at this in a bit more detail, within these major themes that we have identified, first of all, within the user experience, what we're going to do short term is improve our invoicing experience, develop in-product guides, and improve the in-product onboarding, as well as delivering a new mobile experience targeting business owners. Secondly, if we look at integrations, we're really going to focus on enhanced payroll capabilities. And something that I'm really excited about is looking into e-commerce integrations, more specifically Magento, Shopify, and WooCommerce. Now, of course, these are integrations that apply to all of our markets, as does open banking. And then finally, looking at automation, we're going to be focusing on enhanced document interpretation, efficiency gains thanks to SAML 2.0 SSO, and advanced workflow capabilities. Now that we've shared some insights into the future of our product, I would like to thank you for listening and hand over to Simon. Thank you.
Thank you so much, guys. I have a couple of questions. First off, I'm curious about your development in the Baltic region. Could you give us an update on the situation in those markets? How is the onboarding of new agencies developing, and how has the pandemic affected operations?
Yes, absolutely. Thank you. Well, first of all, just to give some perspective, Finland has been and is still our main market. That's where we've been present the longest, and that's, of course, where we have the core of our business. Then we have identified that's complementary. We believe that the Baltics, together with Finland, make up a good market for us to focus on, and that's where we're intending to grow in the years to come. It's important to highlight that it's quite recently actually that we entered into the Baltics, first in Estonia and now most recently into Latvia and Lithuania. So to summarize the situation, we are, I would almost argue that we're still in launch mode. So we're building up the fundamentals to build from. So in terms of, we are adding up more agencies that are coming into Briox. So that is our focus. But to answer your question, has the pandemic affected us? Yes, it has. It has been increasingly important, or it has been more difficult than, of course, than we expected to ramp up new business acquisition, simply because we have not been able to have meetings with them. These markets have been in pretty much a lockdown compared to Sweden. Having said that, we're very confident about the potential in this market. We're having conversations with customers on a daily basis. So things are moving ahead, but we're still in a launch phase, but with great hopes and great ambitions.
Okay, great. Thank you. Maybe one very short question here. Could you give us some flavor on the current onboarding of new agencies in general? Have you seen any acceleration during the COVID vaccination, for example?
I wouldn't say it's either an acceleration or the opposite. What we have felt and what has been a focus for us is that we believe that the onboarding experience is absolutely critical for our customers and basically anyone who wants to take on a new way of working. Having a great product, I think, is a prerequisite and something that's a must-have. But I think in general, and in this industry in specific, I think the service element has been underestimated, which is why we're now putting great focus on securing a very, very good onboarding experience. This has traditionally, both in Briox and in the industry in general, been done quite manually. And since, with our growth ambitions, we feel that this must be done in a more scalable, yet even more customer-friendly way, which is why we have now developed and are now launching Briox Academy as a complementary tool to provide the agencies with more power from us to provide a better service to their customers so that we can together more scalably and more efficiently and as mentioned by Emil, hopefully even more fun, bring on new clients. So that's in short where we are. So we're in the process of launching this, and we have high hopes that this will help us and our clients.
Great. I think that was all we had time for. Thank you so much, Johan and Emil, and thank you all the listeners.
Thank you very much.
Have a nice day.
You too.
Hello and welcome to ABG Investor Day. My name is Simon Jönsson and I'm an equity research analyst here at ABG, covering the IT sector. Next in line, we have the CEO of BTS, Henrik Ekelund. Henrik, the floor is yours.
Thank you very much, Simon, and thank you everyone for listening in to this BTS presentation. I will assume that you do not know anything about BTS. And I will tell you a little bit about our background and what we do, and also a bit about track record, which I must say has been I'm quite happy with. Just as a background, we came to the stock market almost 20 years ago in June of 2001, and we then introduced the stock at 19 krona. And yesterday, I think it was trading somewhere between 330, 340. So it's not. Was I guess 18 times, plus a nice dividend since we introduced. So the performance has been good. And let me tell you, why have we been so successful? Why has the share price gone up? And why do I believe that our growth story will continue? We're just at the beginning of this growth story. I will give you this. So you can see on the next slide a little bit of an overview of what we do. So we're about a 1.8 billion company. And we have about 900 people in 33 offices, as you can see on this map, around the world. And if we look at the next slide, I'll tell you a bit more about what we do. You know, the drivers of our business, we are the consulting and training company that comes after McKinsey. When a company has decided on a specific change or a specific strategy and they need to implement, then the hard thing starts. And what is hard is to align their people to this change and train them and make this change happen as fast as possible. The slide you see in front of you here with all the pressures of change in the business community, I produced that slide before the pandemic. The pandemic itself has multiplied the change pressure among the top 2,000 companies in the world. That's our prime target group. So change is faster now than ever after the pandemic. New strategies, new initiatives, digital transformations, etc. And when companies change, that is when they need our services. So we have noticed that the market, since this year started, has become extra hot. So there's some drivers, strong drivers out there, and the pandemic has accelerated those. And looking at the next slide, I'll give you, these are some of the customer names, and they typically stay long for us. At BTS, we focus on growing existing customers. So we have an average of 7 years with our customers. We, of course, also add new customers. Both of these are important to our successful growth track record. On the next slide, I thought I would give you a few examples of what we actually do. If you look at the whole text on this slide, so this, was, and you can click down until you get to the end of this. Here it is, yes. So a large European gas company found out that their customers did not like them. That's not uncommon for a monopoly utility. And they figured out they had to change this, and they set up a customer focus strategy. To make this happen, they hired BTS to train and develop every manager in the company. And we made this very successfully. And as you can see, the so-called Net Promoter Score, which is used to measure customer satisfaction, advanced hugely during our time. The next slide, I have another example. So this is an industrial company, a global industrial company. They had a new CEO who came in, who said, we have fantastic products, but in this company, the managers do not really understand profit. They understand their products and technology. They don't understand what drives profit and growth. And this new CEO had worked with BTS before. He called us in and said, train all my leaders to understand profitability and what drives that. So we did that, and the profit has gone up significantly in this company, as has the share price. Now, the third example here, if we take the next slide. We're coming straight to this. I want to mention, because some people say a consulting business, there's no scalability. This is not true for us. You can say we are a combination of a consulting education company and using technology. So everything we do, we use simulations, computerized simulations, to train the people we meet. And to explain what that is, imagine you would train a pilot to fly a plane using PowerPoints or the traditional training methods we often use in the business life. It doesn't work. You use simulations. Please go back a little bit. And these simulations we build per industry. So we have a lot of scalable content, a lot of scalable simulations that we can reuse. And that is the reason companies come to us. A lot of it in digital format. So there are many scalable parts in our business. Now, if we look at the next slide, why do we grow year after year? First, look at number one. The market is growing. The market we are in grows about 4 to 5% a year. It's fragmented, which is good news for us. It's much easier to take market share. So while the market is growing 4 to 5%, we have grown 14% top line from 2001 to 2019, so much faster. How do we do that? If we click on the next, we compare to other companies because we use these simulations and our ability to customize them and our digital content gives us a very competitive product offering. This is one reason we take market share. If you look at the next click, we invest a lot in organic growth. We put a lot of money into marketing, into product development, into talent. And final click, we also make acquisitions. So of the 14% we have delivered for 18 years, on average, about 2% is acquired and 12% is organic. And of course, the pandemic for us was a huge issue because much of what we do has always been physical meetings. And I will come back to that later. But I would like to say is that we grow every year, year after year, and we will continue to grow in the future because of these 4 factors. We are in this growing market with only 1% global market share. And we have great product. We put a lot of money into growing and into acquiring. And with 99% rest to take of the world market, there's a lot of room to continue to grow. So that is our plan, to grow year after year because of these 4 factors. So if we look at the next slide, this is a little bit around our acquisition strategy. Just me cover that shortly. So we do not buy companies just to add them to our P&L. We look for strong synergies, either by adding a new service or product that we can sell to our customers, or by adding a new geography. So we bought our way into Italy and into Germany, 2 very interesting markets. We've also added some interesting services like assessment and like coaching to our portfolio. So we look for strong business synergies. We typically acquire a company in the range of 3 to 15 million euros. That's an interesting segment because competition is not that strong. So you can make quite interesting acquisitions at terms which we believe are attractive. And our track record here in acquisitions is, as you can see in this slide, also very favorable because we are very picky on the targets we bring in. One key aspect is the cultural synergy. In a service company, you need to have cultures that can work together or the synergies will not happen. So if you look at the next slide. So let's look at a Q1, and I think you can click on all the bullets here. let me tell you, so Q1 has, become another record-breaking quarter. Until Q4 of 2019, we had, I think, 16 record quarters in a row. Then came the pandemic, and with 70% of our revenues in physical delivery, we faced a tough situation where we decided to apply a long-term strategy last year. We kept all our people because we knew that demand would come back and we wanted this capacity. So we didn't make the short-term cut. Instead, we took all our 800-900 people and converted to virtual delivery. And that was an investment process. It was hard to get into the clients last year. So last year we had, a big fall in revenue and a big fall in profit. But we continued to think long-term during 2020. We don't think our shareholders are interested in the next quarter. They want to see a new long period of 14% revenue growth going forward. So we continued to be long-term last year, and we got the reward already in Q1. And when we look at 2021, we're not comparing with 2020. That is way too easy. Those numbers we beat in a heartbeat. We are comparing with 2019, which was a very strong normal year. And as you can see, we managed to grow 12% and earnings, EBITDA, 40%. So 2020 was a tough year, but every crisis can be used to build, a new era of growth. And this is what we've done, because now we're going into 2021 and going forward with a leading portfolio of virtual services. We are investing in digital. So we become a leader in the kind of post-pandemic paradigm for our industry. And so we're very grateful for this long-term strategy and aim to now go into a long period of growth. Look at the next slide. Yes, you can see here, these are basically the numbers. And yeah, if you look at the next slide, you can see here, next slide, please, that Q1 is, if you compare it with earlier Q1s, is by far the best we've ever had done. And this is, post-pandemic. So we are very proud. And our goal is, of course, then to beat Q2, Q3, Q4 as we move forward into 2021. So looking at the next slide. This is Q1, and you can see that, the development here. You see that the growth in krona is not 12% because the krona has strengthened a lot compared to the same period, both in 2020 and 2019. We always look at growth currency adjusted because it is the measurement of the real growth capacity that we are showing. So looking at the next slide, you can see that we've had a very favorable development in North America, also in other markets. In Europe, our smallest unit, had a very strong Q1 to compare with, and we can see also that the comeback in the market is stronger in the US and other markets than it is in Europe. So next slide, please. So this is just a look at our period. And I mean, to the very end of the slide, you can see how we were hit in 2020. But again, we decided to be strategic and long-term. We acted very quickly, but nothing short-term. We know our shareholders are not interested in optimizing profit in a pandemic year. They're interested in the long-term growth in revenue and profits that we can produce. And we believe that with our strategies in 2020, we positioned ourselves for a new significant period of growth. So looking at the next slide, this is just quickly to see the share price. And as you can see, if you put 19 krona into the BTS share in 2001, long time ago, you've done way, way better than the stock market. And we've also given a dividend that has been, average 2 to 3% of the stock price every year, except actually 2020, we are reducing the dividend, keeping that some of the cash in the company for to drive more investment in growth. So looking at the next slide, so summarizing really the core reasons, why people have shares in BTS. And I think the first one is key. We are not limited by a national market. We are all over the world. It's a huge market. It's growing. While, we only have 1% global market share today, we are very competitive in terms of our offering and how we go into the market. So there's this continued opportunity to grow just by taking market share and benefiting from the growth in the market. I think the second reason why people keep their shares, and actually our stock, yes, it went down in 2020, but not that much. And interestingly enough, after our Q4 report, which was clearly worse than 2019, but we then said, we'll have a strong 2021, because we have delivered year after year this growth in revenue and profits, because we have delivered what we've said year after year. There is a credibility around us that companies believe, investors believe that when we say we will deliver growth, we will deliver growth. And finally, some shareholders are attracted by the fact that we've actually upped our margin goals and growth goals. We have them higher than we have delivered in the past. We were on the way to a higher margin in 2019, working towards the 15%. 2020 obviously was a totally different story. But then again, in 2021, we see 3 percentage unit up compared to 2019. And we also hope to, by making a bit more acquisitions, not growing 14% per year, but even faster going forward. So I would say those are, the real equity story reasons why people own the BTS share. So next slide, please. So yes, basically this is a summary of the next final. That's good. This is a summary of, in March, actually end of February, when we realized what was going to happen. We said, let's act fast, but think long term. And this is how we want to come out of the crisis. It's not about just handling the crisis. What do we do to come out of the crisis? With this powerful same organization, stronger, with a better offering, with virtual and digital, and with a bigger customer base. All of this creating the platform for further growth and profit. And next slide, please. So with 2021, as said, for sure we're going to beat 2020 big time. But we are mainly comparing with 2019, which is a much more relevant year to compare with. Is there another slide there? Please feel free to, yeah. So is an overview of the shareholders. So the bigger shareholders in the company, myself and some other key people in the business, plus some major institutions. And next slide, I think is the end. Yes, it is the end slide. So thank you everyone for listening so far. And I'll stop my presentation there.
Great. Thank you, Henrik. I'll start off with a question about recruitment. Could you shed a light on your current recruitment initiatives? You did not slow down in 2020, quite the opposite. But are you slowing down now when the economy is recovering? And I guess your competitors are looking to recruit as well.
We are recruiting a lot. We are recruiting to handle the growth in 2021 and for the future. I would say in every market. clearly the talent market is a bit tight, particularly on the seniors. If you want to hire seniors, we hire a lot of younger people. There is quite a lot of people actually to hire, because many of the younger people didn't get jobs during 2020. We also have a very good employer brand, very good ranking on Glassdoor, and a good reputation. So despite a competitive talent market, we are finding the people we need.
Great, thank you. And Henrik, you have mentioned that post-COVID, you still expect about 1/3 of your business to be virtual. Could you maybe give us some flavor on how you aim to maintain, or in some circumstances, re-establish good relationships with your customers? I guess this is an issue for most corporations, but how do you tackle it?
Well, we could see when the pandemic came that some of our customers totally stopped buying. Some industries disappeared from buying. So we refocused towards tech, pharma, financial services, consumer products, more stable sectors. But we've stayed in touch with all our old clients and the new growing clients. And in the future, we see that when people want to organize training, they will ask for physical delivery sometimes. They will ask for virtual delivery, so Zoom like we do now sometimes, they will ask for digital delivery, so you work on your own without a facilitator. All of those three. And we see it as a competitive advantage that we can offer all three, and with very high quality. Some of our competitors who focused a bit more on cost cutting in the crisis, they responded much slower to virtual and digital, and they are behind. And we've actually won some new big assignments just because we are strong in virtual.
Thank you. Do you see any risk of losing some of the customers you won over last year with your superior virtual solution once physical delivery is back on the table, so to say? Or do you expect that the positive momentum you gained during the pandemic enables you to further gain market share? Maybe you could elaborate a bit on how you view your competitive position now versus 1 or 2 years ago.
I think we're stronger. Virtual delivery over Zoom is not that easy. And people do not want to take 1, 2, 3-day training class, just listening and seeing slides. They won't like it. And most importantly, they won't learn anything. And when I look at many competitors, it's a talking head with slides and a little bit of discussions. We have an advantage because we do simulations, so we can naturally create interaction and activity by everyone, and gaming situations and decisions and so on. But then also because we went so heavily into virtual last year, we've gained so much experience. We've done several hundreds assignments yet. So the pandemic was really tough news from us last year, but they create an opportunity to become more competitive. I think we will keep the customers we've gained, and I think we will win more.
Okay, thank you. I think that was all we had time for. Thank you so much, Henrik, and thank you, all listeners. We'll be back in 5 minutes. So, thank you.
Thank you, everyone. Thank you for listening. I appreciate it very much, and thank you for your questions, Simon.
Thanks.
Hello and welcome to this next presentation here at ABG Investor Days, where we have the pleasure of hosting a presentation with the CEO of Doro, Carl-Johan Zetterberg-Baudry. My name is Simon Granat and I work as an equity analyst at ABG covering tech and IT companies, and I will be moderating this presentation. And with that said, Carl-Johan, please go ahead and present the company.
Thank you very much, Simon. Let me know if you don't hear me loud and clear. As Simon said, my name is Carl-Johan and I'm the president and CEO of Doro. And I will give you a short introduction to Doro, tell you a little bit about our market and our strategy and focus going forward. So I think, Simon, you can actually jump 2 slides ahead. So Doro, we are a senior-oriented technology company, being the market leader in Northern Europe for senior care and the market leader in Europe for senior mobile phones, where we assist more than 3 million seniors every year with our products and solutions. Last year, in 2020, we had an annual revenue of approximately 1.7 billion Swedish kronor, of which roughly 420 million was service revenue from our Doro Care business. And Doro Care is a business that we've grown with close to 20% in average the last 5 years. You can take next slide, please, Simon. So our 2 businesses, Doro, as said, is a senior-focused technology company with two core businesses and 2 business areas. One being business area Doro Care, where we develop, sell, and deliver technology-enabled care solutions to seniors, relatives, and caregivers, where we focus on both the market for individual living and assisted living. And this is a solution based on both hardware, software, and service elements, both from a sort of contact center perspective and field services perspective. And this business is primarily focused on the public sector. Our main customers in Doro Care are local authorities and housing associations, whereas our second business area Doro Phones, where we are the European market leader in senior mobile phones, is a business where our main customers are the large operators in Europe like Vodafone and T-Mobile, Telia Sonera, and the large retailers in Europe like Elköp, MediaMarkt, Tesco, etc. As I said, Doro Phones focuses on senior mobile phones. It's an offer both based on hardware and software, and more hardware-oriented business-to-business business compared to, as I said, our more service-oriented, public sector-focused Doro Care business. Next slide, please. And as I briefly mentioned before, Doro Care, we are a market leader in monitored connections in Northern Europe, with a market-leading market position in Sweden, with roughly 40% of monitored connections from Doro's perspective. Norway, also approximately 40%, and in the UK, we are a shared market leader with roughly 14%. And the lower number in the UK is because UK is a much more fragmented market today than compared to Sweden and Norway. And in Doro Phones, as I mentioned, we are market leader in senior mobile phones, where in our core markets, Sweden, UK, France, and Germany, we have 60+% market share in those markets. Next slide, please, Simon. And from Doro's perspective, we've had a strategic focus on our Doro Care business in the last couple of years in growing and building up a more significant care business also in combination to the already very strong Doro Phones business. And Doro entered into the care segment, I would say, for real, early 2015 with an acquisition in predominantly Sweden, a company called CareTech. And we have focused since in growing and further developing our care business. And as you can see, we have grown that business from a little bit below 200 million in 2017 up to 420 million last year. And if we would fully account for acquisitions that we made during 2020, especially in the UK, the pro forma number for care would be a little bit higher if we look in from a service sales business. And of course, this brings a different element to Doro also, where we now increased, and roughly a third of our business is more service-oriented business compared to the more product-oriented focus of Doro historically. And also, as you see, the share of operating profit has also grown, and care accounted for a little bit more than a third of our operating profit last year. And as I briefly mentioned, and also the strategic focus on care has put sort of a different shift or different aspect to Doro as well. As Doro Care is the public sector focused business with local authorities and housing associations being our primary customer. And as a result, it's more public procurement driven business, service oriented business with approximately 80% of our revenue being service associated, and the remaining 20% hardware driven. And the services is a combination of both hardware, software, connectivity, and contact center and field engineers, with the average contract length of the public procurement contracts roughly 4 to 5 years. Next slide, please, Simon. And based on sort of the strategic focus we've had on care and managed to grow that business in total now, Doro Care is a business that's a little bit more than 500 million Swedish kronor in revenue. And as I said, it's a business focused on Northern European, but also with some interesting market positions in countries like Germany. We've seen that Doro Care has come to a position where it is sort of strong and big enough to stand on its own. And as we said, our two business areas, they have a great thing in common, and that's the senior. But if we look at customers, business model, and offering, the two business areas differ. And that's why we've taken a strategic decision with an ambition to separately list Doro Care and have two separately listed companies, one being the Doro Phones business focusing on mobile phones for seniors, and the second company being Doro Care, focusing on technology-enabled care solutions. And we firmly believe sort of separating and separately listing the two companies will give each company the focus and dedication to their specific business that they need to ensure that we sort of capture all the opportunities that we see and that we develop the two businesses in the best possible way in the future. So as I said, our ambition and our plan is that we will separately list Doro Care, and we are currently sort of under the ambition and target to do that towards the end of 2021. Next slide, please. We can jump, I can just, and as I said, to give you an update on, or an overview and an understanding of our market, and especially focusing on if we look at the technology-enabled care market, where today, as I think all of you know, senior care are facing great challenges already today, and all those challenges are expected to only increase in the future. Because we have both a growing elderly population, both as you see here in absolute terms, but also in relative numbers to the rest of the population. There's a growing funding gap due to increasing care costs. And also care is several more times costly in residential care and in hospital care compared to home care. And also maybe what you don't see in this slide is also the mental and physical well-being and as a result, the overall well-being of the seniors are higher in home care than in residential and hospital care. And as you might have seen, and Doro, we have started an initiative that we call the Commission of Loneliness. And we presented sort of a study on the map of loneliness in Sweden here recently. And also, I think an interesting fact and finding in that, going back to sort of residential and home care, is people who live in residential and hospital care, even though they live in an environment where they are surrounded with sort of more people on a continuous basis, they still feel more lonely than people who live independently and are treated in home care. So there are several aspects why we firmly believe that technical solutions will be a key and an enabler for senior care at home, and as a result then being able to reduce cost for society and handle some of the acute challenges that we see. Next slide, please. And why is that? So why do we believe that technology-enabled care is one of the key elements in trying to solve this complex equation? This because we see that senior care technology can, as I said, save cost for society, reduce hospital admissions, delay institutional care, can enable family to stay informed and involved. But of course, most importantly of everything is it can enable the senior to live with increased independence, safety, and quality of life. And that's our dedication if we look at Doro. We want to make seniors' lives as independent and as good as it can be. So essentially, we are striving for making the rest of your life the best of your life. We can take next slide, please, Hanna. And given sort of I would say the large trends we see in society and the challenges where we believe technology-enabled care is one of the key solutions, we see, and of course also others predict, that technology-enabled care solutions will be a growing market in the future. And there are a few key factors driving growth. One is, as people live longer and as number of seniors increases, the addressable market grows. We see that penetration of care services will increase, are increasing and will increase even further in the future, in order to be able, as we said, enable home care instead of institutional care and hospital care. And this also drives revenue per customer or revenue per end user to grow as new services and new solutions will be introduced. And that's why essentially the market is expected to almost double in the coming 5 years if we look at the technology-enabled care market. Next slide, please, Hanna. So a little bit of our strategy and what we want to achieve going forward, probably both from a technology-enabled care perspective, but also to give you a flavor of what we want to do in Doro phones and our market-leading position in senior mobile phones. But if we look at Doro Care and our ambition, our strategy in the technology-enabled care segment is we want to be one of the leaders driving and transforming the market for elderly care. And we want to sort of drive the market and drive ourselves from the current more responsive markets with primarily in most countries in Europe, analog connectivity, standalone systems, and more, as I said, responsive type of alarms and services. And we want to transform and drive that towards a future market that will focus on predictive, proactive, and preventive type of solution, which will require and sort of be based on IP-based and digital technology and integrated solutions of products, services, and software, where there will be more active monitoring and sort of call it behavior analysis and detection to be able to early detect changes and movements, etc. And then also, of course, empowering both caregivers, the individual themselves, and relatives and loved ones to be involved and to be as effective in their task as possible. Next slide, please. And in order to be a leader in transforming the technology-enabled care market, we believe that we will need an integrated technology solution for, as I said in the previous slide, tomorrow's services and solutions. And that integrated technology solution, from our perspective, consists of primarily 3 cornerstones. And I can take sort of one of the most important one being the software platform that will be, you could say, the glue holding everything together. And that will be key for notification, analysis, reports, device management, and essentially keeping everything together and keeping it up and running and doing both analytics, notifications, and alarms. But in order for that to happen, of course, hardware will continue to be an important piece in the solution, where different devices and sensors will be both data collectors and triggers, as it is today, or if things happen. So that will include, as we have today, both our care phones or home hub, as we call it, motion sensors, different environmental sensors, GPS tracking, etc. Where from a Doro perspective, we will focus on developing a selected few key products where we know they are key to the overall solution and where we can differentiate and develop a solution that we believe is sort of second to none in the market. For the other products, we will make sure that we use for our services and offering best of breed third-party products to ensure that we develop the best services for our customers and for the end user. And then finally, the third pillar being the contact center and our field staff, taking care and handling alarm notifications, installation, maintenance, etc., to ensure that we deliver a high qualitative service and take care of, again, customers and seniors in the best possible way. Next slide, please. And that's for our care business, and we've invested a lot in the last couple of years to ensure that we build a stronger and more solid foundation to be able to expand even further within our care business in the future. And we've developed a solid and started to do a lot of investments and development in our software platform, improving our hardware, driving sort of a high qualitative and more efficient service delivery, and also expanded our business, adding selected acquisitions, both to drive geographical expansion, but also to improve our presence in already sort of existing geographies. And looking ahead, we want to drive and accelerate growth even further for Doro Care, because we want to grow our market share in individual living, especially in the UK. We see interesting opportunities in further sort of driving growth and increasing our market share in individual living. We want to further expand into assisted living. We have relatively small business today in assisted living, and we are sort of developing and strengthening our offer in assisted living to take a very strong share in that market as well. Then, of course, developing our offering further to the more tomorrow solutions with predictive, preventive, and proactive technology-enabled care solutions, which will drive average revenue per customer or per user. And then also, we will, as an addition, as we've done historically, look for strategic acquisition opportunities to either expand geographically or even further strengthen our market position in selected markets, or as we did with Victrix that we acquired last year, acquire specific technological assets that will improve our offering overall. Next slide, please, Simon. And then if we look at our Doro phones business, where we today have, as I said, a market-leading position in Europe for senior mobile phones. We have a fantastic position that we will continue to defend and strengthen to ensure that we even further sort of increase our market-leading position in senior mobile phones in Europe, but at the same time ensuring that we have a good, continued, very good and profitable senior mobile phone business. Then in combination, we have started to invest and explore even further in sort of new innovative offerings that's suited for our customers and of course for the seniors at first. And what we say is that we are using and leveraging our strong platform that we build up with senior mobile phones to develop and launch new offerings. So it's about making sure that we utilize and leverage our leading senior brand that we have, where we are a leading senior technology company today with a very strong market position and brand reputation in Europe, with very strong customer relationships. As I said before, we have long and strong relationships with all the major retailers and operators in Europe today. And of course, we've been in this business for more than 45 years, meaning that we have a long and very sort of competent team with long experience and know-how in both technology and in seniors. You can take next slide, Simon. And that's meaning in sort of utilizing the assets we have and ensure that we leverage them in developing new offerings and adding new offerings to our Doro phones business. We see that our brand and our know-how and our customer relationships are relevant in highly attractive markets in the future, focusing on seniors. So this is just a few examples where we see sort of interesting opportunities that we are looking into and seeing what and how to explore in the future. Where, just an example, we can take the hearing market, where we have hearing aids and headphones for seniors, where we already today in our mobile phones put a lot of effort in sound and in the speakers, making sure that we adapt the sound to the seniors' hearing and seniors' ear. And here as an example, that's a market that's approximately $9 billion on a global perspective, with close to 10% annual growth. And this is just one, or these are three examples where we see, as I said, our strong foundation can be utilized to tap into different markets as well, and broadening our offering within Doro phones as we continue to manifest our leading position within senior mobile phones. I think next slide, Simon, and with that sort of short presentation of Doro, I hope you got the better overview of Doro as a company today, our two business areas, and our ambition to separately list Doro Care, have two separate companies with a strong strategy and very interesting future, with a lot of opportunities for both companies. So thank you very much.
Thank you so much, Carl-Johan. I'd like to continue the presentation with some questions, and I'd like to start off by continuing where you ended regarding the spin-off of Doro Care. It has now been some months since you announced the news, and I believe that you might have some more color to us to give us around that. Are you planning on changing any strategy? Are you planning on changing the go-to-market model, broadening the offering, entering new markets? Could you say anything about the new strategy?
Yeah, thank you, Simon. I think if we are looking at, of course, looking at the two different businesses, and I would say a little bit the strategy that I presented here, where we want to be the market leader and European #1 in technology-enabled care, and sort of drive tomorrow's solutions. That strategy still is sort of highly relevant for Doro Care, and also sort of from a separate listing perspective. That's the strategy and the ambition we have for Doro Care. Then, yes, we are in a process, I would say, more refining the strategy than changing the strategy. And a little bit the same goes for Doro Phones, where our ambition and strategy is to continue to be the clear market leader for senior mobile phones in Europe. But then, as I said, and as we communicated before, to invest in innovation and use and leverage the strong assets we have to sort of expand our offering within Doro Phones as well, with solutions that are relevant for our customers and for the seniors.
Thank you, Carl-Johan. And as a follow-up question to that, I know that in conjunction with the Q1 report, you mentioned that you have recently seen an increased procurement activity. What markets does that relate to? Do you see any pent-up demand within your care business due to the COVID-19 crisis?
I think sort of, and if we take both Doro Phones or phone market perspective, I think more what we can see in certain market in phones, of course, and it depends a little bit how different countries have handled the pandemic. To some extent, how much lockdown have we seen in different countries? And I would say countries where we've seen sort of significant lockdown in also sort of relevant retail sectors, we see some increased activity as restrictions are eased. And we mentioned that during the Q1 report, for example, we've seen increased activity in the UK after they started to ease on their restrictions. From a care perspective, as you said, Simon, I think in all different markets, or both Sweden, Norway, and the UK, we've started to see increased activity where, as it is predominantly now, it's an increased activity in terms of preparing and getting public tenders out. So that means there is increased activity from our customers to start to do sort of procurement, public procurement activity, which means we see increased activity now, which will lead to sort of market growth and new business a few months ahead, because first the procurement needs to go through and then the solutions needs to be installed, etc. But the activity in the market is increasing a little bit. And I would say maybe pent-up demand, I would say it's rather that existing solutions have continued, and maybe changes that you wanted to have done during the last 15 months, you have postponed, and now those procurements are coming out. So it's probably a little bit of a pent-up demand in new public procurement activity, but maybe necessarily that I wanted to buy something, but I stopped for 15 months.
It's a very good answer, Carl-Johan. We have unfortunately now run out of time, so I'd like to send you my best regards for participating today. So thank you for that.
Thank you very much, Simon, and thank you everyone for listening.
Hi, everybody, and thank you for joining today's call with GOMspace on our Investor Day. My name is Benjamin Silverstone. I am the equity analyst at ABG covering GOMspace. And today I have the pleasure of having Niels Buus with me, who is going to introduce us to this exciting case. Niels, thank you very much for being here today. And without further ado, I will now give the word to you. Thank you.
Thank you very much. Thank you for having me. I would like to start my presentation now. I think you are not on my picture. Are you showing the presentation or? You should run my presentation. You shouldn't run your presentation. Sorry about that. Something is wrong with my presentation.
Let me see. So is it from your side, Niels, or from our side?
Yes. Of course, I would like to present GOMspace today. But before I do that, I would like to point out three things that I would like you to bring from this presentation here. The first thing is, what is the new space economy? If you are interested in space and if you want to invest in space, the new space economy and understanding the new space economy is very, very important. So I will start doing that. And when I do that, I will tell you a little bit about this picture here. The next thing is, what is GOMspace? Obviously, in general, if you're interested in space, GOMspace is worthwhile to know what that is. But if you're interested in our company and interested in investing, that's obviously very important. So I would like to explain you what GOMspace is. And I will tell you about this picture. The last thing is, why should you invest in GOMspace? And that is the core and I will explain why that should be why that could be useful for you. But before I do that, or when I do that, I'll show you about this picture here. But before I do that, I would like to present myself. I am one of the lucky persons who had my face on the Times Square. I think it was there for 3 seconds. So I've experienced to have a great success. I've also experienced to have big troubles. We had a customer that unfortunately couldn't finance their big order with us, so we've had to cut down on the company. I've tried restructuring. I've tried rapid growth. So I think I'm very qualified for the venture that we are standing in front of as a company right now. But let me begin with the 3 points that I want to go through. The first thing is, what is the new space economy? And I promised you to look at this picture. And let's look at this for a moment. This is the SpaceX Starship, the Starship that's going to go to the moon, intended to go to Mars, and it can actually contain 100 people. It's more than 50 meters long, and it's one of the big challenges or goals that one of those so-called space barons have put. The likes of Elon Musk, Richard Branson, Jeff Bezos, they have really ignited the new space era. They have started the new ventures that's going on all around the world. They have made wild goals to go to Mars. They've admired, they've inspired and amazed. And I think they've also brought people to shake their head. But nonetheless, it's really moving forward in this business at the moment. Many countries have, on the back of that, started their own space ventures, space organizations. They can now have access to technology. They can have access to being part of exploring space and create their own wealth in the future of space, which is something that is very, very important. I think it's more than 75 countries now have their own space organizations. It has also started large space investments in new space companies. A lot of venture capital is going into this business segment, and that is something that is also pushing this business very much. The last thing is that the established space companies, they are being threatened at the moment, and that is encouraging. They are pushing them to start to make new solutions where the new space market or the new technology is coming in as well, which is also something that is a lot of new opportunities in the market. And the space market is something that is growing. It is growing from 350 billion last year to 1,500 billion in 2040. So a long-term growth is something that is expected into the future. And obviously, at the same time, the market is growing. The technology is becoming smaller, more accessible. The numbers are going to go up. So the numbers of nanosatellites in the future, or small satellites, are going to go up with a very high pace, do we expect. So this we are developing together with our colleagues and our competitors. We don't see a big urge for any consolidation. That does not make sense in our view in a growing market. So it's about creating new business. It's about creating new opportunities. Okay, that was the first part of it. The next part is, what is GOMspace? And I promised you to tell you about this picture here. This is our headquarters in Aalborg, only a few 2 kilometers from where the company was founded as a spin-out from the university in Aalborg by 3 students. The company is a developer and producer of nanosatellites, and we're very keen on saying nanosatellites and not microsatellites and others, because we want to come from beneath to make the technology light and small and very powerful, even though it's small. The company was founded in 2007. I had the pleasure of being the first chairman of the company and took over as the CEO in 2014. And it was funded by the local seed environment community up here. And since 2016, we were on the stock exchange in Stockholm. We have subsidiaries in Luxembourg, Sweden, and the United States. And as I pointed out last time we were in here, we are looking at other countries as well, primarily European countries where we have the more Asia opportunities, but also because some countries have their space ventures financed by national money that requires that the satellites and the workforce and the work is taking place in their particular country. So that is something that we will have to adhere to and are certainly considering very seriously. I'll get back to that a little bit later in the next part of the presentation. The satellites are growing in size. The first satellites were 1U, 10 by 10 by 10 centimeters. They've grown to 2U, 3U, 6U, 8U, the one that never came about. And finally, the last one, a 12U satellite, which is where we are at the moment. And we are making what we call a GOMX-5 satellite for the ESA environment at the moment. But that satellite is also going to be the backbone of what we are going to do in the future. And you can see here the GOMX-5 satellite, very big solar panels to harvest a lot of energy, very big antennas to make advanced communication and radio wave communication in different kinds. And that is a satellite that is able to produce energy and communication at a rate the same size as satellites that could be 5-6 times as big as ours. That's important because it's very expensive to send satellites into space. So the lighter they are, the less expensive it is to send them up and to replenish them at a later stage. Obviously, the satellites are going to work in constellations, something we've spoken about a lot of times. And this is our ultimate goal, is to make constellations of satellites into space, so that is going to be the backbone of the growth of the company. And obviously, when we send satellites up into space, and many satellites, we have to have an efficient way of running them, controlling them, and managing them. We all know the picture of the left, where you can see a lot of people in a control center running 1 or 2 satellites or things like that. That does not work in our environment. We are creating a software package where we are networking the satellites working together. You can say cloud in second order, where they're working together seamlessly, automatically, sending messages down to if there's any errors, or even repairing themselves in space. This is the kind of thing that we have made with our constellation management software in Luxembourg. The most important thing on the satellite is the data that it can create, and that is determined by the payload, and the payload is the instrument that can measure and communicate. We have been among the very first, if not the first, who could run tracking of airlines from a nanosatellite. We did that with GOMX-1, we did it with GOMX-3. We had very interesting data on the MH70, not at the time it fell down, but that kind of thing. We have done VHF studies with VHF radios from space for the Singapore Air Navigational Service Provider. And just recently, earlier this month on the 10th, we announced that we made an order of 150 million Swedish krona with the Spanish technology provider Indra, and they have now told what that is for, and that is for running building up air traffic management system on a global scale with ADS-B transponder on board, but also VHF on board. And the order we announced of the 3 in-orbit demonstration satellites is building that technology, and that is going to be delivered over the next 3 years. This is a major step for us, utilizing the capabilities we have, and also a major step to building the company to the next level. We have not won the constellation on this project. The constellation is largely going to be funded by Spanish government money, and that means that we will have our considerations how to position ourselves in the best way to do that, and that will give considerations about having how we can have work done in Spain as well. So this is, as I said, a major first step in the right direction. And it's also, you could say, proof on the way to proof of technology with one of the big advanced technology providers, not only new space startup companies, but for real business, for real demanding customers with very high demand of service quality. So this is a big step for us, and this is something that's going to give a lot of new employees in the company, expected to create future, even more future growth. Okay, enough about that. Now, when the satellite is made, we send them into space, and we do that with dedicated rockets for dedicated tracks, so that they can make the right coverage. The satellite can be at the right place at the right time in connection with each other. That requires precise launches of the satellites, and this is an example of a Rocket Lab's launch from the southern tip of a peninsula in New Zealand. It goes without saying that there's a lot of vibration, so the satellites have to be very rugged so that they can withstand that vibration when they are sent up. There's a lot of issues about insurances and quality and things like that, because the responsibility of the satellite is handed over to the customer when they are put at the tip of the satellite. Okay. The next thing is that once they are up, they are put into operation. And you can see that with this kind of satellite, this is the GOMX3 satellite actually. Once they are up, they have a very, very good breadth of view. They can see a lot of things. They can track every aircraft. They have free field of view in a lot of directions. And after that, the work on putting them into operation and running them is the key case for running the satellite operation. Okay, we are at the moment, and with this, we are taking a big step of maturing the nanosatellite business. And still we maintain to call it nanosatellite because we want to keep them as small as possible. 16U, 20U satellites is something that we will be working towards in this kind of configuration. Okay, next one. Why should you invest in GOMspace? First of all, you can invest in GOMspace because we're on a stock exchange. That's what that picture says. Enough about that now. We have a very strong executive team, a non-executive team at the GOMspace. Jens Måle, the former head of Therma, is the chairman of the board. He is very experienced in running this kind of technology. He knows everything about how to do that in detail, how to bring it, organize it, and all that kind of thing. And then I have a very, very talented young CFO. He was here right from the beginning, and he's been able to develop throughout this, and he's got a lot of more potential into the future as well. We have grown 19 times since 2013. And as I said, growth and growing the company is the #1 target. Obviously, we need to make sure we have the cash for it, and we do have the cash for it. But the growth is something that is very important because we need to capture market size, a market share in this kind of business. The order intake was officially was a little bit slow in the first quarter. But just outside the quarter, we closed the Unseen Lab order, and now we have closed the other order at 150. So we nearly doubled our order book within a month and a half. So that is going very well indeed. The next thing is the revenue. The first quarter was a little bit disappointed. It is usually in such a way that the revenue in the first quarter is lower than in the fourth quarter, even though we are growing. So it is like a sword-shaped growth that we always running. But it was also a little bit slower than expected. We some accruals that went into the fourth quarter instead of the first quarter that did some of it. The next thing is that we have problems or challenges like everybody else with advanced electronics components that have taken out some of the revenue on the high earnings runners of products. And we have had to rearrange the manufacturing. But we are maintaining the outlooks so there's nothing changed in our ambition for the company as such. The operating profit was, for the reason I just explained you, lower than expected, but we maintain our ambition. The net working capital goes back towards zero, but nevertheless, all of it is very good, and the cash position is good and solid as we expected. So with these small variations that I think you should anticipate in this kind of business where we are shaking it up with some big orders and so much work we're putting on, we are very satisfied with the progression. Okay, with that, I would show this picture here. Could be in your back garden, seeing a line of Starlink satellites coming across just shortly after they've sent up and before they've spread out in the total orbit. But these Starlink satellites, they are an example on how the new space business is now challenging the established service players. Inmarsat and others who have geostationary satellites that are not very good for running back and forth of internet because of the long distance and the long time it takes for the data to flow. You need to be closer to the Earth. So these Starlink will do that, but those service providers will also need to have a solution for those who are now starting to compete them and to compete against them. And that is something that we believe is going to give us an opportunity to be part of that future solution. So with that, I would like to thank you for your attention and will be ready for questions.
Thank you very much, Niels, for the very informative presentation. I do have two follow-up questions, if we could sort of begin with that. The first one is in regards to the Indra order, which you mentioned. You obviously won the demonstration part of it. Could you give some indication of how big the actual opportunities would be if you were to win, let's say, the actual constellation? And also perhaps just to give some more nuances to which sort of hurdles you had to overcome to win this order. I do know that you mentioned potential have some operation in Spain or know how to produce in Spain, or would there be any other hurdles that you would sort of be looking out for in order to be able to compete for this order? And the final question would be if you could give just a brief clarification of which aspects makes GOMspace competitive today when we look at new and also old space competitors. Thank you.
Yeah. First, regarding Indra, Indra themselves are pointing out in their press releases and in their communication that it's about 200 satellites that will be required for a constellation. The final number, whether that's 150 or 300, that's not decided yet. That's something that the technical solution will determine in the end. So that's one part of it. The other part of it is that it is a challenging project. Fortunately, we have tested most of this kind of things before, so we know how to do it. We know how to make this kind of satellites. So that's good. This is what I'm saying now is entirely from our perspective. Obviously, when Indra is or a customer is going to go out and buy a lot of satellites, they have to make sure that there's proper competition to have the right price. So it's fully understandable that they will be looking around to make sure that when they go into an acquisition process, they are pushing the situation the best possible. However, we have made the satellites. We will have made the satellites at that time. So that is also a good position. We have already now started our own work on positioning ourselves to be able to be the strongest possible when that time comes. So we will be fighting with everything we have to try to win that order when and hopefully when it comes about. We are in a business where we have to understand that we have to operate in other countries. So that's something that we must learn in any case. So that's how I look this situation.
Thank you, Niels.
With regard to the competing with the big service providers. It's actually a little bit the same as the same challenge as with this opportunity here, is that we have to raise the quality and reliability level that the nano satellites or new space is operating under. Excuse me, just a quick. If you take the Starlink satellite that Elon Musk sent up, about 20% of the satellite does not work because it's like or work properly. It's like pushing a lot of satellite up and then relying on the majority of the satellites is working. That's not how the established players is working. They want quality and reliability. And that's a transformation that we will be working on in GOMspace. So that maturing part of it, that's also what I was putting into the presentation, maturing the company with that. And that takes a lot of effort, and that takes a lot of work over the next period of time. But we also believe that doing that, making these small satellites available for the real professional world is a major opportunity. It's not a short term, it's a little bit longer term, it's a cumbersome process, but we believe it's going to be a major opportunity for the company and the one that will be standing best in the future.
Thank you very much, Niels, and thank you very much for being here today. Due to the time, we'll have to end the call here, but it was interesting as always to hear more about the case. Thank you. I hope you have a good day.
Thank you for letting me come. Bye-bye.
Good morning and welcome back to Introduce Investor Days. My name is Jesper Birch Jensen and I work as an equity research analyst here at ABG in Stockholm. And next up we have INVISIO, where the CEO Lars Højgaard Hansen will be presenting. So I think with that said, please go ahead, Lars.
Thank you very much. Welcome everyone to a short update on INVISIO. Next slide, please. So the headline I have chosen for this update is that INVISIO has recently unveiled the future of tactical communication. We have just announced a major update to our product portfolio, the core of our product portfolio, namely what we call control units. And I will get back to that in just a few minutes. Next slide, please. Before that, I'll just give a quick update on our latest financial report, where we had an increase in our revenue of about 23%, driven by our own internal growth, but also growth from an acquisition of Racal Acoustics that I will also touch upon a little more in detail. And revenue from the Racal Acoustics product line was about 20 million in February and March. We completed the acquisition end of January, so they are accounted for 2 months. We had a fairly good order intake in the first quarter, and that leaves us with also a quite strong order book at the end of the period. As we have said several times during the pandemic, we had not so much impact in the beginning of the pandemic, but as it has been prolonging, we have seen many of our customers working from home, not being able to perform and as usual, and not being able to start new activities, new programs, and so forth. Therefore, our revenue and order intake has mainly been from existing customers and also a variety of smaller orders. So with that and without large new programs, we are actually very pleased with what the situation is at this point in time with continued growth. Our gross margin is in line with the corresponding quarter last year. We are still confident that our gross margin over time is able to develop positively. And depreciation, amortization is increased in the quarter, and I would like that to be addressed. Talked about that on the next slide, please, Jesper. So what is new a little bit to us is that we have made our first acquisition, and with that we also have to depreciate the value of the company Racal Acoustics that we bought, and this is now visible in our first quarter and will continue to be visible going forward. So we will have a certain amount for depreciation. We have also in 2020 finalized a number of large development projects that we've been working on for several years, like the new platform of control units that I just talked about, but also our new intercom system. We had our first T7 over-ear headset also finalized. So all in all, that has led to that we, of course, now need to amortize on these development projects that has been finalized. So this is, just something that will appear in our books from now related to Racal Acoustics and new products. So next slide, please. Also just a slide that I normally show, just to remind everyone that INVISIO's business is fluctuating and will vary from quarter to quarter and even between years, because we work with customers that have long-term programs, and sometimes we get very large orders in one quarter and then somewhat less in the next quarter. So on the left-hand side here, you see our sales per quarter, but also sales rolling average for 12 months. And you can see we have on the blue line a positive development in our rolling sales. On the right-hand side, you can see a little bit of a mixed development, but lately you see a sort of a decline in our EBIT margin on a rolling basis, and that is related to investments that we have made in the organization, in the product portfolio, adding more people in R&D, adding more people in sales. So this is all related to investments in line with our strategy. Next, please, Jesper. So what happened early in Q1 was the acquisition of Racal Acoustics was completed. And for those of you not familiar with Racal Acoustics, this is a company with an almost 100-year history based in the UK. They have for many, many years been market leader for hearing protection and communication in high noise vehicles, military vehicles, around aircrafts, and really areas where you need a very specialized knowledge and experience for how to give people the best hearing protection and communication. And we have always felt that Racal Acoustics would be a good complement to the INVISIO portfolio. And when the opportunity came about in late 2020, we were, of course, very keen to acquire Racal, and this is a great fit for INVISIO going forward. At that point, we then also expanded our group management with the CEO of Racal, so he's now part of our management team. Next, please. So just prior to acquiring. Just as an information, an example of what Racal Acoustic does, just prior to us acquiring, they actually signed a large headset contract with the Danish Ministry of Defense, whereby the latest Racal Acoustics headset that you see on the right-hand side here, it's called the Magna 4000. This was chosen by the Danish Army to be their headset in vehicles for the next 7 years. And so Racal Acoustics won this contract with a value of up to $4.7 million. They have received some of the order value already and have delivered products to the Danish Army, but this will be an ongoing relationship over the next 7 years. So this is a very exciting portfolio, as I said, that will complement our portfolio of existing products very well. Next, please. So the way we will operate now going forward is that INVISIO is the group. This is our listed company, but we will have two very strong brand names to offer to the market. The INVISIO brand has since 15 years stood for soldier systems and portable intercom systems. It will continue to do so, where the Racal Acoustics brand is very well known for high noise applications like in vehicles, tracked vehicles, tanks, and so forth. And going forward, we will operate these two brands and product lines. Racal and the team in the UK of about 50 people will continue and to be the center of excellence for what we call high noise solution. And we think that this is going to give us a very strong combined position. After now 3 months of ownership, we can report that the integration between the two companies is going extremely well. It is really clear that we complement each other on all parameters, being it sales, being it R&D, and also in operations. We are able to find ways of cooperation that really benefits both brands. So this is so far a very happy marriage. Next, please. So apart from acquiring Racal Acoustics in the first quarter, we of course also, and after the quarter, we have seen continued business in the quarter. As I said, it was mainly smaller orders from existing customers that still gave us a fair order intake. After the quarter, we are now starting to see some more activities in the market. We can see, especially in the US, that customers are returning to their physical places of work, that certain activities are getting back to where they were before the pandemic. And the first result of that is that we received an order from an existing customer in the US for about 40 million Swedish kronor. So slowly but surely, we can see now that we are, after some delay, getting back to a more normal scenario for our business. Next, please. And in the middle of May, we normally have a very important trade show in Florida, US, which is not taking place this year. We would have announced and shown our new product at that trade fair, but given it's not taking place, we decided to do it digitally. And we have now unveiled our new series of control units, which are for the soldier in the field and which is the center for his intelligence towards communication and hearing protection. The control unit is placed on the chest and it has a connection to his headset with his hearing protection, and it also has a connection wireless to a remote control that can be put on a weapon or put on other parts of the body if you need to have the possibility to communicate differently. Next, please. So this is a totally new series of control units based on a platform that we have been developing over the past years. We have been taking a lot of input from existing customers based on our first generation platform. We have been listening to their feedback. We have been working closely with them to define what is it that you think you will benefit from going forward with the other new technologies that are in the market that you work with, like radios and intercom systems and so forth. So I will not go into all the technical features of our system, but it is a lot based on our core competences around audio. Some of the features are, for instance, just trying to remove as much unwanted noise as possible so that we remove some of the fatigue from the users so they don't have to listen to stuff that is making them tired or just annoying. We are removing everything that they don't want to hear, and we are making sure that they can hear what they need to hear, like their communication and also what is going on just in their surroundings. We have a new patented solution also around double hearing protection, where we can actually combine two of our headsets to deliver absolutely market-leading hearing protection, and where you can then still hear everything that is going on in the surroundings. So this is a new capability we are delivering to the market with a very high level of hearing protection. Everything we do is also made so that it's very simple. It's plug and play, and the user should not spend time thinking about setting up his system. He should be ready to go out of the box. And then, of course, we have also patented system around interfacing through our so-called INVISIO IntelliCable, and thereby we can connect to almost anything in the market seamlessly. All it takes is a cable, and then the system will adjust and set up so that the user can connect to anything: radio, intercom system, mobile phones, any other device that he needs to listen to. Next, please. So with this, the combination of our new platform for personal systems, our IntelliCable that connects everything, and by the way, the new Racal acoustics portfolio is now also being set up to work with INVISIO IntelliCable, so they will be part of the entire system. And then last but not least, we have our intercom system, which we have recently launched, and that is so far receiving fantastic reviews, and we've also received the first orders for it. So we expect the intercom system to be a significant part of our business and our total INVISIO Group revenues over the years to come. So with this, we have an absolute unique positioning, a unique portfolio in the industry. I cannot see anyone at this point in time that has a similar portfolio of products like we have for our markets, for military users and for law enforcement users. Next, please. So we have a well laid out strategy that we defined some years ago and that we have been executing very diligently. And we are going to continue to execute on that also in 2021. Some of the focus areas in 2021 is, of course, to make sure that the continued integration of Racal Acoustics is going according to plan, as it is. And then for our entire product portfolio to intensify our market penetration in existing markets. We still have a lot to do in our existing markets, in North America, in Europe, and also a high area of focus for us is the police and law enforcement, which we for the last 4 years have been putting increasing focus on. We are doing well. We can see that police customers in many countries are having the same needs as our military customers, and we have been successful in a number of countries already, including the Swedish police, where we have delivered a large amount of systems for the Swedish police. So police and law enforcement is a sort of prioritized area for us, also alongside our intercom and other product areas. Last but not least, we will continue to address selected countries in Asia, Middle East, and South America. This has been we were on a very good track before the pandemic, but the pandemic has put most of these activities on hold because it has been impossible to travel and meet customers in the region. So we expect as soon as things are now hopefully soon opening up slowly but surely. We will continue some of these successful activities that we have initiated in this region. This is a long-term activity and something that we also believe will be beneficial to INVISIO over time. Last slide, please. So, as I said, we believe that some of our activities with customers and larger projects and new activities has been on hold because of the pandemic. It has not been possible for our customers to conduct user trials and field tests and so forth, but it has only been on hold. It has not been forgotten. So as soon as people go back to their normal working conditions, we will also start to see a rise in activity level among our customers and a continuation of the global modernization trend for communication equipment and hearing protection. There's no doubt that the need for our type of products, hearing protection and communication in high noise, is still there, still very valid. So we have every reason to take a positive view of the continued good development of INVISIO. So with that, I conclude my presentation, and questions, please.
Thank you, Lars. And starting off, you touched upon this in the presentation. You also mentioned in your Q1 report that you saw the market in the US picking up towards the end of the quarter. Now you obviously recently announced a larger order in the size of 40 million SEK. Is this a result of what you've mentioned in the Q1 report, especially the US market?
Yes, absolutely. I would say, though, that it is slowly but surely going in the right direction. It is not like it is the ketchup is not out of the bottle yet, but we can slowly but surely see that things are starting to improve in many areas. Even in certain parts of Europe, we can see a higher activity level. So this is definitely positive, but it will, we will see a gradual positive development, hopefully up until the end of the year.
And is this throughout all your business segments, or is it mainly within the military or legacy segment?
No, it's similar. And I think that we can see that many of our customers, when the pandemic hit and many were forced to not be at work, they were not really set up to work from home. So many has not had the possibility from an IT structure and others to actually perform their work from home. So we've been trying to be very, innovative in ways of being in contact with customers and continuing. But again, many of our customers are doing this as a long-term modernization trend. There's no urgency, so therefore they have delayed certain activities for good reasons, and we can now see that hopefully it's starting to pick up again.
Thank you. And let's move on to your new product, the V-Series Generation 2. How should we view this product? Is it more of a complementary nature, or should we view it as replacing an older version?
I would say that it is an entirely new platform. I'm not really sure how to compare it with, because most people are used to getting new mobile phones every year. It doesn't go that fast in our industry. New platforms in our industry is maybe every 5 years or so. So this is an entirely new platform with a new engine inside the control unit, and it can do a lot of things. We will, of course, have a lot of customers that have already bought our first generation. They will continue with that. We will also have customers that think that the first generation is sufficient for them, but the second generation now is a totally new level. It is a real leap in technology that gives a lot of new flexibilities and competences and features so we can go now, of course, and sell it to new customers, but we can also go to existing customers and make them interested in upgrading to the next generation. So this is a platform that we will live with and benefit from over the next 5-6 years at least. So this is a really big step for us.
Thank you. You kind of touched upon my next question there, but in regards to which, if it's mainly your existing customer base, which you think would like to purchase this initially, or mainly new customers, but it kind of sounds like it's perhaps new customers or people who has not used the previous?
Yes, and it's also related to some newer needs that are appearing in certain areas. It can also be law enforcement. There are actually law enforcement customers there where some of the features we have in the next generation now are features that you also benefit from greatly if you are a law enforcement customer. So it has a lot of applications, and some of the features are so I would say innovative and secret that we don't want to reveal them for anyone except our customers. So I think there's a lot of good things in this platform that we can benefit from over the next year, and it's also optimized for working with our intercom platform, which came after generation 1. So now it is all technically optimized to work together in the best possible way.
Thank you. And just one follow-up question here. You touched upon the depreciation and amortization increasing somewhat in Q1, both due to the acquisition of Racal, but also due to new products. Should we expect it to rise perhaps a little bit more now that you launched this product? And I suspect you will begin amortizing it as well.
Yeah, I would say that the level we have seen in Q1 is probably the level we will see throughout the year. So it won't increase right now more than what we have seen already. This is related to the Racal acquisition predominantly, and then also to some. It is timing-wise, you can of course say it's a little unusual that we finalize 3 big development projects in the same year. And always, the development projects are always more expensive at the end because that's where you have external costs like testing and tooling and everything else that cost more than just our own internal R&D organization. So, but I think the level we have now is what you will see in 2021.
Thank you. I think we're running out of time here, so I would like to thank you, Lars, for joining us today and telling us more about INVISIO, and for everyone for tuning in.
Thank you. Always a pleasure.
Thank you.
Hi and welcome everyone to today's presentation of Flexion Mobile. My name is Stefan Knutsson. I'm an equity analyst here at ABG, and with me today I have the CFO of Flexion, Niklas Koresar. And without further ado, I leave the word to you, Niklas.
Anna, thanks a lot. Yeah, so if we bring up the presentation. So first of all, I just want to say I'm finally back in the office after a year in lockdown here in London. It's been quite a tough year, to be frank, but it's so nice to be here with you, have your colleagues and a bit of energy around you. Anyway, enough about me. Flexion Mobile, if we go to the next slide, please. So Flexion Mobile is the leading distribution platform for the alternative Android market. And that means that we are not building games. We're a service company to the mobile game sector. So we distribute third-party games to the market. We're a London-based company, 58 staff. We're the biggest portfolio of games and biggest channel offering on our market. I went to First North about 3 years ago. Our history is very important in the company. We always distributing games. We were world leading on the Nokia Ericsson time back in the days. But that's very important because that means that we already have the relationships and the technology know-how to move into smartphones, which we did in 2014. We're focusing on mobile, and within that market, we don't deliver games to Apple. We focus on Android. It's 85% of all devices. That's where the growth is. We don't distribute games into Google Play and not into China. So we focus what we call the alternative market. We've grown revenues a lot over the last years, and we're EBITDA neutral at the moment. Next slide, please. So why do we exist? So the game developers write 2 games files, one for Google, Apple. Everyone does the same. 3 million apps in each stores. Heavily overcrowded. Very hard to be seen. Very costly to be seen for developers in those stores. Basically, it's very hard for them to grow. At the same time, it's very cumbersome for them to reach out to new channels because the games are each games are basically its own live service at the moment. So some of them try alternative stores, but most of them kind of do it half-hearted and then they're back to the 2 big ones. So next slide, please. So there is a market problem here that we solved by since basically 2014, built a service offer where we take care about all steps needed for the distribution. So what we can go and say to a developer, hey guys, you have a file for Android, for Google. Send us that file. We convert it, do all the service steps, and send you back money. So it's a very, very powerful offering to the market. We're the only entity who has this offer on the market. There is an underlying tech here which is very important, and that is something basically started on early versions on back 10 years ago, and that is that we have an automated machine, effectively repackaging machine. So we can take that file that the game developer sends us and automatically repackages for the various stores. And without this one, you can't really scale in our industry, and we are the only people with that technology, and that's really the underlying driver why we are alone here. It's a patent. We have a patent in the US, as a patent pending in Europe. Next slide. So effectively, where are we on the market? Is that game developers at the moment have 2 distribution pipes, one to Google and Apple to come out to the game developer, to the gamers. And what we're saying is add Flexion as a 3rd pipe, and we take care about all remaining distribution here. So if you look on the next slide, please. So we are then working with the big stores, or new stores, alternative stores, and this is massive players. So it's Samsung, one store in Korea has 30% market share on Android. It's Amazon, Huawei, Xiaomi. So these are stores where we work very closely with in partnership with these channels. And why does the developer need, or why does the world need this alternative distribution? I think that's a very important question. And first of all, from the game developer's point of view, they're of course looking for new revenue stream. They need to grow, and it's hard to grow revenues in the existing stores. There is a lot of regulatory pressure on the 2 existing stores. They are controlling the market a lot. And all of us know about Epic versus Apple in the US. You also have, Google have big problems in the US on regulatory basis. Europe are fighting both of them. Russia, India, South Korea. So it's a lot of governmental pressure on the existing system. Another big factor is that the big developers are real takers on the 2 existing stores, and they want to differentiate, and they can do this in these new stores where they actually, they become a really big customer. So differentiation, increased bargaining power is important. And finally, the 2 westernized models work very well in certain markets, but in the wider Indian market, Southeast Asia market, it doesn't work at all. So there you need localized stores with localized payment solutions, localized languages, layouts, everything. So we do see a lot of new kind of specialized stores popping up, which is increasing the fragmentation on the market. Next slide, please. So why is it only us who can do this? And yes, we have technology, know-how, the history, but the important thing here is that it really is a chicken and egg solution. You can't build the technology without games and channels because you don't understand, you don't get enough exposure to be able to solve the problem, technical problem. You can't get the games without the technology and the channels, and you can't build your distribution power without games and technology. So it is a classical chicken and egg where you have to spend an awful lot of years to slowly build up your position in the market. So our history here is really, really important. And that is why we see you have newcomers coming and they have distribution or they have some kind of technology, but after 2 years, they're gone. And we see that again and again and again. So what we're doing here is building a lot of very high barriers of entry on our position on the markets. Next slide. So effectively we're going into this market and build our own ecosystem. We are the first. We have a very scalable model. We create the barriers of entry and we start to create network effects, where it's basically that the economic wheel is start turning by itself. So we want to take this market. Next slide, please. We have a very simple revenue share model. We put out a game in a store. Someone pays 100 money, and the store in our stores takes roughly 20%. So they pay out 80, Google and Apple is about 30, and then we have a soft target of 80-20 with the developer. So we would retain 16% as a gross profit in the company. We are at about 11-12% at the moment, so there is a little bit of growth still on the margin on the existing strategy. We also have a negative working capital model in the company, which means that the more we grow, the bigger the cash is. Basically, we take in the cash, hold it, and then pay it out, which is very attractive with me for CFO. Next slide, please. This is the stuff we're most proud of in the company. There's a say in our market, content is king. And, we are either the crown prince or already the king after this short time. So we are working with 19 games, and we're focusing on the top 800 games in the world. And put that in perspective, I think there is one game publisher in the whole world who publish themselves more than 19 games in the market. What is even more important is that we generate roughly run rate $30 million on these games at the moment. The universal revenue on these games, what make across all stores, is about $1.5 billion. So the upside on the existing portfolio is absolutely massive. And why shouldn't we take 10 or 20% of global revenues on these games? So that is 5-10 times what we currently own it, just on the existing games. So existing games, very, very important. Next slide, please. We have grown a lot in the company in terms of revenue. I think we're averaging 70% growth quarter on quarter in the company. We released the quarterly numbers here earlier this morning. And we released a Q4, which is down 4%. That is something we're very, very proud of, because we came into this quarter with 3 really, really strong quarters, and also the Q3, the December quarter, with all their November and December marketing and promotion events. And we have basically managed to maintain that level through an underlying growth in the company. So it looks really, really good. We also released, because we're in the audit now, so we're quite late with the quarterly reports. We also said that the April numbers are up 14% to the average run rate in December quarter. So it's continued to grow. And it's the existing games that goes. Next slide, please. This is my favorite slide as a CFO. We have a very linear relationship between growth in revenue and growth in gross margin and gross profit, at the same time as our cost base is very stable in the company. I don't think you see that many companies who's grown your staff with our growth, has grown your staff by 13 people over 2 years. We are adding 5 to 8 people per year in Flexion. In Flexion, you automate, you don't employ staff. So basically what happened here is, next slide, is that you start to see a pretty decent growth on your EBITDA in the company. So from being a kind of controlled negative growth, we start to be positive. And very, very proud that we managed to get a positive EBITDA for the full financial year, March to March here. That's good. Also comment on Q4, it's slightly down. It's the last quarter of the year. There's a little bit of audit adjustments, but we had some end of year performance payments to staff, but the big driver is FX, because both dollar versus sterling are playing a yo-yo at the moment. So we had over 100K in negative FX adjustments, which are kind of short-term volatility. Thank you. Next slide. Because we're entering a new financial year, we're given some guidance on the next year. We are seeing that on the existing service offer, which is organic growth or traffic in the company, we expect revenues to grow by somewhere on 40 to 60% on an annual basis. So a lot of growth. Next slide. Sorry, I just come one thing on the last slide, and that does not include the new initiatives in the company. I want to make that clear. So it's the existing organic traffic, but no new initiatives in the company. Of course, we haven't given a guidance on that. Next slide, please. Thanks. Staff cost, very boring. We grow by 5 to 8 people on the existing service offer organic growth. We've done it for a couple of years, so we're going to continue with that. Next slide. I want to comment a bit on the growth and the growth drivers in the company. And this is very important if you want to follow Flexion. If you look at the KPI section in our quarterly report for the last year, you see that the main driver in Flexion was that the top, what we call top tier games, the big games, grew by about 3 times in revenue over a year. And we also reached now that our top 3 games all make over $500,000 per month. So that is the key. And the way we had a bit of initial COVID effect, which we don't think are there, but we added a channel, which is Huawei, but we're also very closely with all channels, because these guys are investing a lot here to increase their own distribution power. So what we've done is that when you get the right IP, you can continue to work with these stores and also use that almost unlimited upside in these games to continue. So distribution of existing games is a key driver for us going forward. At the same time, we can add more titles in the company. Of course, here we're focusing, as we said, is on high-end games at the moment. The top tier games average about 10 times as much as the smaller games for us. So the key is to add on more quality games and content. It takes a little bit longer to get in, but the driver is going to be really, really strong. We will add mid-sized games also to the company, but we see that more to be for strategic reasons, for channels or developers or existing developers. So a little bit more selective on that side, but still add grow your distribution and grow your number of games in the company, and you get a very good multiple in total. Next slide. So just to wrap up, a quite narrow existing strategy, add more games, add more channels, and get better distribution of existing games. That's what we're doing. And that gives you a very, very strong growth opportunity. You get a diversified exposure on both game side and distribution side. So you get a more stabilized revenue. And I think we start to see that. And you also, what is really the painful thing with a platform is to come up to a level where you reach critical mass. And I think it's fair to say that we start to come up to that one now, because you see that the marginal cost in the company start to be quite low. And that is, of course, why we start to see movement in the EBITDA in the company. But on top of that, and this is what makes it so exciting to work in Flexion, we come up to this market position, and now we can start looking at basically paid traffic. And that is to expand the existing service offer and take it beyond where we are. And that is what we see in the market is a lot of new initiatives on monetize. And you have this within promotion, you have influencer marketing, you have data-driven marketing, you have hybrid distribution outside the classical store, direct consumer distribution, and you have the whole classical UA starting to come into our market. And all of this are things that would fit very well into our service offer, and especially for the bigger games. So what we're looking at now is that we raised 10 million pounds, 15 million pounds in cash in the company, is to look at what are we going to do in-house, what are we doing through partnerships, and what are we doing through M&A activities or acquisitions in the company. And I'm very pleased to say that we have recruited senior UA, user acquisition managers, to lead those activities in the companies. And we also hired a very experienced M&A corporate development team in the company to look at acquisitions in our field. So very, very, very exciting at the moment. So just to wrap stuff, can I say one more thing here also? That what we're doing on this is we're increasing the service offer and add scalability to the existing games. But when we add value, we can also start looking at the margin beyond those 16%, as I spoke about before. So we do see that if we succeed with this, we're both going to have a really, really strong revenue growth, but also look on the margin growth in the company beyond where we are at the moment. So just to wrap things up. Next slide. Biggest portfolio of games, biggest distribution power, massive opportunity. We're first mover, building barriers of entry. We have a very clear strategy, and we're growing a lot. So we've never been in a better position in Flexion than we are now. That's it. Thanks.
Thank you, Niklas, for the presentation. I will do a short Q&A to follow up. And as you mentioned, the report that you released this morning concludes a really strong year for Flexion as a company. Some might think that it is because it has been boosted by COVID effects, but yet you guide for revenue growth of 40 to 60% next year. What will you say will be the key driver for this growth going into the next year?
First of all, this is only the organic traffic. This is not this new opportunities. We exclude anything from the UA team or the corporate development team in this guidance. So if we get that right, we see higher numbers for sure. But it is the power of the IP we have, of the games we have. The upside here is if we get this right, there's unlimited upside in these games. And that is what we see. There's so many different ways we can grow with our corporations, with the channels, and then add new channels, add new games. So it's just to continue to grow as is. It's just executing on the existing strategy, really.
So despite that you mentioned that the top tier games has gained a lot of revenue per game for you, you see potential to increase that further going forward?
We are still a couple of percent of the total universal revenue. Why shouldn't we be 10-20% of that? Just need to continue working hard.
Perfect. And another thing that you can do to grow revenue is, of course, to add new games to the portfolio. I'm curious about your relationship with the customers that you have on board right now. I mean, they can release new games. Do you think that is the easiest way to add the games to your portfolio, or do you put equal amount of time to pursue also other game developers?
So suppose on the existing game, so we start to come up on numbers on the game. We're making $6 million per year, and they are we start to they start to talk about us properly in the organizations, and when they have new games coming up or other games, look, this guy's actually performing. Should we look at this game and this game? And these are big developers with a lot of games. So yes, definitely more existing. But we also said in the report that we have a very small new sales team at the moment, and we want to add more power in that, especially on the localized market. So we will invest in more sales to get in more sophisticated sales also. We just started. We're very new, so it's on the sales. So it's to increase the sale power to also get in, but focus on quality and not quantity.
Okay, perfect. And despite the success that you're telling us about today, I think you're a bit behind your expectations on launching new games to the portfolio. Can you just mention briefly what has caused this delay and how you're working to fix the issue?
Yeah, it's been a bit slow, and we're working hard on it. It's been externals. It's nothing dramatic. Small external factors, internal delays. We are also some of the games maybe we shouldn't have done, looked at. So we are looking at how to improve our selection of games. We are going to ramp up a bit on our own delivery capabilities, add a little bit more power into that. But it's nothing dramatic. It's just to get it moving a bit better. And we are saying we are starting to release games now. We said that in the quarterly report. So 2 games are coming out very, very quickly. So we are getting there.
Perfect. And based on the guidance that you gave this morning about the growth and also about the addition of staff, it seems to me that there is a possibility to strengthen EBITDA margins going into the next year. I'm just curious to hear your thoughts on that, and also on how investors should view the long-term gross margin development.
Yeah, but we have an existing offer where, as we said, we can grow the margin on that one a bit. But the big opportunity on the margin play is beyond, to strengthen the service offer and go into paid traffic. Because at the moment, all we do is kind of almost free traffic for us, what we generate. If we can go into that paid traffic, we increase our service offer and the value of the service, or we can then start working much more on the margin play. So at the current organic, it very much is a revenue play. Get the games, get the distribution, get our position on the market, and from then add on services to the company.
Beautiful. And just if we zoom out to have the last question here, and if I would summarize as an analyst, I would say that 2019 was a year of adding very promising titles to your portfolio. 2020 was a year of increasing your distribution power with new channels. I'm just curious, what are you most excited about for 2021?
It's to add top quality. It's to grow the existing games, take them to another level, add top quality games to the portfolio, and then what we're looking at is to increase the service offer, with this M&A activities and UA activities. We have taken in cash, and we will start to deploy that, and that's going to take this to completely different level. And also, all those services are then driving the existing games. So It's important for us to have these games that are receptive for this increased service offer in the company.
Okay, by that I would like to conclude the presentation. Thank you very much for having you, Niklas, here today.
Thanks a lot. Thanks for that.
Hi and welcome everyone to today's presentation of Prevas. My name is Stefan Knutsson. I'm an equity analyst covering the service sector here at ABG Sundal Collier. And with me today I have the CEO of Prevas, Johan Strid. Welcome, Johan.
Thank you. I'm Johan Strid. I'm the CEO of Prevas. I've been around in the company for about 3 years now. It's 3 years in August. Before presenting Prevas, it might be polite if I present my background just a little bit. I've been in the consultancy industry for about 20 years. I've been a consultant manager, managing director, salesperson, sales director, and a business area manager in about 5 different consultancy firms the past 20 years. Before that, I was at Ericsson working as a product manager, among other things. And as such, I bought consultants and projects. So it was a good experience working on the customer side before moving over to the consultancy side. That's me, very briefly. But moving over to Prevas, the main focus, of course, we are a consultancy firm. We're working with products and production development. This is an example of a customer of ours, the Hövding helmet. It's an inflatable bicycle helmet. It's quite complex. We're helping out with the mechanics and electronics for this customer. And we're doing that in such a way so it's possible to produce in a cost-efficient way. So just an example of what we do. But before going into details into Prevas, it could be smart to look at the environment around us, to look at some trends and the context. So thank you. There's a few trends to keep track of. So if we take the next slide, here are a few of the trends that are affecting us as individuals, affecting Prevas, affecting our customers and our customers as well. And there are different type of aspects. There are some mega trends regarding globalization, for example, or demography. We're getting more people, we're getting richer, we're getting both healthier and sicker, depending on the perspective that we have. There are some aspects regarding sustainability, climate changes, and so on. And there are also some financial trends that affects us all, maybe more than we think of in our everyday business, with the 0 interest rates, for example, and the gig economy or a circle economy. So there are a lot of other trends that is affecting also Prevas and our customers. And of course, there are some technical trends that are quite disruptive. Artificial intelligence, 3D printing, and so on. And today it's possible to do really cool things with small means. So you don't need huge amount of developers or consultants. You can try a complex idea, test out the viability of that idea, and then take the next step and the next step, and then scale it up with a cloud solution, for example. So there's a lot of possibilities. But it's also another side with security, integrity, surveillance. You can be afraid of the Skynet, for example, and so on. But at Prevas, we have a positive attitude. So if we take the next slide, this is our slogan, Hello Possibility. We really think there's a lot of possibilities in the technical trends to do good with technology, and that is our passion. And actually, our passion is so big, so it's our vision. So if we take the next slide, ingenuity will save the world. Being creative, being innovative, working as engineers, that will save the world. So there's a lot of possibilities to do good things with technology. And you might argue that we don't have to or need to save the world. Hopefully that's true, but we can always make it better, and that's our passion. And today it's really complex. So if we take the next slide, please. This is our mission. And maybe it's not humble, but we think that we are really the best at some certain technologies, but it's not enough. you need to understand the context and what you contribute into the environment. So it's important to co-create solutions. So our mission is to co-create technological advancement for the betterment of all people, planet, and profit. So we work very closely with the customers. Maybe they provide their special competence and we provide our special competence. And we're working with partners and sometimes also with competitors in order to do really innovative solutions. And of course, it's about making a profit for the customers, increasing revenue, decreasing costs, or being more efficient or something like that. But at the same time, we can have the perspective of doing good things for the planet and for people at the same time. So if you take the next slide, please. Here are a few brief facts regarding Prevas. We've been around for 35 years. We are noted on Stockholm Exchange Market on a small cap. We are about 800 employees, most of them in Sweden and then Denmark and Norway. We have 21 offices, so we're quite close to the customers. We quite often have long-term relationships and being close to the customers, both by proximity but also by heart. And we're working with both turnkey projects and providing professional services regarding product development and production development. Next slide, please. So if we look a little bit deeper into product development, it's quite often a physical product and a complete product. The Hövding helmet is a good example. And we understand and work with the whole process from an idea, design, development, test and verification, maybe certification, and industrialization. And we have actually been a part of or having responsibility for over 8,000 products during the years. So we understand the pitfalls in the later phases in a product development process. And that means we can provide lots of good advice in the earlier phases. And we're working with startups, for example, and also larger companies. So quite often a complete product and a physical product. And we are at our best if it's an advanced and complex product. This is an example of a medical device, a medical instrument, where we test for sepsis. It's a brand new product. It's really, really complex. Before, if you tested for sepsis, it took 3 or even 4 days before you got the analysis ready. By this instrument, we're reducing that time to only 2 to 4 hours, and you can test a lot of samples at the same time. So that will change the testing for sepsis dramatically, and it will save a lot of lives. And this is a really good example where we take on the responsibility for the whole product, while the customer, Gradient Tech in Uppsala, in this case, are providing their medical expertise and how to test things and so on. So we're combining the customer's expertise with ours and making a really, really great product. And quite often the products are connected, so we're working with Internet of Things, and we understand the whole change from sensor to the embedded technology to providing the data up to the cloud and making analysis and seeing trends and so on. So complex products, advanced and connected. That is a typical product development. And this product should be manufactured as well. So we're working with production development. So next slide, please. And we're working a lot with the industry, mainly in Scandinavia. And it's about automation and digitalization of the industry. There's a lot of things to do. And we are quite technical, so we are starting from the floor and working with the technology. So we are designing a single cell for a customer, and a cell is a specific step in the process where you produce something. So we are customizing a robot, in this case from ABB, to do a specific task. Then you're combining that to a whole process and a production change, where we have the manufacturing or management systems as well, and systems for internal logistics to really be efficient and flexible. So automating the industry and also digitalizing it. There's a lot of systems industry from the 19th or even the 80s that are really old. So we're providing user experience expertise, for example, and providing a much more efficient and modern working environment for the people working in the industry. And we think we understand manufacturing as a company fairly good. So we have a holistic view on things and also a sustainable view on things, of course. We have solutions where we reduce energy consumption. We have a specific product for that that is owned by Prevas, that is reducing the energy consumption in steel industry. And about 90% of the steel mills in Sweden have that, and now we're starting to exporting that to the rest of Europe. So making the industry more sustainable is also an important aspect. The next slide, please. Here are some internal stuff that I would like to mention briefly. Up to the left is our organization. The point is not to go through the organization, but I want to show that it's simple. We have 11 regions. We have decentralized organization. Each region is responsible for its own profit and so on. But more important is the cloud down there to the left. This is how we view our organization. We are a network of 800 people and about 34 different business units, where each unit is focusing on a spearhead offering. And then we're combining the different units and the different people in a very dynamic way. So that's our way of thinking. And we're both a whale and a dolphin. Maybe a whale is a little bit too much when you're on small cap, but we have a turnover over 1 billion Swedish crowns. We've been around for 35 years. We're a safe choice both for employees and for customers. And at the same time, we are dolphins. We're playful, we are fast, we're agile. And of course, we have some control and planning, but that's not the important part. We are really active, trying new things, doing experiments and testing new technologies and so on. And up to the right, it's a small robot that we've done on spare time. So we are nerds and we're proud of it. So a lot of the colleagues are really interested in technology and doing things on the spare time. This is an example of a robot that the colleagues have done in Copenhagen. It has an artificial intelligence, a battery optimization, and so on. But we don't only do it for fun, since we are building an infrastructure all along. So that's the last picture there on the right side. That's a picture from our EMC lab in Stockholm. So we're building modules, frameworks, reusable components. We have laboratories, instruments, and so on. So we're trying to build an infrastructure that we can reuse on behalf of the customers. So we're building a value on top of the hours that we provide. And that's really interesting also for the employees. It's fun, it's challenging, and it's a great value for the customers. It's a reason for choosing us as a partner, and we provide more value from start in the assignments. So we're building that in a very structured way to reuse it. That was a few aspects from the internal aspects at Prevas. If we take the next slide, please. I want to just provide a perspective regarding our history, where we are right now and what we are aiming for. So if we take the next slide. Before we had some performance problems in the company. We actually lost money and we had a really bad performance in about 10 years or so. And 2018, we decided we must try something new. So we initiated a change program that was quite a lot of different aspects. So we changed the organization, we changed the sales process, the management process, we simplified things, we reduced overhead, and we changed a lot of things. But we kept the good parts, the customer relationships, the technical stuff, and so on. And by doing that, the good combination led to a much higher profit. So we increased the profit in 2019. And we also invested in our image, our brand, which is really crucial for recruitment, for example. And then last year, we had the COVID situation, not specific for Prevas, of course. It affected the whole world. But I think we pulled through really good. So we increased the profit also last year. And we continue the path with a decentralized organization and focus on building value and being the best. And going forward, the strategy is to continue with the same approach, building value, being centralized, keeping things simple, and so on. But now we're adding also growth. And if we take the next slide, we did that a lot starting this year. So we merged with 3 different companies at the same time. They had the same owner, Awardit. And it was Filo Process, Tritech, and Deva Mechanize. And we prepared that last year, and we started the 1st of January or the 4th of January this year. And that meant we grew with 250 colleagues overnight, mainly in Stockholm, in Västerås, but also in Linköping and Gothenburg. And the nice part here with the preparation in the end of 18 and 19 was to changing the organization so it's easier to welcome new colleagues and new nodes in the network. So we view these companies as new nodes. We will have a single brand policy, but the idea is not to change everything, but rather keep the good things with these companies and these colleagues. And this has strengthened our product development capabilities and production capabilities as well. And we had some really good feedback from customers and potential customers, and also employees and recruitment candidates. So that's been a lot of the focus ending last year preparing for this merger. And we're doing the merger right now, and it's going pretty good. So next slide, please. We had a flying start this year. The first quarter was a record. We increased the revenue, the profit, the earnings per share, and so on. So I think we are in a really good trend. And the idea is to keep that going. We have a margin a little bit over 10%, which is okay in the consultancy business, and use that position to also grow, both organically and acquired growth. So if we take the next slide, this is the way forward. Keep it simple, continue with the good parts, as mentioned, building value, building the brand, keeping things simple, and also add growth. And we're not in a hurry. So we're looking at new colleagues or new companies who wants to join Prevas, who likes the vision and the way of thinking, the way of working, and the network approach. So when we find a new spearheaded company that is fitting into our strategy, then we will move forward. But we're not in a hurry, but there's a lot of candidates, so I hope we can manage to grow in that way as well. And the last slide, going back to the possibilities, there are a lot of things happening with the trends affecting all of us, and we see a huge potential also for Prevas that using the disruptive ideas and the possibilities that these trends bring and going forward in the future. That was very briefly about me, and mostly about Prevas, our history, and how we think, and a little bit about our way forward. So thanks a lot for listening.
Thank you, Johan, for the presentation. I will just do a short Q&A. I must say what I witnessed in the presentation is that you have performed a quite impressive turnaround. Now you're talking more about growth. I just wonder, have you set any financial targets or ambitions going forward?
Yeah, that's a good question. We have an official target regarding the margin. It's 8 to 10%, and now we're above that. We haven't communicated any goal regarding growth, but I think it's healthy to grow, and it's more important to grow in the right quality and rather than the right amount. So we haven't communicated any financial goals regarding that.
And you also mentioned that you're strong within product development and production development, but my view as an analyst is that maybe traditionally you have sort of put Prevas as a industry consultant or technology consultant, but what we're seeing with increased digitalization is that maybe like the market picture of what is an IT consultant and what is a technology consultant is somewhat merging. Do you agree with this view?
Yeah, absolutely. I agree fully. And my personal background is more at IT consultancy firms as Knowit and Cybercom and so on. So that's my personal background. And maybe it wasn't just by chance I started at Prevas. So I think that these worlds are merging, and there's a lot of potential in that as well.
And you talk a lot about megatrends and other disruptive technologies. That is possibilities for Prevas in the future. I know that some of these trends and technologies has rather high growth assumptions forecasted going forward. Is that also what you see for Prevas, that you can increase your organic growth in the coming years?
Yeah, absolutely. I think the trends are in our favor, and the demand is huge. The toughest part is to grow and grow organically. And I think both Prevas and all consultancy firms have focus on that. So that will be our main focus. That's where the challenge is, to keep up with the big demand.
And I'm also curious about, you mentioned that you have a long-term relationship with your customers, but if we look at the income side, is it mostly project related, or do you have some sort of income that is more recurring in terms?
Yeah, we have some recurring revenues as well. For example, we're working with support and maintenance. When we provide a solution for a factory, for example, if the factory goes down, it's a huge effect on the customer. So they are buying an insurance, so to speak. So we have support and maintenance and monthly fees just being ready to support them, for example. We also have some products or semi-products of our own where we charge license fees, and we have some software as a service deliverables as well. So we're moving in that direction to increase recurrent revenues and other revenue streams than just ours.
Perfect. And I also would like to know a bit more about how does your current exposure look like in terms of end markets, and is there a specific end market that is growing faster than others, so to say?
Yeah, our biggest industry is the medtech industry. It's almost 25% of our revenue. So that's a huge focus, and it's a really interesting area. And it's also a good area to attract recruitment candidates doing good things for humans and people. So that's the biggest area, and the trend is really positive in that area. And otherwise, it's manufacturing, for example, and there's also a good trend in that area regarding sustainability and the need for modernize manufacturing and having a more flexible manufacturing approach in Scandinavia, for example. So I think there are many different trends that are in favor. We're also working with telecom and defense, and they have been really stable the past year. So that's been really good. So we have a diversity of different industries and a really good mix, I think.
And also you mentioned COVID. Obviously, everyone has been affected, but you maintained to or you sort of increased your EBIT results, maybe because of the exposure towards life science. But I'm more curious about how you view the business recovery here in the second quarter. What you've seen so far?
Yeah, I almost said it's like COVID never existed, and the market is really busy. I think everyone is positioning for growth and for a positive future. So we have a huge demand from all type of customers. You mentioned life science, and actually that was a little bit tricky last year, since a lot of hospitals and so on, they focused only on COVID. So some of the life science customers had some challenges actually, but we're building up a depth in the world. So there will be a lot of demand regarding life sciences in the coming years. So that is increasing dramatically fast right now.
Perfect. And lastly, I would just like to ask you about, we saw that you did a rather big acquisition in the beginning of the year, adding 250 people. Is that like part of what you want to do going forward as well, to have an M&A agenda to strengthen the Prevas Group?
Yeah, we want to grow in 3 different directions, actually, both regarding geography. We want to grow a little bit strongholds in Norway, for example. But the most important focus is to find really spearheaded companies, and they don't have to be large. So the focus is their offerings and their capabilities. So we want to have new nodes that are really, really good. And sometimes they are big and sometimes they are small. Perfect.
By that, I would like to thank you very much, Johan, for coming and presenting with us today, and also to all of you listening in to the presentation.
Thank you.
Good afternoon and welcome back to Introduce Investor Day at ABG. My name is Jesper Birch Jensen and I work as an equity research analyst here at ABG. And the next company that we have for you today is G5 Entertainment, where we have the CFO of the company, Stefan Wikstrand, here to present. So I think with that said, please go ahead, Stefan.
Thank you very much, Jesper. And thanks for having us. Again, it's a fantastic tradition to come back to this event. We can skip to the next slide. I think this doesn't tell you that much, but this does. So to start from the beginning, so G5, we're a developer and publisher of casual free-to-play games. So usually puzzle games. They are targeted to a wide range of kind of family-friendly, wide range of players, but the target audience that we focus on is females over 35, which is a target audience that we've been working with since, well, essentially going into this type of game in 2009. So a core focus for the company over the years. So we operate in the mobile gaming space primarily. That is a quite large market today. It's a 70+ billion market and continuously growing. We operate through 7 offices worldwide. So I'm based in Stockholm. Our CEO is based in San Francisco, and we have an office in Malta. And then we have 4 offices in Ukraine and Russia, so 2 in each country, where we have the majority of the staff. And that is where our development is done. So we have roughly 750 people in Russia and Ukraine. So you have the revenue chart there on the right-hand side, which shows the development we've had since doing kind of moving into the mobile gaming space and doing these casual games. In 2013, just to point out some highlights, we pivoted over the business totally to the free-to-play games. So today we're a pure free-to-play game company. 2013 was also the year when Secret Society, our first biggest hit, was exited soft launch and started growing. And Secret Society has since then made over 130 million USD in lifetime revenue and 30 million downloads. In 2016, we had Hidden City started growing after it was released in 2014. And that game grew very aggressively up until 2018. And currently it has generated over 330 million USD and 70 million downloads, and it continues to be our biggest game in the portfolio as well. The company's been around for 20 years, so we celebrate our 20th anniversary today, or this year. And also we've been listed in Sweden since 2006, so that is 15 years, and we moved up to the regulated market in 2014. So we can move to the next slide just to look at the market that we primarily target. So as I said, mobile gaming market has been a fast-growing market over the years, obviously, given that it's a fairly new market, and it continues to be the fastest-growing segment of the gaming market. And the growth rates have come down a bit, but we still look at 10% growth over the coming years. And we also see an increasing in users and gamers that play on mobile devices. So that is expected to grow as well. So even though that growth is quite heavy, you can see that Asia is now the biggest market for mobile gaming. It is more than 50% of the revenue. And you have a lot of players there, but maybe they spend a bit less. Our focus is, well, the entire globe essentially, but our core market is North America, where we have always been the strongest. So North America is 60% of our revenue currently. Europe is 22%. Asia has dropped off a bit and is 12%. And here it is primarily Japan and South Korea, where China, being a very regulated market, we don't have any business of significance currently. And then we have the rest of the world as well, constituting 6% of revenue. I think we can skip to the next slide. So we target our market, as I said, primarily females over 35. That is also, it is the target audience. It is the audience that we have. We have, roughly speaking, 70% of our users being over 35 and 70% being female. It is a growing demographic that has served us really well. It might not be as underserved as it was historically, so more and more companies realize that this is a very good target audience to work towards. So that is slowly fading out, but we have amassed a lot of knowledge in targeting this audience, and we see that there's still things to do there, obviously. The audience is good, it's a very loyal audience, so when they start playing the games, they tend to stay for months and quarters and not fairly often as well years. So they stay with the game for a long period of time, and they also are a very strong paying audience. And we focus on the audience with 5 categories of games. It is the 3 top ones that matter, so to speak, or are the main ones. So our biggest genre is the hidden object games. Hidden object games is a bit of a distinct genre in the sense that it's not super big. We are a few players, so it's not super competitive either. So we are 4 or 5 companies that essentially make up the hidden object market, but a very good market to be in. People that likes playing hidden object games, they come back to this type of game. And there's definitely room to grow and this subset of the market as well. If you have a successful title, you usually find a new audience and that comes in and plays the games. Here it is represented by our game Sherlock, which is our latest hidden object release, which is doing quite well currently. It was released in Q4 or late Q3 to be totally accurate. Our biggest game in hidden object is still Hidden City, which is also our biggest game, so it kind of falls naturally. And the second category here is the match 3 games. Match 3 games is a much bigger segment of the market. It's likely one of the biggest in mobile gaming. It is here represented by Jewels of Rome. So being a bigger market, it's a lot more competitive, but also people know what a match 3 game is. So it's easier to attract in some aspects. It's easier to attract an audience that really likes match 3 games, and just taking a smaller part of the match 3 segment would mean a lot for the company as well. So we've had some really good success in the last years, primarily with Jewels of Rome, but also other our match 3 games. Thirdly, we have the Mahjong or the match 2 category of games, which has been with the company for many years, longer than mobile gaming. So it's what we consider an evergreen genre. People that like playing Mahjong games, they continue playing them for forever. It's very casual, soothing gaming experience, and once again, the people that start playing Mahjong games, they usually play them for years. So very good. It has a bit of a difference in terms of KPIs. If you look between 3 genres, where Mahjong might be the weakest, but still, it's a very good genre to be in. And as I said, we've operated this for many years as well. Then we have 2 categories in the bottom. We have the word games and the blast games, which both are kind of more early entrants in the genre mix for us. The word game was released late in 2019, and the blast game was released in Q1. So still doing tests on these and figuring out the mechanics and working on the genre, so to speak. So only 1 game in each of these categories and fairly new to the company. All of the games that we have are tied together with a social network called G5 Friends Network. So the G5 Friends Network gives the players the opportunity to store their progress, and they can play on cross-device. So they can play on multiple devices. They can play on an iPhone on the way home, an Android tablet, and you can switch to web or PC when you get home. So it's very, very good for the users. Obviously, as I said, storing their progress as well. If they lose their device, they also build friends in the social network and kind of help each other forward in the game. That gives us as well some opportunity. Well, it increases loyalty from the users, and they also get prompted. For example, when one of their friends start playing another game of ours, they will be prompted that their friends start playing other games. So it helps us with cross-selling. It also, the social network also gives us further tools to kind of work with cross-selling and kind of maintaining and working with the audience, because it is, in the end, it is the audience that makes up what we do, and serving them with good content and retaining them over time. So we can skip to the next slide. So, well, G5 operates with a portfolio approach of games. So we always have plenty of games and release quite a few every year. As you can see here on the right hand side on the chart there, you can see the development since 2016. From the top, you have the dark blue bar, which is the licensed games. So primarily Hidden City. Today, you have the yellow, which is our own games. So games developed and published by G5, but are a bit older. And then we have the orange bars, that is a new generation of games, which is defined as games that are released from 2019 Q2 and onwards. And I will take a few minutes to describe why we make that distinction. So in 2016, and especially from 17 up until, well, you could say 19, we worked really hard with changing or not changing the development teams, but enhancing. And so we expanded the teams, we hired more teams so we can run more games simultaneously, and did a lot of work taking home games that were where we had outsourced development, for example. And these were very busy years, setting new structures in place and processes. So in 2018, we only had one release, and usually before that, we usually had 2 to 4 games per year that we released. So 2000 was a bit of a gap year due to the investments and all the work done in development. And then in 2019, we started to release games on the back of the investments made. And we got a bit of a catch-up effect there as well. And so from 19 to Q2, that's why we distinguish them as new gen, as they're based on the investments made. But we also released quite a few games since then. So in 19, we released 5 games, which is then starting to build up the revenue that you can see there. And then in 2020, we released an additional 8 games. So in total, 13 games that belong to this kind of new generation of games. And then we also have released already 2 games this year. So the pace has definitely increased on the back of the investments made as well. And the gray line you can see on the chart is the share of revenue coming from own games, which is an important KPI to look at, as a higher share of revenue from own games will improve the gross margin for the business, and thereby also the margin potential that we can achieve. So that number has gone up drastically over the last 2 years, and now is 63% of revenue, and is continuing to growing based on the successes of the new generation of games. In the bottom, you can see the constitution of the portfolio a bit as well. So harvest mode games are games that we don't retain a development team, so they're older games that collect money in the stores. We have active games and we have in development. Numbers are a bit skewed just because in development also includes games in soft launch, so it should actually be a bit more games in active, but it at least gives you a bit of a feeling on how it looks. And let's skip to the next slide then, please. So coming back to the kind of life cycle of a free-to-play game, that is important to understand. So the life cycle of a game, you know, if we take Hidden City, for example, that is represented in the long tail revenue category there. So Hidden City was initially released 2014. In the long tail revenue, we also have Secret Society that was initially released in 2012. So the time frame that we're looking at here is quite long. It isn't highlighted here, but you know, it's because it's hard to say for how many years a game can live, but the long tail revenue, or the longevity of the lifetime of a mobile game, is probably underestimated a bit in the market. So if we start from the beginning, you know, we take an idea to the market. It takes usually 9 to 18 months to get the game in production and getting it to the market. And then you release it, you see how it works with the audience, you collect KPIs, you make changes to the game. In this kind of soft launch period, eventually, hopefully, you will figure it out and the KPIs look good and you can start market the game. which is then the scaling process that you can see where the kind of red line starts moving upwards. Eventually, at some point, the game will reach a peak where it's tough to market a game, either because there are other games in the market, so competition-wise, or you have served so many ads that you have a tough time finding an audience, or whatever reason it would be. But it reaches a peak. Usually you see a churn in revenue after that as you adjust the marketing strategy on the game. And you can see the dotted line here, which is the user acquisition, which is then, you know, taking a smaller share of revenue when you reach kind of peak revenue and also in the long tail revenue phase. And so you see a churn of users based on the change in strategy for user acquisition. Then the revenue stabilizes and is usually, you know, very stable and very healthy. And in this part of the life cycle of the game as well, you see the majority of the profits from the game as user acquisition or marketing is optimized, and on a lower level, kind of optimizing the user base, keeping as much revenue as possible, and just maintaining that revenue level. So after long tail revenue, you also have some games that, you know, the revenue stream that we get from the games doesn't justify the fact that we have development team attached to the game, because in long tail we still have a development team. They send out monthly releases to kind of, you know, give as much content and stuff to play for the users. When it comes to the harvest mode games, the revenue stream that we get from the game doesn't justify having either marketing or very limited marketing or a development team. And then it's, you know, it's very profitable, but usually on a lower revenue level. And the games essentially sit on the stores and just collect long tail revenue. Okay, let's move on to the next. So a bit of the last quarter highlights that we achieved. So we've had a very good, strong year in 2020, and we continue that in Q1. So in Q1, we saw a top line growth in USD terms of 22% year over year. And why we measure this in USD is because of what I said before. So North America is our biggest market at 60% of revenue. I think Sweden is roughly 0.4% of our revenue, but we have to report in SEK. So the numbers get a bit distorted. So, you know, the SEK growth is 5%, which is still okay, but underlying the growth momentum was much better. EBIT was almost 60 million, and the EBIT margin was over 18%, which is very strong. And we've seen a shift here during the last year where the EBIT margins have come up quite significantly on the back of the revenue from own games, both the fact that the business that we operate is very scalable. So if you add on revenue, you don't need to add on cost. So very scalable business. We've done a lot of work within user acquisition and optimizing that over the years, and that has really shown through in the EBIT margins, and user acquisition as a percentage of revenue has come down quite significantly from earlier years. So from the start of 2020, we had, Q1 last year, we had 22% of revenue in user acquisition. Q1 this year was 70%, so on the lower end, but still, you know, all of these numbers from Q1 last year up until Q1 this year and the quarters in between show that we were much more effective in the user acquisition. So, you know, if you break down the revenue growth a bit, so I said 22% in USD terms, the own games grew 68%, and the new generation of games almost grew 200% in Q1. So we are growing growing the business and you know, growing with these new generation of games that we have released. Also, the audience metrics have had a positive development where the monthly active users have gone up, and also the average spend per user has gone up 25% year over year, which is a lot, and is now the average spend per paying user is now 63.5 USD, which is a very strong number. Let's skip to the next one. I see the time is my enemy today, but I think we've covered a lot on the revenue side during the presentation. Also, EBIT, once again reinforcing that you know, the scalability of the business, getting growth in the own games expands the gross margin, but also all the work that we put into user acquisition has really shifted the scales in our favor in terms of profitability. So you can see the red in the middle chart there, the red bar, which indicates EBIT has been very consistent and growing over 2020 and into 2021. We also have a very strong cash position which has grown over 20 and 21 as we convert cash really well from the EBIT that we generate. Even though we have added cash here, as you can see, but we've also repurchased a lot of shares and paid dividend to our shareholders. So without those, it would look even better. So in Q1 specifically, we bought shares for 34 million, but over the last year, we've almost bought shares for 100 million SEK. So that impacts that quite drastically. But we still end on a record cash position of 214 million SEK. And yes, let's move on to the last slide. So just a quick few words on 2021. So, we expect the growth of the new generation of games to continue and continue the trend that we've seen. We will continue to release more games. So we released 2, as I said. One is a licensed game that was just released 1 or 2 weeks ago. But we have 4 more games to release during the year. We will continue to optimize the user acquisition efforts and the tools that we use for that. And the G5 store, together with advertising, which is we're quite proud of, exceeded 1% of net sales in the quarter and continues to grow month on month. So very positive there because we don't pay any store fees on those revenues, so the profitability is much higher. And also finally, we have that little thing that Microsoft has reduced their store fees. So effective August 1st, they will lower their store fees from the customary 30% to only 12% going forward. And that will have a significant effect on the company's profitability. That went quick, but now I think I'm done, Jesper. Almost 20 minutes.
Thank you, Stefan. A couple of questions from me. First off, I'd like to pick your brain on the user engagement and spending levels here in April and May of this year compared to last year, which, as everyone knows, had quite strong tailwinds from the COVID-19 lockdowns. How are your games performing this year compared to last year in terms of spending and engagement?
Yeah, as you rightly point out, we had a very distinct COVID effect, which was limited to April and half of May. When it comes to revenue, we started seeing downloads from mid-March, but revenue kind of kicked in from April, mid-May. Since then, it's been very normal. So very normal seasonality. We see very limited effects of lockdowns. Of course, then April, May, then it's tougher comps. But we've also, since then, the new generation of games have continued to grow. Hidden City, as we communicated in Q1, has stabilized and shows a bit of signs that it could potentially grow a bit, but that's very slow and steady, but more stabilizing, which is very positive. So I think we're kind of comfortable with what we perform currently. But then Q1, as we looked at, you can see we had quite a significant FX impact. That is still with us as well in Q2. So when it comes to the SEK reported numbers in Q2, it's really tough comps in that sense. But that will ease up in Q3 and Q4.
Thank you. That makes sense. And I'd like to move on to the Microsoft store fees, which you mentioned. And I think people are well aware that they chose to lower their revenue split here a couple of weeks ago. You mentioned here that you have 17 games out of the top 90 games on the store. What does that mean in terms of revenue percentage? That's number one. Number two, how does the dynamics of the store differ from perhaps Android and iOS? I'm thinking in terms of user acquisition, spending, and so on. Thank you.
Well, as we've said before, Microsoft is a very, very good platform for us. It has been strong for years. We don't disclose the exact split, but it is a big platform for us. That is definite, and you can see that we've had true success there, given that we have so many games on there. So this will have a significant impact on the company, the lowering of the fees, and we're obviously super happy about their decision. I think it was a bold and interesting move from Microsoft. When it comes to user acquisition, it's not, well, the mechanics are the same, so to speak. It is about chasing ROI. We allocate budgets to where it makes most sense. You know, it's not like we're only doing Microsoft. We do all platforms. All games are growing on all platforms, you know, when they're growing, and you know, so we have a very healthy mix. If it would stand out in, you know, in kind of to be much better than anything else, we would naturally allocate even more capital. So you know, it's still a competitive market. It is the same. You know, channeling might be a bit different. You know, other stuff might be a bit different, but it's not hugely different than other platforms. In that case, we would, as I said, likely be even more successful. It was just an open field that we could play around in.
So the ROI levels are similar as to the other platforms?
Yeah, I would say so, yeah. Yes, I would say so, yeah.
Okay, thank you. I think we're unfortunately out of time, but I'd like to thank you, Stefan, for joining us today and telling us more about D5, and also to the audience for tuning in. So,
yes, thank you. Thank you all, and thank you, Jesper.
Goodbye.
Bye.
Hi and welcome everyone to today's presentation of the technology consultant Semcon. I'm an equity analyst here at ABG and my name is Stefan Knutsson, covering the company. And with me today I have the CEO of Semcon, Marcus Granlund. Welcome, Marcus.
Thank you so much. So yes, thank you so much for having me and for the opportunity to present Semcon. We've been on quite a transformation journey the past few years, and it's good to give you an update on where we are and where we're going and what we have done. So please go to the next slide. So as you know, just a recap of what we do for the ones of you who are quite new to the company. We are the partner in advanced product development. We work with production optimization for our customers. And we also work with digital product information aftermarket solutions. Those three are the main offerings that we have from Semcon. Going to the next slide, please. So Semcon is an international technology company. As you know, we're around 2,000 dedicated employees. We had group revenue in 2020 of 1.6 billion crowns. And we turned 40 last year. It was a bit difficult to celebrate during the pandemic, but anyway, we were founded in 1980 and we're listed on the Nasdaq Stock Exchange, as you know. And we're present at more than 30 sites in 7 countries. Moving to the next slide. So our statement that is very important and that we live by every day is that we put people first. As far as we are concerned, technology has no purpose of its own. It's the value it adds to people and our planet that is most important. And by uniting physical and digital solutions, we create user experiences that matter. This is how we make a difference. And that's really the why people join our company to work together with us and why customers work with us every day and how we create value for the end user of the products and solutions that we create. Going to the next slide, please. So we have 2 business areas, the largest business area being engineering and digital services with 62% of the share of the net sales in the group. And the second one is the business area product information, which has 38% of the net sales of the group. Going to the next slide, please. Just diving a bit into the business areas, starting with product information. This is the business area where we provide value to our customers in aftermarket solutions and product information solutions by providing services within digitalization and tools, providing platforms to our customers where they can populate information for their advanced products and systems that they have. We provide user information, which was formerly known as manuals, but is now digitalized and creating value in the aftermarket segment. We provide service information to the service technicians that serve all the products and systems that our customers have. And we create information for parts and accessories and also digital training solutions, which has really accelerated during the pandemic due to the fact that it's not much classroom training going on at the moment, but rather you train your employees by using digital platforms and e-learnings and so on. And we are now the leading player in Sweden in this segment, one of the largest in the Nordics, and continuing our growth in this very important segment. And we also provide strategic support and operational excellence related to these different offerings that we have, that we provide to our customers. Next slide, please. So going into the figures of this business area, as you've noticed, a lot of focus has turned to aftermarket solutions, and therefore we've had a really good year in 2020 despite the pandemic, and we have also had a great start to this year and continue to really deliver excellent operating margins. So the operating margin is still on a very high level. As you can see, 16.6% operating margin in the first quarter this year compared to 15.9% in 2020. And the number of employees increased, of course, driven by demand for digital aftermarket solutions. And the share of functional sourcing and solution-based deliveries is large and increasing. And in this business area, we actually have long-term contracts for about 75% of the revenues, which is really important and a good platform for growth, of course. And we deliver with a multi-site delivery using our skill centers, for example, in Budapest, to provide really good value for our customers with the right cost base. And you see the industry diversification that we have in this business area, where manufacturing industry stands for 36%, automotive 27%, and we are quite big within telecom. We have some in life science, energy as well. And the public sector now, with the acquisition of Extractor that we made during Q2 last year, has really added the segment, the public sector as well, into our customer portfolio, which is great from many perspectives. So going to the next slide, please. If we look into the other business area, engineering and digital services, this is a more classic consultancy business area where we combine a digital edge and with really hardware knowledge, providing competences within strategic design and innovation, advanced engineering, production optimization, and digital services that really runs across all these. So it's product development and production optimization, the core of this business area. And we provide advisory services and project and quality management. And as you know, there is a large demand for technical solutions and technology in general, and it's getting more and more advanced, and therefore there is a huge demand for these services. Even though we've seen some up and downs historically in various industries, we still have see a large demand and a good possibility for growth for this business area. Moving to the next slide, please. So diving into the figures here, we do see positive market developments coming out of the pandemic now, hopefully, as vaccinations is being spread out. And we have grown the industry diversification. We had a very strong growth in life science, where we are one of the strongest players in the Nordics, which grew by 32% in the first quarter. And as expected, we had an organic growth that was impacted by restructuring in Q2 2020, where we had a restructuring carried out. And we also divested our Indian operations at the end of the year. So that has impacted the organic growth, predominantly the restructurings made in Q2. And therefore, you see a negative growth in the sales, but here we now have a fantastic platform to grow from, and in the Q1 figures you see that we have an operating margin of 10% compared to 9.2 in the previous year, and for the full year was impacted by restructurings that impacted the EBIT of 35 million crowns in this business area. So we are on a really good track, and we've made quite a transition over the past few years. Going to the next slide, please. So looking at group figures, we are really trailing at a good operating margin track, now reaching 11% in the first quarter for our total operations, compared to 10.2 for the same period in the previous year. We have really good growth opportunities, and where we prioritize life science and digital services. And as I mentioned, we saw good growth in both these segments in the first quarter. And as expected, as I mentioned, the sales growth was impacted by structural changes in 2020. And now we have a good growth possibility going forward. We also can note that in Q1, we had one fewer working day, which has an impact on our EBIT and our sales of about 6 million crowns. So looking year over year, it looks quite good. And productivity was positively impacted by new ways of working. And by that, I mean the work flexibility that we have now in Semcon, taking the positive things that we see in our new ways of working in the group, working in a more digital manner, and making sure that we perform the value for our customers that they expect. But it doesn't matter if we do that from our offices or from at home, but we have really a high productivity in the group, which is also fantastic. So moving on to the next slide, please. So looking at this transformation that I mentioned just in the beginning, that we have done over the past 5 years, we have really succeeded in creating a more diversified industry mix. We have less dependency on single sectors. That has really improved the resilience and positioning that we have as a group. And we saw the proof of that during 2020 when we had the pandemic crisis hit us in mainly Q2. We have improved the profitability over the past few years. Operating margin full year 2020 was 8%, and Q1 now at 11%, as I mentioned. And 2020 includes restructuring costs of 37 million total in the group. So the adjusted margin is of course higher than the 8%, but we're glad that we're now coming in strong and starting strong in the first quarter of this year. And we've also achieved a very stable financial position over the past few years, where we have a net cash position of more than 200 million SEK, which of course increases our flexibility also to grow by way of acquisition. And we met all the financial objectives during 2020 that the board of directors had set up. So that's a fantastic achievement by my colleagues, which I'm really glad to report. And so you see the industry diversification in the right-hand corner, and now with manufacturing being at 32, mobility sector where we have really strong trends towards digitalization and electrification, and also autonomous vehicles now standing for 31%, life science increasing quite a bit, and we also have a good position in telecom and energy, and also increasing in the public sector. Moving to the next slide, please. So now what we see is that we have a very good and stable foundation for profitable growth. And this is really the next step. Having a solid position, both financially and profitability-wise, is important to take the next step, and that's what we're doing now. Going to the next slide, please. So since we reached all the financial targets last year, the board of directors decided in Q1 this year to adopt new financial targets. So the targets for the group now is total annual revenue growth of at least 10%. And in that, we include acquisition growth as well as organic growth, and an operating margin of at least 10%. Moving to the next slide. So our strategy for growth is driving really the digital transformation for our customers. And we see this trend in all the industries that we're in, that it's a huge demand for really making this transformation, whether you talk about product development or investments into production facilities to ensure that you can really take the benefits out of all the data that you have in there to make that production facilities even more efficient. And it also is about the aftermarket part where we provide digital product information to our customers to ensure that they have a stable and really good aftermarket business. We create a really good impact with long-term partnerships. As I mentioned, we've now existed for more than 40 years, and many of our customers have been with us for more than 30 years. So we have long and stable partnerships with our customers, which is great, and also a good foundation for growth. And we need to have an inspiring workplace to attract the right talent. And that's why it's also very gratifying that we got the receipt of that. That's the fact that we have historically high net promoter score from our employees in the latest survey, which is also great to see. It's been a bit of a different situation now from a leadership perspective, leading in the digital world when we can't meet each other as much physically as we would like to. But still, and in the light of that, it's really gratifying to see that we're scoring really high on the net promoter score, the fact that our employees want to recommend Semcon as a working place. And the increased demand for sustainable innovations, I would say that this might be one of the most important factors when driving growth going forward. There is an enormous demand for sustainable innovations in all the industries that we're in, and we're helping our customers to find the solutions to do that. And we support the transformation, as I mentioned, in several industries, and that's really the edge that we have, that we're not focused on one single industry, but we are actually moving between various industries to help them with their transformation. And we have a financial stability, and we want to make even more strategic acquisitions to drive growth also in that regard. So moving to the next slide, please. So the ongoing strategic shift that we are in is really offering the high value services with digital edge within product development, production optimization, and aftermarket solutions. We have a business model where we work with specialists on site or in agile teams towards our customers. And we work with solution-based deliveries and functional sourcing as well. And we have a really good industry mix now, continuing to broaden the customer base that we have, which is a fantastic base to have with a lot of great trademarks that we work with. Going to the next slide, please. So when we say supporting the digital transformation, we mean, for example, the digital experience that the end user of the products or the services or solutions that our customers provide to the market. The digital experience of those products is what we help our customers with. We also create smart products, making sure that they are connected and digital. We work with autonomous solutions within mobility, and that's predominantly now in the initial phase within secluded areas, meaning, for example, harbors or transports within forests or so on, to help them have really good return on investment cases when it comes to autonomous transport within secluded areas. Electrification is also a very important trend within this, which we also include in the digital transformation that is ongoing and is affecting many of the industries that we are in, if not all. And we also, of course, we have a fantastic team within artificial intelligence and data management. And as I mentioned before, with regard to production or with regard to product development or aftermarket services, we can really create extra value through this knowledge and special services that we have here. So this is really a great offering that we have as well. So we are with the customer all the way from idea to implementation. Next slide, please. And talking about acquisition growth, here we have the latest acquisition that we completed just a few weeks ago, where we had the fantastic company Squeed, which has a fabulous trademark in the market and a very, very good reputation. We have now almost 100 employees joining us from this company, which is strengthening our digital position in the market. They have a net sales of in 2020 of 105 million. They had an operating profit of 14 million. And so this is a great complement to our services. And what we do with this acquisition is really that we're strengthening our digital position, and we're also broadening our customer base because it's complementing us within new industries. For example, the finance sector and also the retail sector where Squeed is very strong. They have a very good distribution when it comes to customer base already, so they have no large dependency on one single industry or one single customer, but is working very, very broad on digitalization with our customer and fantastic software knowledge in that company. So we are very, very glad to welcome Squeed to Semcon, and this is, of course, boosting our growth further. Going to the next slide, please. So our sweet spot is really between the physical and the digital. As I've explained, we know the DNA of production. We know the DNA of the products that we have developed over the past 40 years together with our customers, and we are adding the digital layer. So we are not the company that come from the IT side of things. We know the DNA in the production and products that we develop. And we have a unique position with both advanced engineering and digital edge. And several players in the market can develop these separately, but only a few can improve them together, and that's what we do at Semcon. So we are in a good position to grow. Moving to the next slide, please. So sustainability as a driving force, I mentioned this in the beginning. There is a sense of urgency, as you all see in the market and in all the industries that we are in. And we do see the shift in the discussions now between going from being a risk to an opportunity. And a lot of the companies and customers that we work with are really seeing the opportunity to make good business of the transformation into a more sustainable way of providing products and services in the market. And we are helping them in doing this. And there is an increased demand for sustainable business models, which is also part of our discussions now with our customers. And new regulation and increased transparency obviously drives this demand even further. So I would say that this will be one of the key drivers for growth going forward for Semcon for many years. And it's impacting all the industries, as I said. Going to the next slide, please. So in summary, We have a solid position for future growth, growing need for technology, increased focus on service and aftermarket solutions, and also with a touch, of course, of sustainability, where we can make a really big difference for our customers. We have a unique combination of digital solutions and advanced engineering. We have a beneficial industry diversification that has really improved over the past few years that many in the market, I think, have not yet recognized. And we have fantastic colleagues that are inspired, which is, of course, a basis for profitable growth. And we have an excellent financial position. So we are now writing the next chapter of our history, and that's a really exciting journey. So next slide, please. And that's why we put people first and then technology. It's really important that we make a difference in our product development, production optimization, and aftermarket services, where we put people first and use our expertise in technology. So thank you, and I open up for questions.
Thank you, Marcus, for the presentation. I will conclude with some Q&A. And first up, obviously, COVID-19 affected you during 2020 with the 2 restructurings. But what is your view on the business recovery now when society is slowly coming back to normal here in Q2 and also in the second half of 21?
As I mentioned, I'm so impressed by my colleagues at Semcon, where we have really handled a very difficult situation in an excellent manner, making the restructurings, accelerating our transformation that we did during 2020. We are now in an excellent position. Now, we maybe did a couple of years' work in 1 year to make this transformation even quicker. And that's why we have such a good position now for growth. Obviously, for the first quarter, we reported negative organic growth due to the restructurings, but everyone knew that. And now when we have, going for the rolling 12 going forward, we do see a positive development. So when everything is opening up now, we do see that it's the possibility to open up even more new customer accounts and have more, good discussions with our customers, and we do see a good market development.
And also, COVID-19 led to some cost savings. You reported a strong EBIT margin here of 11% in the first quarter, but are these cost savings that you had last year only temporary, or do you expect to keep them more long term?
I think that we have a bit of a cost saving, a bit lower cost in 2020 due to the fact that we didn't carry out as many activities, we didn't travel as much. I think that's what we see in many companies, not just in Semcon. But on the other hand, we do not have expectations that we will move back to the cost level of 2019. We have permanently made sure that we can keep the cost level at a lower level, and we've also implemented the additional efficiency measures in acting when we made the restructurings during Q2 last year. So we do see that we will have a lower cost base going forward compared to 2019. We will take more investments into sales activities going forward because we want to boost our growth and grow further. And so we will take investments in that in both business areas, both EDS and product information. But in general, as I said, we will keep the cost level down. But we had some extra low cost level in 2020. But hopefully we will compensate that by growing the business further.
And as you mentioned in the presentation, your revenue mix has becoming a lot more diversified now, mainly as life science revenues has grown. Is it also within that industry that you see the most future potential?
We have a very, very good position in life science, and it's a bit of a larger hurdle for our competitors to get into life science because it's more a regulatory industry compared to maybe other industries, if we compare. And we have a very strong position in the Nordics. So we continue to see a very good demand for our services within life science. And we have strengthened our trademark even more now in life science when it comes to recruiting competence into that area. So we do see a large interest for Semcon and joining Semcon to make a difference within that industry, which is great. So yes, we do see a very good potential to grow that further, and we're happy to see that we grew that by 32% in the first quarter.
That sounds promising. And just to conclude now, let's talk a lot more about your growth agenda. You recently acquired Squid, and my impression is that Squid is a small, fast-growing and profitable consultancy company. I mean, how hard was it to get this deal done? And was it a gem, or do you think that you can find similar companies out there?
We've had many and various discussions over the years. For us, it's really important that we have a match in the culture of the companies, that we see that this is something that really can complement Semcon, and that it's not more of the same, but it can add something in the customer base. It can add something from a competence perspective, and Squid is really doing that. We see other similar companies, but just because it's a company within digital competence doesn't mean it's right for Semcon. Squid is definitely right for Semcon. It's great to add an extra 100 million to the revenue and welcoming 100 new colleagues to the Semcon group, and we do see other companies like this in the market. But we have really invested time in having the discussions and how we should operate together, and we've done that very thoroughly because we want to succeed with these kind of acquisitions, and we do see other opportunities in the market, definitely. And with our strong financial position, we have, as I said, a good flexibility here to grow also with acquisitions going forward.
Perfect. It will be interesting to follow your journey going forward here. But that concludes the presentation, and I would like to thank you, Marcus, for coming here and presenting with us today.
Thank you very much.
Okay, then I welcome StrongPoint to this presentation. Here today we have the CEO, Jakob Tverrbak, with us. So with that, I'll leave the floor to you, Jakob.
Thank you so much, Petter, and thank you everybody for listening to this short presentation of StrongPoint. So for those of you that don't know StrongPoint, we are a retail technology company headquartered and listed on the Oslo Stock Exchange with own offices in Norway, Sweden, the 3 Baltic countries, and in Spain. In addition to that, we are working with a network of partners to distribute our solutions outside these countries. Last year, we had a operating revenue of in excess of 1.1 billion Norwegian kroner and just south of 100 million EBITDA. If you go on the next slide, I mean, it's difficult not to reflect on 2020 and the pandemic and what that did with StrongPoint. For StrongPoint, it has turned out to be a little bit of a perfect storm in this one way that the demand for online groceries have skyrocketed. Many markets have accelerated 3, 4, maybe 5 years ahead, making online groceries more mainstream than it has ever been before. And StrongPoint and its e-commerce logistics solutions are just in that sweet spot, which we'll talk a lot more about. But not least, we also have a number of in-store productivity solutions that are there to withstand the margin pressure that you face in the brick and mortar stores. So next page, I would like to, before progressing, just emphasize that we are not only a retail technology company, but really a grocery retail technology company. We have our focus on the grocery retail customers and companies out there in the world. And that's not to sort of say that the grocery retail market is not big enough when you compare with the overall retail market. The grocery retail market is humongous. It's so making sure that we have the best solutions for the grocery retailers is by far enough to drive a very, very exciting growth journey ahead. That said, there are also some spillover effects to other verticals, do-it-your-own type of stores, for instance. But primarily, we are focusing on grocery retail. And on this page, we have labeled a few of our customers. In principle, the major grocery retailers in Norway, in Sweden, in the 3 Baltic countries, and emerging so in Spain. Going to the next page, I like to talk about, and we like to talk about, StrongPoint's double opportunity. So even pre-COVID, the e-commerce growth was driving 2 opportunities for StrongPoint. And obviously, these opportunities have accelerated with COVID-19. Number one is that e-commerce in itself drives some of the revenue from stores to online to the online channel, and part of that is going through dark stores, meaning it never really hits the grocery stores. And you can imagine with more and more of the turnover going outside the stores, it means that the stores with their cost levels are experiencing a margin pressure. I would claim we have yet to see that happening because of the closed restaurants, canteens, etc. But what is happening now with the opening of society is that this margin pressure will really, really mount up. So to withstand that margin pressure, technology solutions is a vital part of that solution. and I'll explain in a bit what solutions StrongPoint offer. So that's number one. Number two is obviously that e-commerce in and of itself is growing massively. And StrongPoint has some of the best, if not the best, e-commerce logistics solutions for grocery retailers to take part in the growing e-commerce market. It is no longer a question of if you want to go into e-commerce as a grocery company, it is how fast can you go into the e-commerce market and make that profitable. So again, for those of you not familiar with StrongPoint, I will go through very briefly some of the solutions we offer in store and in our e-commerce logistics suite of solutions. So if you go to the next page, we have basically taken the roof of a supermarket or a grocery store. And a non-exhaustive overview of the solutions we offer is presented here. So on the one hand side, you would have self-checkout solutions, which have obviously increased a lot in interest with COVID-19, wanting to reduce the amount of contact with both people and others. We have number two, we have electronic shelf labels. As StrongPoint, we have contributed to, in particular, Norway being one of the highest penetrated ESL markets in the world. It's virtually impossible to go into a grocery store without seeing electronic shelf labels. Number three, we have our VenSafe solution, the tobacco automation solution, which is not only tobacco automation, but is also a solution which very nicely fits into the self-checkout solutions and other checkout efficiency solutions, making that almost like a rebirth of that solution. On number four, we have task and labor management solution. We are a proud partner of Reflexis, the workforce and task management solution that was acquired by Zebra last year. That is very important. As we know, grocery stores have their highest cost item, apart from COGS, being labor. And so being able to optimize the labor and how labor works in the store is very, very important to withstand the margin pressure. Cash management, you'd think cash is dead. The recently announced deal we did with NorgesGruppen in Norway proves that that's not the case even now. But in all honesty, the major bulk of growth in cash management we are expecting to come from other economies such as Spain, Italy, Greece, and other more cash-intensive industries. Then in the intersection between what goes on in the store and e-commerce, we have here illustrated our picking solution. We'll talk more about that. So the in-store picking solution from StrongPoint, and also the click and collect lockers where customers can obtain the purchased items efficiently and for the retailer at a very, very cost-efficient manner. So there was a very quick and, again, not comprehensive overview of what we provide in the brick and mortar stores. Going into what we do in e-commerce a little bit more in detail, on the next page, we will see the solutions we operate with as illustrated here. So in the e-commerce logistics space for groceries, there are really two major bulk of cost items that need to be solved. One of the items is picking, and the other is the last mile delivery. And StrongPoint, we provide the most efficient picking solution for the stores. We are not into robotized solutions like the Fabric, the AutoStore, the Takeoffs of the world, or Ocado for that matter. that is interesting to have a look at, but that's not an area in which we at least have developed something ourselves, but are cooperating or will be cooperating in the future, I'm certain about. On the last mile delivery, we provide click and collect locker, drive-throughs, pickup in store as own proprietary solutions, and we work with Gordon's delivery on both the route optimization and home delivery. So in total, StrongPoint provides the entire solution for any grocery retailer from an order is received in the web store until it is delivered to customer. And we'll talk more about e-commerce. I know that's a hot topic. So we can go to the next slide, please. So I want to give you a little bit of more flavor on what are the USPs of StrongPoint's picking solution. So number one, we are the most efficient solution we have seen out in the market. When we are exploring competitor benchmarks for how fast and how efficient can you do picking in store, we see no other solution coming close to what we are offering. We offer higher or more than 240 items per man hour picked in store across categories. So more than 240 items per store or picked per hour in the store. And if you were to go to one of the major consultancy companies, they would probably give you a benchmark of 60 to 90 items per man hour. There's a huge difference, actually so big that it's sometimes difficult to believe how it could be this big. And I think I'd like to just provide a twofold answer to that. Number one is we are coming from Scandinavia, from Norway, Sweden, the highest low-cost countries in the world, which means our solutions for manual picking, if you want, needs to be very, very efficient. Needs to be very, very efficient. There's a reason why the AutoStore and Odas of the world are also getting a lot of success. We are Nordic-based. We need to be efficient. That's the only way our solutions will work with local clients. And number two is we've been doing this for more than 20 years. That is with the acquisition that StrongPoint did of Cube back in 2017. We have invested heavily into the Cube picking solution and continuously modified and accelerated the movement to make the picking as efficiently as possible. That's number one. Number two reason for why our picking solution is so good is that's extremely fast to deploy. Typically, any grocery retailer of a certain size would have some sort of handheld device in the store or ARM PDA to facilitate order intake, making orders, or receiving goods. We're using to a large extent a lot of the same type of hardware in the store. And with very few additions to that, we're able to scale the solution both practically, but also through our cloud-based picking solution that we're rolling out as we speak. And lastly, it's because of that, a very, very low capex. Our third generation picking solution operates with a fee per order and making the cost overview for our customers very, very transparent. Let's go to the next page and talk a little bit about the ambitions, and then we'll talk about what the proof of the pudding is for our e-commerce logistics solutions. Some 1.5 years ago, StrongPoint went out with its ambition of being a 2.5 billion kroner company in 2025. We were confessably somewhat hesitant to repeat that again in the midst of the pandemic in March, but very quickly realized that the expected decline in cash management potential we would see would be more than made up for in the e-commerce logistics suite. And so the majority of the bulk of StrongPoint's growth coming forward versus 2020 is going to come from e-commerce logistics. And this is a massive growth. We know that, but we also know that we have some stellar solutions that are gaining lots of traction in the market. So I'll use the remainder of the presentation to talk about the e-commerce solutions that we're offering and what we are achieving in the market. So you can go to the next page, please. So to provide you a little bit of top-down understanding of how is the market growing for online groceries. On the left-hand side, what we have here is the online grocery sales estimates in our target market, so principally the US and Europe. And you will see there was a big jump, of course, from 2019 to 2020, a doubling of the amount of revenue going through the online channel in groceries. We are expecting, along with analysts, expecting this trend to continue with about 15% annual growth rate. So that fundament makes us go into, well, how do you process these orders, both from a picking point of view, but also from a delivery point of view when you look at technologies. And you would also very quickly realize that the CAGR, the growth, is slightly higher in terms of number of orders being processed versus revenue. And that simply has to do with the fact that one expects, and we expect, more smaller purchases to be done, amongst others through the Globus, Deliveroo, and Delivery Hero type of growth as well, as you see with the delivery platforms. Simply said, StrongPoint, we provide all the delivery technology solutions that you have out there, as just explained. And when you're looking at the picking solution, we are offering the pick in store and also the pick in dark store solution as our proprietary solution. And in order to convert this into sort of an addressable market available for StrongPoint, you can say, simply said, you can say that the picking solutions, as well as the home delivery, drive-through, and in-store delivery is all part of the software license market, versus the click and collect market, which is predominantly a hardware market, so the click and collect lockers being sold to the retailers. So if we go to the next page, we'll have a deep dive into what does this mean for the addressable market for StrongPoint. And we're seeing a massive growth, 17% CAGR in the software licenses and 36% CAGR in click and collect lockers, which means that maintaining today's market share, StrongPoint would be doubling its software license fees and 4 to 5 times doubling its click and collect locker sales. Of course, we and our ambitions are not to just follow the market. We want to grow and gain market share, and we believe we have a very strong value proposition to actually make that happen. So let me try to give a little bit of proof in the pudding. If you go to the next page and talk about what are the addressable market for StrongPoint, you could be separating between these kinds of players. We are clearly working with both grocery retailers with an existing e-commerce offering, where click and collect for sure is very, very attractive and applicable, but also picking solution. And simply the, I should say, conservative reason for putting it in brackets is a lot of companies already have existing picking solution and making it a little bit harder to sell the solution, but the performance of our solution makes that very attractive. Newcomers basically need it all. Pure online players, like the Odas of the world, to most extent are developing solutions themselves. However, we also do see some click and collect opportunities there. And then lastly, the on-delivery platform players are, as you've seen, getting its act and going into the grocery retail space, making our picking solution in particular very, very applicable. On the next page, just wanted to prove the point on the delivery platforms. We, in Q1, announced the deal with Glovo. Glovo is one of the very few, and if not the biggest, one of the very biggest unicorns in Spain. More than 20 countries, and actually, as announced earlier today, Glovo acquired a major bulk of Delivery Hero's Balkan operations, increasing the number of markets they're penetrating as well. And the interesting thing, and to provide you a little bit of proof on how good the StrongPoint picking solution is in fact the fact that a delivery technology unicorn as Glovo has selected StrongPoint's picking solution to be used with its partners, Carrefour's, Spar, Walmart, etc., when doing grocery picking in their stores. So we're very, very proud of that, have high expectations for the growth to come after some time, but not least, it's the marketing effect also to our customers that the StrongPoint picking solution is world-class, if not best in class. One or two more slides now, and then I think we'll open for questions. But immediate priorities. Number one, we have a full focus on capitalizing on the e-commerce logistics market. It's difficult to believe that not all grocery retailers have moved into e-commerce yet, but there still are some exceptions, Norway being one of those markets. I have great hopes that we will see things happening in not only Norway and Sweden going forward, but in all markets going forward, and we are there to capitalize on that. We're there to deliver on the in-store productivity solutions demand that will push its way forward, even more so now with the economies opening up, putting even more pressure on the margins and revenue in the stores. And lastly, which we haven't covered much of in today, is step up the M&A initiatives. We see a number of initiatives that we could take in place to further make StrongPoint a really, really retail technology company, not only in the core markets we are now, but also outside these core markets where we see a good product market fit. So my last slide, I only want to summarize. We are underlining our ambition to become a 2.5 billion kroner company in 2025 by organic growth, so M&A in addition to that. To grow our e-commerce share from, in 2019, 6% to 9% last year, and 25% in 2025. And last but not least, go from a sub 9% EBITDA margin to a 13 to 15% EBITDA margin in 2025. Thank you so much.
Thank you, Jakob. I think we have room for a couple of questions. So I'll just start with the e-commerce and logistics, which will be the growth engine going forward here. And you also touched upon, some of the subcategories, but can you also share somewhat more lights there? Which of these subcategories are you seeing the strongest momentum? And also, do you see some differences between your regions?
I think the short answer to that is there is growth across the board. There's growth across the board. I think as an investor, what you should know is that clearly the picking solution being a software-based solution where we are charging a cost per order is going to have a steadily growing type of profile going forward. Whereas we both hope and expect that with click and collect becoming a preferred means of receiving your groceries, not only like in Sweden, you will see more sort of rollouts with bigger announcements of rollouts. So I think it's fair to say that we're seeing a growth the growth across the board on all dimensions. It's almost difficult to single out one versus the other.
Understood. And then also, I mean, obviously the grocery sector has seen a boost now in sales during the COVID-19. Have you seen any increase in the willingness to do investments in new retail technology? And how do you expect that going forward?
Yeah, I think with a few notable exceptions, I believe most of the grocery retailers realize two things. One, e-commerce is here to both stay and grow. It's not going away, and hence you need to invest in that. And number two is the fact that last year did see a unnatural growth with the closing of canteens, restaurants, etc. And so most groceries are bracing themselves for what you call tough year when you compare growth in the stores versus last year. And that's where it comes into the sort of margin pressure. And the good thing is, of course, with, again, very few exceptions, these grocery chains have the financial capabilities to do these investments and are in it for the long run. So the short answer would be yes. I think by far the most amount of grocery chains are investing in the future for this new normal.
Okay, perfect. I think, I mean, we could sit here and ask questions for the next hour, but I think our time is up. And I thank you so much, Jakob, for sharing your thoughts and the presentation of StrongPoint.
Thank you so much.
Hi, and welcome to our next presentation with Teqnion, presented by CEO Johan Stene. Myself, my name is Max Bacco, and I am an equity research analyst here with ABG within industrials. And with that said, please go ahead with the presentation, Johan.
Hello, thank you so much for having me today. I'm the CEO of Teqnion since 2009. I have probably one of the
Johan, I think we lost the sound from your side. Could you try to say something?
Yeah, I have a delay of approximately 5-10 seconds, which is very hard to work with.
I can hear you clear and loud now. So if you just try to go on with the presentation.
I will try, absolutely. Yes. I still have a backlog of the sound coming back at me after like 7 seconds or so. Is it something I can do to remove that? Or?
Do you have YouTube on the background or something?
So much for having me today. I will try to describe a little bit about Teqnion. We are an industrial group. We are growing primarily by acquiring smaller industrial companies, almost always driven by entrepreneurs, and we try to keep them on board as we become the new owner of the company. We have taken a lot of influence from our big siblings on the Stockholm Stock Exchange, such companies such as Lifco, Lagercrantz, and Adtech, and we have been doing this since 2006. We very strongly believe in what we do. We have a lot of fun at work, and we think there's so much more to be done. We have a fantastic management team, and we are working very closely with our subsidiaries, and we have we're in it for the long run, and we are, as it feels, just in the start of something big. With that said, we've been doing the same thing since 2006, which means perhaps I have a very short memory. I don't know. Next slide, please. 2006 we founded this, and we are today 17 different companies. Actually, we are a few more companies, but we have them as result units, and we are divided into 3 different business areas. We mainly are focusing on product delivery, where we deliver a product with a lot of know-how. The group is very decentralized, meaning that the subsidiary is working by itself. We're not trying to steer them in any direction. We are trying to help them and support them from the mother company. We are also helping them within the board of that subsidiary, where we, together with the management of the company, are deciding about the long-term strategy for that business. We are approximately 280 co-workers today, constantly growing, of course. Our main market is still Sweden, even though that we have business globally. We have almost all of our companies in Sweden, and we have a lot of that is due to the fact that when we started this, we wanted to work within the companies to learn the business, get to know the people, and really get to know the business. Please give me the next slide. A little bit about where we are today. We are turning around a little over 700 million. We're trying to have 10% earnings from that. During this year, we have acquired two very good companies. One is a cutting metal company in Valdemarsvik, and they are manufacturing really specific parts for big Swedish global industrial customers. And then we acquired a smaller specialized companies that manufacture benches and cooling benches and heating benches for the professional kitchens in high-end restaurants and restaurants and in hotel restaurants. Thank you so much. Next slide, please. We have all our subsidiaries divided into 3 business areas. A lot of them are in the business area niche, with a little bit because we love the niche products, and that is also where we think we have the best offering towards our customers, where we also sell a lot of know-how and application knowledge. We love to be in markets where there's a lot of regulation and where it's hard for any competitor to get in. We love the unsexy stuff where no one would like to be. We love to be there. We also have a business area called Growth, where we have companies that have the potential to become really big globally. And we also have an industrial area where we have a broad variety of different industrial producers, manufacturers, I should say. Please give us the next slide. The strategy for us is to let the subsidiaries be entrepreneurial driven. We have the demand that every subsidiary should be offering something unique to its customers and to its market. We strongly believe in long-term relationships with both suppliers and customers, and of course with our co-workers, which are our most valuable asset. We believe that a sustainable business is a business that is easy to understand for all stakeholders, that is always profitable and always have a good cash flow. We also try to make our workplaces fun to be at and to keep our co-workers proud of where they are employed. And we love genuine people. We love to be our best and be as good as we can be. Please give us the next slide. When it comes to acquisition, which is our main focus here on the mother company, we are constantly targeting and approaching potential sellers of industrial companies. We look at some different criteria that we would like to be fulfilled. It should be profitable, and it should have a sales of approximately, it's pretty wide range for us, but if it's very niche, it could be as low as 20 million Swedish, but we look at companies that turn around approximately 100 and a little bit more. We're almost only doing business-to-business companies. It's very important for us that we understand the business. It shouldn't be complicated. It should be easy to describe. It should be easy for all involved to understand who is earning money and why. We pay for these acquisitions with our own cash and with bank loans, and we do it in a way that we pay approximately 70% of the price for the shares up front when we step into the company, and then we do it on earnouts, performance earnouts, approximately over 2 years, the rest of the payment. And we try to get our money back within cash money back in 5 years. And We are going very. We focus very much on the entrepreneur, on the person that we both parties, both the seller and the buyer, believe that we can work together, because we try to keep the management on board even after this 2-year period. And normally we can do that because we are pretty fun to work with, and we have a drive that we will constantly want to be better and develop our companies. Next slide, please. As it is today, we historically I've been doing a lot of the acquisitions myself, the screening and finding new companies. Since over a half year now, we are 3 people doing this, meaning that we have a very good pipeline at the moment. Most of the companies that we are talking to, or the prospects that we're talking to, we have found through our own scouting, cold calling more or less, and but we also have a constant intake from brokers that we work very closely with, and we see them as partners and co-workers as well. And during the last 5 years or so, since we've been doing this for a while, we also get calls from entrepreneurs that would like to sell their business to us because they have heard that we are a good taker of industrial companies. We have today, we're talking with constantly talking to approximately 10 companies for buying them. And we are aiming for the upcoming years to buy approximately 5 companies a year. That feels today like a doable target. After that, I guess we will accelerate. Thank you. Next slide. We try to keep everything simple. We like to earn money. We rather have a high bottom line than a high top line. We constantly striving towards higher margins. Sustainable companies is what we believe in. Sustainable people and relations is what we believe in. We try to have as high cash flow as possible, and from all the cash that we get into the company, we try to find good acquisitions to grow the company with. And yeah, we're in it for the long term. Next slide, please. We have a very fantastic management team. We used to be the two people in the middle for many years, Maria and myself. But since 2018, we have grown a little bit. So now we are more or less an entire army capable of doing almost anything, at least hard things. I'm very happy with this team, and perhaps we don't always look this happy as on the picture because we discuss a lot and we never let anyone be less than their best. But we have a lot of fun at work. Next slide, please. Just to summarize everything, we are continuously growing, primarily through acquiring very good industrial, entrepreneurial-driven smaller companies. They are working in narrow niches where we can have a good, where we can keep a very good customer offer and long-term relationships. We believe in sustainable businesses where we always earn money, where we're always profitable. We strongly believe in the decentralized architecture where every subsidiary could stand on their own legs and just need support from the mother company. And the sound people, the people that love to be good and love to drive something to the future, those are the people that we would like to attract and that we would like to work with. We are in the beginning of building something huge. Next slide, please. Thank you so much.
Thank you very much for the presentation, Johan. And now over to some Q&A. As you mentioned during the presentation, you have made 2 acquisitions here to date, Cutting Metalworks and Kemma Storköksförsäljning. Could you tell us something more about the reasoning behind those 2 acquisitions and why those 2 companies fit into your business group?
They are a little bit different, those two companies. We both love them very much. One of them, CMW, Cutting Metal Works, we've been talking to them for a couple of years, getting to know them. And finally, we decided that we should work together, and we acquired the shares from the more or less the founders that were still working within the company. One of them had reached the pension age and wanted to retire, and the other one would like to work, still be working. So Christer is still there as the CEO and would like to continue so, but with new ownership. And we could give them stability, a good board of directors that could help them with the decisions for going forward. And they are in a position where they can grow with their customers and with their existing business for many, many years. It feels like a very stable company with very good people with a lot of knowledge in what they do. So that was an easy one. Kema was something different. It was a company that was not for sale. It was something that we more or less stumbled upon, and the owners, father and son, both of them wanted more or less to retire. And we told them that you don't have to close the door and throw away the key and go home. Please let us help you to revitalize what you have, because you have built something fantastic. And now we're working together with them to revitalize the company, and we have a tremendous response from the customers, which really love that we are trying to put some fire into that company again. It's really fun. And that's also a company that owns its own brand, or selling its products under its own brand, which is very, very good for the future, of course.
Okay, thank you. And as you mentioned, sometimes entrepreneurs approach you in order to sell their business. Why do you think that business owners want to sell their business to you specifically?
Except for that we pay them money. I think that one thing is that we who approach them, we have worked in this type of companies ourselves, so we know, we can understand them, and they pretty soon they realize that we understand them. And that when you are an entrepreneur and you are building your company throughout the decades, you are often very, very lonely. And when you meet someone that realize or that understand that, and also can offer them a family now where they can continue doing what they love, but without the burden of providing for all of these employees and feeling the sole responsibility for all of these employees, they can get they more or less get a new burst on doing more. So even that they perhaps believe that they would like to retire, we can almost always show them that it's very fun to stay on in some way anyway. Perhaps not as a CEO, but perhaps stay on with their closest client, or stay on as a board member or something like that. So I think why people like to sell to us is that we understand them and that we love them, because these are the people that are building our country. And when we love them, it's easy for them to love us. I think it's as easy as that, or as complicated, I don't know.
That's a very good answer. And on to the next one. With your strong balance sheet and low debt ratio, how much could you potentially add through additional acquisitions if we play with the numbers?
I think just to answer that broadly, I think we will have we're working together with one of the big banks, and when it comes to acquisition, so we use our own cash and we loan some money from them. And as the partnership we have today will probably keep us on the rate of buying turnover of approximately 300 million per year for at least 3 or 4 years coming. And since we are acquiring companies that are cash positive, we constantly increase our own cash as well to acquire even more companies. So the more we grow, the more we have the possibility to buy more companies as well, because we are buying companies with positive cash flows, good relationship with the bank.
Yeah, sounds like a very good business idea.
Yeah, I think it's very important for us, of course, to keep to don't have too much debt, of course, but as it is today, we have a lot of cash and the debt is very low. So for the coming years, we have a lot of good acquisitions to do.
Yeah, and on to the last question. In your latest Q1 report, you stated that a lack of raw materials and increasing raw material prices have affected your industry segment. Have you seen any improvements in this area, and how have you handled the situation?
Yeah, we try to talk to both customers and to suppliers and do whatever we can to handle this situation, but it's both steel, it's construction wood as well. A lot of timber, the prices have increased enormously because of a lot of the Swedish timber is going on export today, and we will have to struggle with this for a long time, I guess, before we will see any normalization. But I mean, we have good, as we value always, good relationship with both customers and suppliers. We try to help each other out, and then we know that we are depending on each other. So we're all in this together.
Yeah, I think that was all from me. Thank you very much for joining us here today, Johan, and good luck in the future.
Thanks.
Thanks. Bye.
Bye-bye.
Hi and welcome everyone to today's presentation of Eurocon. My name is Stefan Knutsson. I'm an equity analyst here at ABG covering the service sector and Eurocon specifically. And with me today I have the CEO of Eurocon, Peter Johansson. Welcome, Peter.
Thank you very much. Glad to be here.
The floor is yours.
Thank you. Okay, I will start to say that you can take the next picture. Yes, Eurocon is a company which holds a couple of smaller companies as well. We see them PDAB and KLT and SiteBase. PDAB is a specialist company for design and process automation and process safety. And you can see KLT, they are a qualified technology consultant for automation, mainly in the pulp and paper business. And they also have an installation technology department, which is a smaller one. And then we have SiteBase, which is our integrated engineering system that streamlines and qualify and ensure information in the industry, especially when you are rebuilding or building new things there. And also take care of data to the maintenance systems. You can take the next picture. We're working in several areas. We are working especially, of course, in the industry. We're mainly working in the industry, I would say. We have some smaller parts in the infrastructure and in the IT section. But the main turnover is coming from the industry side. And there we are for chemistry, mining and steel, forest and energy. Our services are covering the entire life cycle of an investment, which means that we are doing everything from studies to calculations to the project. We go through the whole project and then we make sure that they get all data after the project, which is completing the projects. And we work mainly with both new projects and maintenance projects and rebuild projects. And as I said, we are working in several areas here, which is, we have already spoken about them, but the main focus is, of course, pulp and paper business and the mining and steel and chemistry. They are the biggest ones. Energy is also climbing up a little bit. So we can take the next picture. We are around 250 employees today. I am very happy to say that we have succeeded very well from the 1st of January until now. We have 16 new employees, more or less. We get some more or less every day now, and which we are very happy with. We had some resizing during the COVID procedure here during 1.5 years, and which have, of course, it's problematic. We need resources for the coming projects here. We are also a very flexible organization with the offices from the north out to the south, which we're coming into more later. So we'll take the next picture. Our vision is to make sure that the industry knows about us and we will be the first choice for the industry depending on quality and environmental and sustainability. That's the major target for us and very important that we work with. We also have a goal to make sure that we proceed with the turnover at 10% every year, which have been very hard the last year, of course, depending on the COVID pandemic here. So that had been very hard, but we see now that we are on the run and getting better and better, and we are having actually very easy to recruit at the moment. It had been very hard for a couple of years, but now it seems to have been a little bit easier. And we get also experienced people, engineers into the company now, which is very sophisticating. We haven't been used to that for a long time. You can take the next picture. Yeah, I talked a little bit about sustainability. We are working very hard with that, of course. We are working with new facilities mainly in the pulp and paper industry, and we hope also to get in there in the iron and steel and mining, which are expecting to build a lot of new facilities during a couple of years now. And we are, of course, working very hard to get in that technology. We are working with a couple of companies which are institutes to make sure that we are on the top level of what's happening in Sweden and in the world of new technology. So that's very important for us. And we are working very close with such companies. We also are working very hard with the social, environmental around our offices and around our communities. And that's also important when you're hiring new people, of course. Yeah, we take the new picture. This is the organization we have. You can see it's a lot of companies, but we are still holding it up very easily. You can see the one who is dark blue here, a little bit lower down, they are companies that we have brought into our company with acquisitions. We expect to have around 40% of our turnover comes from 40% comes from when we are doing hiring in people. And then we have to buy some companies also over the year to achieve the 10% goal to get 10% of the turnover. So that's the biggest thing. But we make this very easy because we are trying to find companies around Sweden which having specialists and which having the structure in the company which suit us good in our business plan. So we take the next picture. Here you can see a little bit of the growth. It had been lousy during 2020, and it was a little bit low 2019. But I think we have almost recovered that area just in the first quarter, which I'm very happy with. And hopefully we can run this very quickly over the year here now. Seems very, very, very offensive today. Yes, go to the next picture then. Here you can see also what I told you about a little bit of the spread about the turnover. The forest industry are very important for us, and we are very deep into looking into new products, new areas, and new technology here. We also see that the chemistry, energy, and the mining and steel industry are working with more or less the same products and such things now, so it's very easy to jump in between the mining industry, forest industry, and the chemistry industry, though we have some specialists also, as I told a little bit about. And that is very interesting for us to keep that area up. And it's very important to be sure about what's happening and the new things coming up in the market, especially in the pulp and paper and mining and steel business now. As you all seen in the papers and in the news, that it's growing very well, especially in the North Sweden. And we are having around 160 engineers up in the North Sweden and around 90 in the south part of Sweden. But all of the company are very set to work with the industry wherever they are in Sweden. And we have this own IT system that works with the projects, and we can bring people in a project from the whole Sweden, and of course also from abroad, to work in the same area and the same project and see what we are doing, which fits us very well when it comes to big projects. Then we can take the next picture. Yeah, here are the customers, and you can see here what I'm talking about. We have those huge companies around the pulp and paper and mining. We are a little bit lower on the chemistry and energy, but we are working on that very hard at the moment. You can also see that we have, for instance, Sea Green down there, which is a new company, new started company, which is coming on the sustainability side, very much to create new things for the rest products of the industry, which is very exciting. And we see a couple of more companies that we are working with there. Yes, we take the next. We are trying very hard to increase our competitiveness through the efficiency and smart technology solutions and the latest thing on the market all the time. Sustainability is very important for us, and we are creating a long-term benefit for the industry in that area. We are hoping for at least, and we are working very hard for that one as well. So we find it very interesting, projects which is coming up here in the near future, especially in the north part of Sweden. Then hopefully it will spread also down to the south part of Sweden. Next picture. Okay, we should look into the first quarter here. You can see the turnover around 69 million Swedish crowns and the EBIT margin up to 7%. It was 5% last year. That is a quite good one, and we don't have any support from the Swedish government now, and we are keeping the results, and the turnover is increasing as we expected. So we find it very interesting coming up to the 2021 and 2022 now. We will take the question around this later. Then we take the next picture. Yeah, you can see here some key figures. We are increasing the turnover, we are increasing the EBIT margin, and everything looks quite good. The only thing I want to make sure that we get now in the end of this year is that we get our targets with 10% on the margin, EBIT margin, which I see is we should be able to do that, is my opinion. Then we can take the next picture. And the next.
I think that was all.
Then we don't have any references.
No.
We can go back to the picture number 10, then I will tell you a little bit about it. Yes, we can see here at SCA, we have been working very much with the new product line in Östrand, and we are now working for SCA up in Obbola, which are huge project, both of them, and we are right in the middle of ending up the Obbola project, and we have been finished the Östrand project, which have been a great success, both for us and also, of course, for SCA. We are working very hard with LKAB, which is a huge mining company. They are working very hard together with SSAB and Vattenfall here in Sweden now, and they have some projects coming up now called Hybrid. And we are also, of course, offering our services for Hybrid at this moment. We have a quite huge office up in Kiruna, which we are around 30 persons in the office, which means that we are the biggest local company up in Kiruna, which we are very proud of. And then you can see a lot of pulp and paper industry here, but you can also see some energy companies and some water treatment companies in here. So that we have experience from both Sweden and outside Sweden. We have been in Sumatra, Indonesia, and doing big projects. We have been in Canada and done a lot of big projects. We have also been able to make sure that we want to have some better competitiveness in Canada. So we had actually, before the pandemic here in Sweden, we have a discussion ongoing in Canada to get better up there and better marketing, but we have to stop that procedure for the pandemic. We will see what's happening after this now, if we can continue it or not. But that's very important also, and I see it's quite a big benefit if you can do that. Yes, unfortunately, the pictures are gone there for the. I had some more prepared, but they are gone, unfortunately. So we might switch over to questions then.
Yes, of course. Thank you, Peter, for the presentation. Just first up, can you tell us a bit what happened actually last year when COVID came and how it's affected the investments in your industries? And I can tell that you're rather optimistic about the recovery now. Just to spin on that thought a little bit more.
Yeah, we can see a lot of projects which we have calculated on and was very close to get just before the pandemic. They was having some problems, depending on that all of us was hurt by the pandemic, of course. We couldn't have meetings and such things, and they will put then the projects on hold. And also we can see that during the pandemic, for instance, pulp and paper industry, especially the ones who have the paper machines for newsprint, I mean, it's just in Sweden we have the paper coming into the house every day. But if you look at Europe, they went out in the street and buying it, but they were not able to do that. So the fine paper business went down very quickly and very rapidly. So we saw a lot of projects having hold up and went very slowly forward. So that was the main issue. Then we have done some, we have employed some new young people into the company, and we couldn't put them on hold either. So we have to put them out of the company for the moment. So that's why we are having some decrease of the staff during the pandemic. But we are on that today, and I think what the things looks like now is that we can recover that very quickly, I hope.
Perfect.
That's why I told you that we have put in at least 15 persons during the first quarter here. Of course, they don't come in directly. If they are experienced, it will take 3 months before they have them in work in our company, but they are on their way in.
Perfect. And I would also like to go into a few projects. You mentioned the hybrid joint venture with LKAB and SSAB and Vattenfall, and that is a really ambitious project to hopefully that will hopefully result in fossil-free steel by 2035. Can you tell us a bit more about the project and how you foresee that, like your part in the project? When do you think that will ramp up and so on?
Yeah, I don't know about how the ramp up will be, because that's LKAB and SSAB and Vattenfall who is running that one. But we are in there and doing some small part of job for them today. And we would like to have maybe one of the projects for a couple of years, because there is so huge projects coming up there. And we are not able to take everything, but we can at least get into 1 or 2 of them and make sure that we have the capacity and we have the specialist for it. I mean, we have one of the best specialists on the vätgas here in Sweden, and they are in the project today, helping out there. And we very much like to look at that. And then we have this office up in Kiruna and Luleå. I mean, we have started a new company and a new office in Luleå during last year, and they were 1 person when this year started, and now they are up to 7 in Luleå. So I see that we are increasing our staff up in the north part here also. But we are having continuously offering over to hybrid today, and hopefully it will end up with some project.
Yeah, and just as a reference, I think the total budget for the hybrid joint venture is somewhere, I've seen figures of 400 billions, and that can be compared to your previous Östrand project that was a total budget of around 8 billion.
Exactly. So, and we have, if you compare that with how many persons you put in a project like that, I will say we had about 35 to 40 persons in for 3 years.
Yeah.
In one such project, so you can see the opportunity coming up there.
Yeah, perfect. And apart from the mining industry and the hybrid project, is there any other areas where you see potential for a ramp up in investments now in the coming years?
Yeah, energy. I mean, if you're talking building out the northern part of the iron and steel and mining, we need a lot of energy. And I think Sweden is also a huge leak of energy today. So we need to ramp up the energy solutions here in Sweden. And then you have the chemistry. I mean, chemistry are going more and more into pulp and paper. And we are taking care of the chemicals in the pulp and paper industry for good reason now. Before we have put them in the wastewater and just put them into cleaning as far as we can do that and then put it out. Now we are taking it in and making sure that it comes to good chemicals that we can use in many other areas. And so the pulp and paper industry is also changing rapidly.
And I suppose...
Yeah, it's very interesting today.
Perfect. And I suppose part of that is also we've seen that RISE has been granted extra funds in order to intensify the sustainable solutions in the bioeconomy in Örnsköldsvik.
Yes.
Can you tell us a bit more about how that can affect you and what is your role in that build-up, so to say?
Yeah, I'm going to go through the history a little bit. We have been part owner of RISE, and we have been part owner of more research. And both of the companies are now sold to RISE. So, which means that we have a very close contact with them, and we have been working with more research and Processum for many years to create new facilities for having startup things and small pilots to do pilot tests on new technologies. And now RISE is starting to build a new center up in Örnsköldsvik, and we are very lucky that we are working with the RISE at the moment to create that area also, which we are very happy about. It's not as a huge industry project, but for us it's very important to be a part of the development here of the different kind of chemistry and different kind of pulp and paper things coming up there. It's a mixture of chemistry, bioeconomy, and everything is coming in there. But I see a huge amount of new technology coming up there in the future, near future.
Perfect. And then to conclude, Peter, what will be the most prioritized during 2021? Will it be getting the EBIT margin back to target, increasing your organic growth, or to find new M&A targets?
I will say they are not, all three of them are on the highest priority, I would say. So we are, my plan in my head, I can see that the things we are talking about in the industry sector now up in the north part of Sweden, it's not a thing coming up for a year or two. It's going to stay for a quite longer time. I can't say how long, but in my area, it's around at least 5-6 years with heavy investments, and which means that we have to have a lot of new persons. We have to look for acquisitions. We have also to look for new competencies, which we will be able to use when we are working with the RISE people today. So I find it very, very interesting, the years coming up here.
Perfect. It will be very interesting to follow your journey here, and I would like to thank you for coming and presenting with us today, and also to all your listeners on the stream here.
Thank you.
welcome to this presentation with Napatech. My name is Eirik Thune Øritsland, and with me today I have CEO Ray Smets. So he will give a 20-minute presentation, and then we will follow up with a Q&A afterwards. So with that, I give the word over to you, Ray.
All right, Eirik. Very nice to be here at the ABG event, and thanks for everyone attending. My name is Ray Smets. I'm the CEO of Napatech. I've been the CEO of Napatech for about 3 years now. And why don't we just jump right in? A little bit about Napatech. It's an 18-year-old company, and we build high-performance FPGA-based SmartNICs. We're going to tell you a little bit more about what a SmartNIC is, but this is an example of one that I'm holding in my hand. It's an important piece of technology that fits within a server. And what it does is it accelerates compute-intensive applications, and we have unparalleled expertise doing that. The secret in here is software, which we'll talk a bit more about in just a second. We are headquartered in Copenhagen, and in fact, all of the engineering is done in Copenhagen from stem to stern. That allows us to maintain a very high quality standard, and we can develop very specific features and functionalities that are unique to Napatech because we're a very close-knit team of employees that have been working for the company for quite some time. So we have a total of about 90 employees headquartered in Denmark. We do have employees around the world. I'll give you a sense of what our revenue stream looks like from different parts of the world. But Copenhagen is a center of excellence for the kind of work that we develop. Obviously, our company started 18 years ago, and other companies have spun off from Napatech. And Copenhagen overall is really a hotbed of technology activity around SmartNIC development. So it's kind of important. We do carry what we call barrier to entry into the marketplace. We have patents, of course, and patents pending, but a real barrier to entry is the ability to create these solutions with the software that runs on it effectively. It's very, very hard, for example, to assemble a brand new group of engineers who have never done this before from local universities and say, go build a SmartNIC. It does take years and years of development to get good at what we do, and therein lies a very important barrier to entry for competition. We have been able to assemble a solid track record in what we believe is a highly leverageable business. You'll see that in the financial results if you do a deeper dive. We'll cover it just very briefly here, but 10 quarters in a row of year-over-year growth, 4 quarters in a row of growth and profit, and we hope that that's a positive sign for our investors. And the good news is we live within a very large and growing marketplace, and I'll give you a sense for that in just a bit too. So that's a bit about the company. Let's talk about what we do. Next slide, please. So Napatech builds, very simply, a SmartNIC. These are the SmartNICs you see in the center of the screen here. And those SmartNICs accelerate server-based applications. As everybody knows, everything is an application now that runs on a server. It's very, very hard, especially in the world of networking or cybersecurity, to build a special purpose hardware box. Those are times of the past. A transition that the industry went through about 12 or 15 years ago is everything became a software application running on a server. And there are some challenges with servers, and I'll get to that in just a bit. But the SmartNIC itself is responsible for accelerating the applications that run on those servers that require a lot of horsepower. So we design these SmartNICs to offload servers and accelerate applications. And it's really the software that runs on the SmartNIC that powers the ability to do that. And we like to remind our investors that truly is a strategic advantage. We derive a pretty high price point for our products, anywhere between $1,500 and $11,000 per unit. We have very strong gross margins of 70% or more. And that should signal that it's not a hardware gross margin, it's a software gross margin that's really driving the gross margins in the top line of our business, which we're very happy about. And that is by design. We build all of our hardware solutions in the US using a US-based contract manufacturer that we have a very close relationship with. I meet with the CEO and her team on a regular basis, and they have a very specialized ability to build using a specific chip that we use on this particular device called an FPGA, which is kind of the super performing microprocessor that helps us do what we do. Overall, this is a great business and a great solution to be building for that business, and we're very excited to tell you more about that. So next slide, please. So just a bit about our companies. customer base, we have over 200 customers buying products from Napatech at any given time. About 70% of our revenue is based in the United States last year, and we expect that to continue to be the case moving forward. We have two kinds of primary customers. One customer is an OEM customer, and these are customers that buy our products and integrate it into their product line or solution and then sell it to the end user. These are technical companies that are building applications that run on servers, as you can imagine, either in the networking, network performance, and cybersecurity domains. And because they deploy their application with a server architecture, they need, at some point in time, they'll need something to make their service, their solution work faster. So all of these companies that you see here, and many more that we're not allowed to show you, basically take our SmartNIC and insert it into their server-based architecture along with their application and provide a higher performing application as a result. Their job in life is to be the leader within their respective marketplace. And what we do is we help them be the leader by providing a higher performing solution that they bring to the marketplace. You can see a few very key brands here. We'll talk a little bit more about them later. IBM, Cisco, Viavi, Pico, Nokia, all of these companies use our product in some way to accelerate applications they bring to their customers. We recently announced a relationship with Lenovo and Silicom as well, which I'll talk a little bit more about later. We consider the revenue we get from the OEMs as kind of our A++ revenue. The reason why we like revenue from the OEMs is because it takes time to win a design win in the OEM space. But once we get it, we typically have a revenue arc that lasts about 3 to 5 years and sometimes longer. Because these companies build us into their product line, they continue to use our product as they drive that product line into the marketplace. So it doesn't provide guaranteed revenue, but it provides a longer relationship of revenue, and it tends to be a very technical, deep relationship. So we do get an opportunity to get design wins with other product lines that they're also bringing to market, and that's a super great place for us to do business. So over 70% of our revenue comes from an OEM in 2020 in particular, and we expect that percentage to remain healthy and strong as we go into 2021 and beyond. The other kind of revenue we get is from an end user customer. These are customers that have projects where they have an application within a data center they have to deploy, and they're making a decision about which application it is and what is the performance vector that application has to perform at. Customers like this were building big data centers. Customers like Facebook or Citadel or Bank of America, Morgan Stanley, some of the pharmaceutical companies like Eli Lilly or Novo Nordisk, they build data centers and then they run applications on the data centers. And there's certain kinds of applications that just don't run well on a standard server. In that case, those companies look for SmartNICs, just like the ones that we provide to the OEM customers to help them accelerate apps. They have a choice. They can either deploy more servers to make the applications that they're deploying run better, or they can deploy less servers with SmartNICs embedded in them to horsepower those servers and use less floor space, less powering and conditioning, less energy, and get the same output of performance or even more output on performance. So these customers usually show up when they have a project to implement. They may implement the project over a couple of quarters and then they'll go away. And then when they have the next project, they'll come back to buy more. So it's a different kind of revenue arc. It tends to last for a shorter period of time. It tends to arrive in our pipeline in a shorter period of time. But it produces about 30% of our global revenue, and we expect it to stay that way going forward as well. Just in the middle of this slide, we're showing you a little bit about our key partners. We go to market through a number of different VAR relationships and channel partner relationships. But the three at the top are very strategic to us. There's the two on the left, Intel and Xilinx, are the two mega players in the FPGA domain. The FPGA is the super fast performing accelerating chip that we use on our product. And we buy those chips from Xilinx and Intel. They own about 90+% of the overall FPGA market, so they are absolute leaders. Obviously, they're huge brands within the marketplace too, and we have a strategic relationship with both of them. That strategic relationship is intended to give us the best-in-class technology, but get us access to the market as well. We've recently announced the addition of Achronix, who is a kind of a challenger FPGA maker to Intel and Xilinx, that has an innovative FPGA design, and we've entered into a partnership with Achronix to look for ways to use their technology and for them to use our software in their product line. The reason why these are important is because if we can make the FPGA do what it does, we're going to build a better product in the marketplace. So these key partnerships are very, very important. It's also very unusual for a company our size to have a relationship with more than one FPGA supplier because you have to move your software to run on those different architectures. But Napatech has designed its solution to do that quite well, and it's a unique advantage for Napatech. Next slide, please. So just to sum up what the problem is, I've mentioned it a couple of times, but I want to make it perfectly clear. Why do we exist? Why is there a market for a SmartNIC? And the chart at the left basically just sums up the situation very clearly. The server has a CPU in it, and every server ships with a CPU. But that CPU is not getting any faster. There's a tale in Silicon Valley around something called Moore's Law, where the CPU doubles in transistors and speed every 2 years at half the price, and that has really driven Silicon Valley to grow dramatically. It's kind of the fundamental tenet of Silicon Valley. But the reality is as CPUs get smaller and smaller and smaller, they're getting less and less performance at a higher cost, unfortunately, out of the CPU. And what's happening with the servers is the server CPU is beginning to level off. The other thing about the server is if it's a fundamental building block to any data center, any sort of deployment, servers can't be expensive. The goal of a server, it has to be cheaper. So you have two challenges here. The server has to be cheaper and the CPU is not getting any faster, but then it's going to be the foundation for running all of these intense CPU and intensive applications. So what do? You have this gap. Well, you fill the gap with a SmartNIC. You plug the SmartNIC into the CPU. Every single CPU has slots that allows you to insert these into the server, and then you put this into service within the server, and you move the application to run on the server, and suddenly you've increased the performance of the server dramatically. Less floor space, less power, less environmental conditioning, and you have a much faster performing data center with less servers. So the SmartNIC comes into the picture kind of at the right point in time when the market is highly dependent on the data center performance. Next slide, please. So I guess I don't have to tell you this. It's very obvious that everything is turning into an application that runs in the cloud or on a data center. Everything from applications, IT applications, security applications, but especially mobility applications as well. In fact, if you look at the mobile world, the 5G network itself is the first network that will be fully virtualized, meaning it is a set of applications that run on servers and lots of them. So we're just at the tip of the wave there, hopefully able to catch a market opportunity around the 5G networks, but there's plenty of other opportunities to accelerate applications as things are running on data centers. So our market follows very closely the health of the server market itself, because now servers are being deployed at massive scale in support of data centers, hyperscale data centers, and network deployments. And every single one of those servers is a physical addressable market because we fit in every one of those servers. Once again, those servers have to be low cost, and the less of them you buy, the better. So once again, the NIC market follows the server market very closely because it provides the horsepower necessary for those servers to perform very high CPU intensive kind of computing responsibilities for applications. So the NIC market is driven by the server expansion, and right now there's no end in sight. That's the way companies and enterprises build networks. So let me give you a sense for what that NIC market looks like. Next slide, please. So I've got just a couple of slides that summarize this. We like to show this to investors and prospective investors just to give you a sense of which market we sit in, and excuse me, and the viability of that market. Is it growing or not? And you can see in 2021, the market overall, the total NIC market, is expected to be about 2.9 billion and growing pretty rapidly to 5.6 billion by 2025. And the NIC market really is comprised of 3 different kinds of NICs, which I'll describe in just a moment. There's in a little more detail, the basic NIC, the offload NIC, and the programmable NIC. But if you look at the total NIC market and who plays in that market, you can see that on the right-hand side of this slide. The top 10 players in that market are massive companies like NVIDIA, like Intel, like Broadcom, who make some type of NIC and bring it to the market. But as you can see, Napatech shows up on the top 10 list. So you can see that there's a tremendous amount of consolidation at the top of the heap. But then the smaller players coming up from the bottom, there's plenty of them in the other category, are working their way up into this market, and they're entering this market either through the offload NIC category or the programmable NIC category. So let me talk about which those categories are. The little blue box you see on the bottom of the stack chart is something called a basic NIC. These are super high volume, super low margin, super inexpensive NICs that perform a very, very basic function, and that's to allow networking between servers. It is highly consolidated around a particular industry player. In this case, it's Intel. In the marketplace, they own 80 or 90% of that market. It is not a market we focus on, and it's highly consolidated, and we're uninterested in that market, but it must exist. The offload market gets a little bit more interesting. The offload market performs a similar function to the smart NIC that we're building, but it performs that function in hardware. So the hardware is actually developed so that it performs a basic set of functions over and over again. It takes a long time to develop hardware to do that, but once you develop it, it becomes less expensive and it performs well over a long period of time. So there's a viable market for the offload market, but it's built in hardware using something called an ASIC. The programmable NIC by default is programmable, and therefore it's software driven. So the difference between the green bar and the orange bar is these are run by software, whereas the hardware NIC or the offload NIC is run by hardware. This is the market that we participate in. That is the one market that we're focused on, and that is where we're deriving all of our potential for growth, is in the programmable NIC market. And I'll show you a little bit more about the programmable NIC market on the next slide. So I go to next slide, please. So as you can see here, what I've shown you on the left-hand side of the slide is just the orange bar from the prior slide. It shows you kind of who are the key players in that market from the top to the bottom, and you immediately can see that Microsoft and Amazon are strangely within the programmable market. And there's a good reason for that. Microsoft, about 5 or 6 years ago, decided that it would compete with Amazon by building its own smart NIC within its data center to accelerate its applications and make their cloud-based infrastructure work more effectively. Excuse me. Just needed to clear my throat there. So Microsoft is actually a maker of a smart NIC. It's actually an FPGA smart NIC, but they only make it for their own use and they don't sell it. Amazon chose to do the same thing. Their purpose in life is to compete against Microsoft Azure by differentiating their services within their cloud. They acquired a company that is also a programmable NIC company, and they build, but they only consume it themselves. So we consider those two guys self-builds. So if you take those two guys out of the marketplace, you can see that Napatech fits kind of at the top of the heap behind Marvell and Broadcom and ahead of others within the programmable NIC market. The pie chart on the right-hand side gives you a sense of what that market looks like with the self-builds removed. So Napatech sits in a very interesting position as a challenger in that market, as one that's growing, looking for a way to expand itself further by leveraging the use of the FPGA-based smart NIC. And our goal is to continue to accelerate within this market. We're going to see market growth as well, but not all NICs perform all functions within that market. We got to focus the function that we develop on the NIC to meet the needs of the growing parts of the marketplace. But Napatech's been able to emerge as a significant named player in the programmable NIC market as well. And you see the market is a fast-growing marketplace. So we hope that that gives you some sense of comfort that we're not trying to steal share from others per se, although we'd love to do that. We're just looking to pick up our fair share of the market by leveraging the kinds of applications that we build and deploy. Next slide, please. Let's talk a little bit about the business. So from a historical perspective, and this is for 2020, we shared this in the Capital Markets Day presentation. We've been growing and been growing quite nicely. We report obviously as a Danish company in Danish kroner. We trade as on the Oslo Stock Exchange in Norwegian kroner, but we are a US-based revenue company. All of our products are priced in USD, and year over year we grew at 16% year over year in revenue in USD. Our margins continued to stay strong at 71.5% as expected. That's a very good sign for us because it's a demonstration that we're not having to discount our way to success as we grow the business. Our customers are giving us a lot of value for the features and functionality that our software provides in our product line. We are very happy to, for the first time in history, deliver not only an improved balance sheet, but strong earnings in the year as well. And that's a very important line that we crossed, profit and cash flow, and we continue to accelerate that in 2021. So next slide, please. So just underscoring some of the financial data that we shared in our most recent IMS, 10 quarters in a row of year-over-year growth, 4 quarters in a row of profit and growth, both of which are very important to us, and we continue to see the expectation to do so some more. In Q1, we grew at 6% year over year against a very tough compare, Q1 of last year. Gross margins remained very strong, and our EBITDA, and our earnings were significantly up year over year, even over last year. So we bring a business to the market that is doing well. It's growing, it's profitable, it's cash flow positive, and we believe that the prospects are positive for more of that as we get into the future. Next slide, please. So just to wrap things up a little bit, we are going to continue to announce key relationships that we build in the marketplace that we think are important to our customers. We just recently announced Lenovo and Silicom as new important players for a new product line that we're bringing to market around virtual networking. We just announced a relationship with Achronix, which is a new FPGA supplier that is a challenger to the Intels and the Xilinx of the world. We're doing very well in the fintech world, and we're growing in terms of the number of design wins. And I mentioned that earlier in the presentation. The more design wins you have, the better your long-term revenue prospects can become. So those are all very positive. Next slide, please. We're going to focus on a three-pronged strategy for growth. On the right-hand side, it's very clearly articulated. We're going to continue to expand our core product value, which is what we've been doing to grow our business over the last 5 or 6 years. But we're going to introduce new products that accelerate the growth in 2 areas. One is called inline, which is the ability to process packet flows in a more kind of inline fashion for higher speed, higher performance, and things for example, in the firewall market. And then we're also approaching the new market around virtual switching, which we believe will be a very significant new marketplace as 5G networks get fully evolved. So that's our three-pronged strategy. Next slide, please. So just to summarize our outlook, and we'll go to the slide right after that. One more slide, please. You can advance one more slide. Yeah, that one. We feel pretty good about our 2021 aspirations. We put annual guidance out, but just to give you a sense for what our growth vectors are looking like, we're very comfortable getting to a 20% growth rate. We're on track to fulfill those aspirations to get to the 20% growth rate by the end of 2021 over the aspirational period. We see 30% growth rate in 2022 and beyond. And as part of that, if you run the numbers, you can see $100 million in revenue within the 2024-2025 timeframe. So we have momentum, and we see no reason to believe that momentum will shift in the wrong direction. The question is how well we can execute. We also expect margins to remain high at around 70%. That's a very good sign that we can grow the business and maintain our gross margins, and we've proven that over the last couple of years. Our operating costs, we're going to continue to keep low. It gives us plenty of opportunity to invest for growth. You can see that in the business. If you look at the business in history, we've been very good about cost structure and keeping the cost structure in place. But we're also building a software-only line of business that will also help us from a margin perspective, selling the software that we build on our SmartNIC that can run on others. So with that very last slide, just wanted to put the concepts on the table. We're a stable and growing company. We have cash flow, earnings, and revenue in an exciting market, building great new products and winning customer brands. And we hope this is a good investment prospect for our investors. So Eric, I'll turn it back to you.
Thank you for Thank you for a very good presentation, Ray. We have time for a few questions, so we can start by looking into what are your thoughts around the OEM investments levels now in 2021, since you have seen some headwinds due to COVID-19, to my understanding. So if you can comment quickly on how does the visibility look like now, and have you talked to your OEM customers, and what are they saying? Thank you.
Yeah, the OEMs are going to continue to be strong for us in 2021, without a doubt. We do have a difficult compare in the first half of the year. Last year, COVID had a strange effect on our seasonality in 2020. We tended to perform a little bit more in the first half than expected, and we performed a little bit more normally in the second half of the year. And we would not expect anything major to change within our business related to our OEMs and overall business. We tend to do more business in the first half of the year with OEMs than with end user customers in the first half of the year. Most of our end user activity is in the second half of the year. But we see we have good visibility as always. We have pipeline visibility to our OEMs that go out about 6 months. We're not like a chip company. We don't get orders 1 or 2 years in advance. Our OEMs do place orders with us about 3 to 6 months in advance maximum. Right now, we're getting a sense that the OEMs are performing just as we would expect them to perform. A couple of variations. Not all OEMs are exactly the same. Some are a little better, some are a little worse, but overall, we anticipate that in our business plan. And so we feel pretty good about the development there. What's really exciting for us is what's happening in the second half. The second half is going to be dominated by continued OEM activity, which we normally would see, but also we're beginning to see some of the opportunities on the end user side. We don't have really strong visibility into the second half for end users when we're doing the business planning, because we just can't see out into that pipeline that far, but we have a pretty good expectation of what kinds of activities could occur, and we're beginning to see those develop. So I think 2021 is another good year for us.
Mm. And you also might see some developments in the Lenovo and Intel Xilinx partnerships. So have you seen anything there, and when can we expect to get some news flow around those partnerships?
Yeah, we'll keep the investors well aware with news flow as things develop. But there's a lot of activity with both of those guys and others. The way these design wins work, especially with companies like Lenovo and certainly with Silicom, is there's a fair amount of work that has to be done up front to bring the customer to market, and then there's a fair amount of work that they have to do to actually win their first customer wins. We work very closely with them throughout that entire process. Obviously, Lenovo is in market. They are talking to certain customers, and the way things work in China is you tend to sell in the first half of the year, and you tend to reap the benefits of that in the second half of the year. And they have a very, very annualized buying cycle. So we're hopeful that we'll see some opportunities like that emerge in the second half of the year. We still have a ways to go. Like with any new line of business, it takes about 18 months to create revenue, but we'll see what we can do, and maybe we'll get lucky and get some revenue in 2021. Same with Silicom. Silicom is still a software a port over to their hardware solution that's based on the Intel hardware, and that work is underway as well. And we're optimistic, and we'll see what we can do to help them get revenue in 2021. So fingers crossed. We obviously would like to see it happen sooner than later.
Sounds very good. So I guess the next question would be then, since you have quite strong growth aspirations, so what would be the main risk for you to not reach that target for 2024, 2025 of $100 million?
Yeah, I mean, there's always risks in the marketplace. For example, the predominant risk in the market today is supply chain risk, not having sufficient component supply to build the products. That could be a challenge for us. But I think the risks are that we don't reach the market at the right time, and somehow, some way, we miss the window of opportunity to capture a piece of that significant market growth around 5G. But we think we're hitting the sweet spot in terms of timing. It's all about access to the market and then execution to close the business. We are competing with some pretty significant players out there, but we bring a very interesting prospect to the table. So there's a sales and marketing, and there's a channel to market challenge for us. We continue to try to mitigate those by building our partnerships to a broader base of partners. And we think that that's going to serve us very well in the future.
Thank you, Ray. I see that we are out of time, but thank you for a very good presentation and good answers to my questions.
Thank you very much. I appreciate it. Thanks to everybody.
Hello and welcome back to ABG Sundal Collier Introduce Investor Days. My name is Victor Kruger and I'm an equity analyst covering real estate and construction companies here. The following three presentations will be real estate related companies, and the format is roughly 20 minutes presentations and 5-minute Q&A. Next we have 24 Storage, operating in the young but growing segment of self-storage. And with no further ado, I'll leave the word over to the CEO, Fredrik Sandelin.
Thank you, Victor. 24 Storage, we are the only self-storage company listed on the Swedish Stock Exchange. We were founded in 2015 and has in a short period of time reached a position as the second largest operator in the Swedish market. Next slide, please. We call ourselves a prop tech company. We use automation, digitization to a larger extent than most of the other companies in the industry. We also call ourselves a growth company. We have had an annual revenue growth rate of more than 30% since we were started in 2015. And foremost, we are a real estate company. But what differs us from most other real estate companies is that we are both the owner and the operator of the properties. Next slide, please. This is the short summary. We are operating 25 stores in Sweden, the three major regions, Stockholm, Gothenburg, and Malmö. We have around 11,500 storage units, 63,000 square meter lettable space, and around 7,000 customers. Next slide, please. What is the main driver behind self-storage? You might ask yourself. And the main driver globally, it's not just for us or for Sweden, it's globally, it's urbanization. As more and more people move into cities, land prices increase. That leads to that prices for houses and apartments, buildings increase. and that leads to that we build smaller houses and apartments, and more important for us, we build smaller and less storage units. At the same time, we have more things to store now than before, and to solve that equation with smaller living area, smaller storage area, and more things to store, the solution to that is to separate between living and the storage area, and that's where we come in. Next slide, please. These two graphs show the development in the US stock market for real estate, and the upper graph you can see that this is for the last 25 years, and the reason why we've chosen US is that that's where most of the listed self-storage companies are present. And the upper graph shows that the return for the different segments within real estate, here you see that self-storage has had the best performance. The lower graph is maybe even more important in the current situation, that is showing that self-storage is a resilient asset class within real estate, and during the downturns for the last 25 years, you can see that self-storage has been more resilient than the other asset classes. And we will come back in a few minutes to see if that has been the case also in the current COVID-19 pandemic and the downturn in the economy. Next slide, please. Self-storage, as we know it today, started in the US in the 70s, came to Europe, UK first in the 80s, and to Sweden in the 90s. In the US today, they have more than 55,000 storage stores or facilities. In Sweden, we have a little bit more than 200. And of course, you might say that that's not so strange because the population in the US is so much larger than the one in Sweden. But if we take that into consideration and do the calculation per capita basis, you see that the lettable square meter per capita is almost 20 times as high in the US compared to Sweden. And if we take number of stores, they have almost 10 times the number that we have. So they have many more stores per capita, and these stores are larger. Still, if we take some statistics from the UK, of the present adult population in UK, less than 2% have tried self-storage. But if we look at the existing customers, more than 40% of them have been a customer before. So have you once tried self-storage, you very often come back. And of course, the longer a market has had self-storage, the more returning customers you have. So of course, the US have many more returning customers than we have in Sweden, for example. Now we don't say that we will reach the same numbers as they have in the US because there are differences in demography, the way we build houses, etc. But we think that we will move in that direction. And if we compare with more similar countries like the UK or Netherlands, where the self-storage industry came earlier to these markets, the penetration is higher, and we don't see any reason why we will not reach the same level as they have. Next slide, please. This slide is important to understand the business structure and the business model for self-storage. And this is not particular for us, and it's not particular for Sweden. This is a more general description. If you take an office building, for example, you normally have an occupancy rate of at least 80% when you open that building, because you can sign contracts with customers before the building is ready, and then they move in. It's very different for us. Very few customers book a storage unit in advance. You book it when you have the need. So that means that when we open a new store, we normally have an occupancy rate very close to zero. And then that occupancy level increases over time. You can see on the simulation on the NOI margin that day one, we have a low occupancy level, but we already have the full cost base. So the result initially is negative and the cash flow is negative, and then it increases over time. We normally say that it takes at least 6 years for a new store to reach maturity, and during the first 4 years you are in the lease-up period where the ambition is to go to an occupancy level in the region of plus 80%, and then you have 2 years of revenue optimization, and after 6 years you will have a store with an occupancy level exceeding 90% and with the rate that you have calculated. And after these 6 years you have a store with a good cash flow, a good result. You see that the NOI margin is in the region of 60 to 70%, and of course then you can say that's easy to say, but if we look at some good example in the industry with mature portfolios, listed companies, or the data is public, we can see Shurgard listed in Brussels. They are running at an NOI margin of 64%. Big Yellow, the biggest listed company in the UK, even have an EBITDA store margin of close to 70%. And the reason why we reach these margins is that top line revenue is resilient, and that in combination with low operating cost and maintenance capex lead to a good profitability and good NOI margin. And during these 6 years also the main increase in value of the property takes place. Next slide please. This shows, I said that we are present in the 3 major regions, Stockholm region, Gothenburg and Malmö, and here you can see where the different stores we have. Right now we have 3 new stores under construction, 2 in the Gothenburg area and 1 in Västerås, northwest of Stockholm. Next slide please. Even if the phenomena of self-storage is fairly new, it is a traditional industry. The normal way to run a self-storage store is that you have local manning, and normally you have 1 to 3 persons sitting at that store. At the same time, you have rather few walk-in customers, so it can be inefficient to have a person sitting at the store all the time. So when we were founded in 2015, we said that we will do it differently. Instead of having local manning, we have central manning. So we can monitor, we can control the stores at a distance. So remotely our customer service center can do the tasks that would normally be done by the personnel on site. We have a lot of cameras. We can look at the building. We can, when a new customer is arriving, we can open gates. We can open doors. There are intercom devices. We have self-service kiosk, and the potential customer can, through a video link, get real-time access to a sales agent in the customer service center, have a discussion, sign the contract, and do more or less all the services that could take place if we had local manning. The advantage there for us is that the cost level is less, because we can run our central customer service center with fewer employees, much fewer employees than we would be able to if we had 1 to 3 persons sitting on each and every store. So that is one side of it. The other side is that we have an online sales part that is higher than most other of our competitors. The normal way is that you can reserve a store on the web, but then you still have to go down and do a lot of the paperwork locally. Last year we had 40% of all the contracts we signed were signed by customers on the web. So they did the whole customer journey there without contacting the customer service center. So as a customer, you can sit wherever you want, whenever you want, go in on our website, find a suitable store, see if there are any sizes available. If you want to go forward, you can identify yourself with a bank ID, sign the contract, pay with credit card, we will send a code to your email address, and with that code you can go down to the store and move into your unit. And of course this is a more scalable model because the increase in cost for online sales is less than if we do it manually. Next slide, please. Here you can see that we have around about 7,000 customers. Of these customers, 15% are corporate customers, and private individuals are the remaining 85%. And we have a clear ambition to increase the share of the corporate customers. And as I said, if you look at the pie chart to the right, last year we had 40% on sales via the web in comparison to 31% the year before, and the run rate now is over 40%. Next slide, please. If we look a little bit on the environmental impact, we build rather uncomplicated buildings. So during the building process, we consume less resources and energy than most other real estates. We also, with as we can monitor and steer the temperature, humidity, etc., we can also have a lower consumption over time. If we look upon it from a society or social point of view, it's also that we can occupy plots where most other real estate cannot. We don't have a problem, for example, being close to a major road. On the contrary, we like visible locations because we want to increase the awareness and knowledge about self-storage in general, and of course to increase the brand recognition for our brand. So a very good combination is where we can be a noise barrier between a major road and new residential area, because then we have the advantage that you can build houses closer to the road. We become the barrier. We don't have a problem with closeness to the road, so we get out our brand, and at the same time we have a good new customer base with the newly built buildings with smaller storage units than in the past. Next slide, please. The short summary, if we move into our first quarter result, the short summary is that we continued our revenue increase. Revenues increased by 18% in the first quarter compared to the same quarter last year. At the same time, gross profit increased by 24%, and if we take like for like, it increased with 42%. This shows the scalability that we have in our business model, that we can add new stores to the portfolio without increasing the cost at the same pace. So the margin is constantly increasing. You can see that we have all-time high gross margin of 32% in the first quarter. We added net almost 9,300 square meters between Q1 this year and the same period last year, and the occupancy rate increased slightly to 69%. Next slide, please. Here you can see the development since we started. It's almost linear. Property value, lettable area, and revenue from 2015 up until 2020. Next slide, please. And if we break that down on a quarterly basis, you see that we increase revenue quarter after quarter, and the reason for the increase is a combination of that we have a higher, for our existing properties, we have higher occupancy level, we have higher rent, and we also add new capacity. Next slide, please. If we look at the occupancy level and the rent, you can see that we are on the occupancy side moving sideways. We are slightly below 70%, increasing a little bit in the last year. And the reason for that we are on that level is that we're constantly adding new capacity. And as I mentioned before, when we add new capacity, the occupancy level is close to zero. So of course that dilutes the total number. for each and every single property, the occupancy is normally increasing year after year. If we look at the bottom graph, we can see that even with the added new capacity, we increase our rent level year after year, and we are now at a little bit more than 2,000. That should be seen in the context of that the country average is 2,350, and there's no reason at all in the long term that we would not be at the same level or higher, because we have most of our properties in the regions where the rent level is highest. So when we have a mature portfolio, we will have a rent level and an occupancy level that is higher than the existing one. Next slide, please. I said earlier that this is seen to be a resilient segment of real estate, and we can also see that the effect from COVID-19 has been very limited. If we go 1 year back in time, we were of course wondering if this downturn in economy would be similar to the previous ones when it comes to the effect for us, and we can now say that it has been that we don't see much of an impact at all. And one reason for the self-storage industry to be resilient is that we have a very granular and diversified client base. I mean, we have 7,000 customers. So there's a lot of customers, and each of them pay a very limited amount. There is a stickiness in the business model that have you once moved in, there is a threshold to move out again. And we have a strong occupancy level throughout the whole economic cycle. Another interesting thing is that we think that there will be some changes in behavior after COVID-19, and for example, most people believe that we will work more from home than we did in the past, and that will lead to that people will in a way substitute their living area for work area at home, and that might lead to a demand for a storage unit. We see an increase in online sales, and that leads that smaller online sales companies can use us for warehousing and warehousing closer to their end customers than otherwise would be the case. Next slide, please. If we look at the gross profit and the gross margin quarter after quarter, you can see that the overall trend is the same as for, or even a bit higher than for revenue, but there are more variations here, and that's because there are, especially on the cost side, seasonality effects that leads to that we don't have this quarter after quarter increase, but the general trend is the same. Next slide, please. Here we have plotted all our stores. I said that normally there's this lease-up period for 4 years and then the revenue optimization period. And here you can see the clear trend that the longer a store has been in operation, the higher the rent level and higher the occupancy level. And we normally say, the whole industry says that the occupancy rate for a mature facility is just over 90%. You can see here now that now we are running 4. We have 25 stores, as I said. We have 4 of them running at an occupancy level of more than 90%, and we have 7 with an occupancy level of more than 80%. And the country average for Sweden is 85. So when we have a mature portfolio, most likely we will have a higher rate than that. Next slide, please. I think it's time to round off, and the second last slide here before Victor is entering in is that we have a strong balance sheet. We have an equity to asset ratio of 33%, net loan to value of around 60%. Next slide. And the last slide will be the growth and the growth plan. We have, as I said earlier, a little bit more than 60,000 square meters of lettable area today. We are building right now, 2 buildings in the Gothenburg area and one in Västerås, as I said, and that will add 12,500 square meter, opening within less than a year. And in addition to that, we have 3 contracted properties that we will start a bit later, and they will add an additional 10,000 square meter. With that, over to you, Victor.
Thank you, Fredrik. My first question was regarding the development portfolio. Since you aim to add 10,000 approximately square meters per year, and you have 12,500 under development now, and building rights of approximately the same size, do you feel comfortable with this size of a development portfolio, or should we expect it to have a different size in, say, 2 years from now?
I mean, our target is to add 3 to 5 new stores every year, or that is equivalent to around 10,000 square meter lettable area, and that is the ambition. So you can say that for the coming 2 years, we have already met that target. So what we're building now is I mean, we are further building the pipelines, which we constantly do. But we are, I think we have a good pipeline, we have good projects, and so we are in a very good position.
And do you want to say anything on acquisitions, adding to those developments? Will that be, how large do you think that would be in relation to the development additions?
Well, it's difficult to say because, I mean, if we make an acquisition, it will most likely be a number of stores at the same time. So then it would be a stepwise increase. It's still a rather fragmented industry, especially in Sweden, but also in the rest of Europe. So there are a few larger operators, and then there is a long tail of small operators. Of course, there is room for consolidation, no doubt about that.
And when you do build, do you need a certain degree of pre-lease tenants, or before you start developing, or can you start to build on speculation?
I mean, as I said, when we open, we normally have an occupancy rate of close to 0%. So we don't rely on we don't need to have signed contracts before we start building. I mean, we do a very thorough analysis of the existing competition, the type of area, I mean, the population, the economic factors, all these demographic. So we have a number of KPIs. I mean, how many stores per capita, etc., and what kind of income level, number of houses versus apartments, etc., etc. There are a number of these variables, and then out from that we see if we think that it's a good market or not.
Great. Just a final one here. The total rental level of 2,350 that you mentioned was the country average in Sweden. Could you give us a hint of when you think 24 Storage will reach that level?
No, I mean, we don't guide in this type of questions, and I think what you could do, of course, is to look at the development this far and then extrapolate that, and then you would. But you can also say that over time, I mean, if we grow with 10,000 square meter per year, the relative share that is new will be smaller all the time. So you can say that in the past we have seen a big dilution on both occupancy and rate because we've added so many new properties. Of course, their relative share will be less in the future, and that would lead to that the rate of increase would be higher.
Great, Fredrik, thank you. We'll have to speak more next time. Next presentation is coming up, but thanks for participating.
Thank you very much. Thanks for listening.
Hello again and welcome back. Next we will have the real estate company Eastnine presenting. And with no further ado, I leave it over to the CEO and CFO.
Thank you very much. My name is Kęstutis Sasnauskas, and with me,
Britt-Marie Nyman.
And today we have a pleasure to present you Eastnine and our case. So if we move to next page. On today's presentation, we'll just give you a brief. We'll tell you about the market, why we consider Baltics being so exciting investment opportunity, and we will talk more about details of our company. So if we move to next page. What is Eastnine in brief? Eastnine is actually the Swedish-listed company, a real estate company focusing on offices in prime locations in the Baltic capitals. So even if we are listed in Stockholm, actually our entire business is focused on the Baltics. But actually within our tenant base, it is very much Nordic as well. So we have a combination, a very nice combination of very much underlying Nordic European exposure with very attractive Baltic assets. And they also have certain features that we consider being very, very attractive. Our total property value today is 374 million. It's slightly higher now because we made the recent acquisitions that were announced. Those are the figures from the first quarter. Our total assets are around 500 million euros. Our rental income is around 21. LTV 36% on the total portfolio and 46% on direct assets. In total, we manage today 120,000 square meters of prime office space, both in Vilnius and Riga. And here comes one of the most exciting parts is actually that our property portfolio is valued at 3,100 euros per square meter. So just about 30,000 SEK per square meter. And those are the most prime locations, and those are very prime assets. Market cap 2.8 billion SEK, and we have a very high surplus ratio of 90%. And we will tell more about it further in the presentation. Let's move to the next page. So why we feel that Baltics are so exciting? And it's actually a combination of a number of factors. If we just look on the map, you can see that the 3 Baltic capitals are actually among the top 10 largest cities in the Nordics. If we look on the region as itself, with 6 million people, it's actually bigger than Finland, it's bigger than Norway, and it's bigger than Denmark. So we have a quite significant portion of the Nordic population actually living in this area. But today we're still having yield levels 200 to 300 basis points above Nordic levels, and we are talking about prime. And we also are in a significantly lower rental rate level. So this combination of higher yields, low rental levels, still creates very low property prices today. And of course, this is combined with the Nordic financing gives you one of the highest spreads between the financing cost and actually the direct yield that we receive. If we move to next page, in general, the Baltic market has been developing very, very positively and very rapidly. So since the independence back in the early 90s, the Baltic markets have actually started gradually to grow towards the Nordics, and this convergence process that has been going on is actually ongoing, and today is becoming faster and faster. If we look 15 years back, the Baltics have been growing approximately 3 times the speed of the Nordics. If we look 5 years back, the same, and if we even look today, this speed is continuous. If you look on the office segment as such, Baltics have also emerged from very low levels to now becoming a more attractive investable universe. but still relatively undeveloped market. And if we look at office space offering today in the market in the Nordics, which is closer to 5 square meters per inhabitant, we are at around level of 0.7 to 1.2. So still structurally, we are still very, very much behind the Nordic levels, which also creates a quite positive environment for the future office development overall. If we move to the next page. So shortly about the last quarter and what has been happening in our company. We had a relatively stable quarter. We continue growing due to larger portfolio. We have some vacancies in Riga, some increase, but there's not so much related to COVID. They are more related to our plans of development of certain properties. Our other investment, BTS Group, keeps delivering and growing very, very rapidly, and we're very happy for that. And we also announced 2 recent acquisitions, one in Riga and one in Vilnius. Let's move to the next page. And here are our next one, our acquisitions. So we did 2 acquisitions after the closure of the quarter, one in Vilnius and one in Riga. The one in Vilnius complements very much our cluster in an area called Vertas, next to other 2 properties. And Zala 1 is very nearby to our other property called Valdemar. If we move to the next page, we can see them actually in a bit better way. So all of our properties today, you see here on the pictures, they are all very modern. They are all environmentally certified, almost all, one with the exception of one in this picture. It's called Vertas 2, but it's in the process. And all of them are also among the top highest brackets of each of the systems, either LEED Platinum or BREEAM Excellent. So those are very, very modern, very nice properties. They're all situated in this greenish, bluish area with the bigger numbers 1, 2, and 3. And these are the 3 clusters. And each cluster is, the 1 and 2 is around 40,000 square meters, and number 3 is a bit smaller but more central, is around 24,000 square meters. And actually, we strategically try to cluster all those properties closer to each other to be able to actually work with our tenants in more efficient manner. If we move to Riga, next page. Here you can see our properties. Riga has a bit of a different spread in the market, so offices are more widely spread. There is no very clear CBD formed yet in Riga, but we believe that that area will be around where we are, around the central street called Kristiana Valdemara, where all of our properties are actually situated today. And with the most central being number 1, Valdemara Center is the most central location for offices in Riga. And you can see Zala being just behind it, just a couple of 100 meters behind. Number 3 called Alojas Biroji. It's a former headquarters of Nordea in Riga, and now Nordea has merged its operation with DNB Nor. It's called Luminor. So this is now a multi-tenant property right now. We have 2 exciting projects in Riga. One is called The Pine, which is the first wooden construction, wooden office building construction to be started hopefully this year already, and a Kino project, which we are now in the architectural competition and working on the design. If we move to the next page. Here is shortly about our 2 other holdings. We still have historic holdings of Melon Fashion Group, which is a Russian fashion retailer, and it's performing exceptionally well. Eastnine holds 36% in it, and during the first quarter, Melon continued growing. As you all know, it performed very strongly during last year, despite the pandemic and all the turbulences that the market has incurred. But even this year, Melon continues growing 35%. Online sales stand for 32% and continue growing faster than the traditional network. And company is actually posting very nice profits, and the company also declared a dividend, which we expect actually any day now of around 3 million euros. If we look on the other holdings, we still have a story holding in East Capital's property fund number 2, and that holding has been performing quite well. It is in the divestment phase, and we also hope to get proceeds of it shortly and reinvest them into our other portfolio. If we move to the next page. So for my last but not the least, it's actually sustainability work that we do. Since we started, sustainability work is actually at our central part of our DNA, and we've been working very, very actively by promoting, but also introducing all the measures in all of our properties towards more sustainable future. We also are ranked among top 20% among our peers in real estate globally for our sustainability work by GRESB. Our financing framework is ranked by Cicero at Dark Green and Excellent. 87% of our portfolio is actually either LEED Platinum or BREEAM Excellent certified. It's actually only two properties that are not certified at the moment, but are in the process. And if we look on the 2 acquisitions, they are both actually LEED Platinum properties as well. So that figure will only increase. We're also among the top ranked companies in terms of gender equality among Swedish listed companies by Allbright's Foundation. And we also implemented green leases in Vilnius already. And 95% also enjoy 95% trust index amongst our employees at a great place to work. So we have a very strong, very motivated team to continue developing this company further. And now I'll leave to Britt-Marie.
Thank you, Kestutis. And we continue with the income statements. Most figures, including the rental income, increased during the quarter due to a larger property portfolio. In a comparable portfolio, the rental income decreased by 7% though. As we said, we have higher vacancies in Riga, partly due to vacating of a building and partly due to taking longer time to relet during the pandemic. Central administration costs increased mainly due to non-recurring costs, and we had only minor positive unrealized value changes during the quarter, both for properties and other investments. We didn't receive any dividend from investments during the first quarter, but we will, as we have mentioned before, receive dividend from MFG within a day or 2 now. We continue with the key figures. For the first quarter, the occupancy rate was high, slightly lower than at year-end though. The surplus ratio is still on a high level, 90%, which is a really high figure compared to real estate companies operating on the Swedish market, when 70% is quite normal. This is due to a high degree of triple net leases in the Baltics, and the Baltics triple net leases are much better than the Swedish ones. The average rent level is 15 euro per square meter and month, and that is about the same level as at year-end, and it's around 2,000 SEK per year. The LTV is low, doesn't depend on whether you compare all assets or the properties, 36% and 46%, and hasn't changed since year-end. The return on equity is positive. It was negative during the first quarter last year due to negative unrealized value changes, and earnings per share is also positive again. Profit from property management is on the same level as during the first quarter last year. Equity per share and long-term equity per share has increased by 2 to 4%, depending on comparing in euro or in SEK. We can continue with the current earning capacity. And this is a truly important page if you are looking into a growing company. This doesn't show, this isn't a prognosis. It shows the capacity to earn money for the coming 12 months based on current agreements and certain assumptions. And we compare the end of March with the end of December last year. And since we didn't take possession of any new properties during this quarter, the figures haven't changed that much. But we can see that the rental value has decreased slightly, and this is since we vacated this building in Riga. And we have the vacancies in Riga has increased, and the vacancy value has also increased thereby. The rental income is slightly lower, and so is the net operating income. Central administration on the same level as the interest expenses, and profit from property management slightly lower. The prospective yield level has fallen due to the higher property value and also due to lower net operating income. We can continue with the share and the shareholder list. We have on this page the 15 largest shareholders in the company, and we have had small changes during the first quarter. Patrik Brummer has bought some shares, and ICA Ananas-Förbund has increased their shareholding. The market cap was 2.8 billion, and this is based on the share price by the end of March at around 126 SEK. We have slightly less than 5,000 shareholders, of which 3/4 are Swedish, and we are traded with a discount. We can continue with next page, profit and value increase. And on the first chart, you can see the profit from property management per share. And as you can see, in 2017, we had a negative figure, but we have gone through a transformation process, and this has also increased the profit from property management. But the increase is also due to increased efficiency since we have increased the volume. We continue with the dividend per share in the middle chart, and you can see that it has increased from slightly more than 0.2 in 2017 to around 0.3 euro per share in last year. And we have a dividend policy saying that the dividend should be at least 50% of profit from property management after current tax. And for 2020, it was 66%, divided on 4 occasions. And the last chart on this page is the long-term equity per share, and it has increased from around 11 euro per share in 2017 to nearly 15 in 2020. Over to you, Kestutis.
Okay, thank you very much. So just to summarize why we feel that Eastnine is a so exciting story. Actually, through all these years, we assembled a unique portfolio of prime properties in prime locations in the Baltic capitals. Those properties are inhabited by prime tenants, very much Nordic institutions, financial institutions, telecom, IT companies, very much international businesses. And of course, those properties generate a stable and very strong cash flow. We also work very, very hard on sustainability, and we are actually leading that way in the Baltics, and we see more and more people follow us. And we hope that you can join our journey as well. And in terms of journey, we see in front of us a very exciting future. The Baltics actually is growing. We have an ambitious plan to double our portfolio, but also we have this gradual convergence that is going on, and I believe that it will only accelerate in the future, since we still have a very, very big nominal gap between the countries, between the regions, and this underlying growth is actually set to a very exciting journey, especially owning real assets like properties. So on this, we finish our presentation and we are open for questions. Victor, over to you.
Yes, thank you.
Thank you.
I will start with your earnings capacity. And for Q1, you had your net operating income. If you look at it for the full year 2021, assuming that that would be growth of 5.7% in net operating income and 8.5% in income from property management. If we then fast forward to 2022, looking back at this year, do you think it will deviate a lot from these numbers?
Yes.
Yes, we have a plan to increase the company and buy more properties. Yeah, because it will.
And besides from just the great acquisitions that you just announced, is there anything else?
There's much more to come.
And in terms of development versus acquisitions, is it like a 50-50 divide looking forward, or is that hard to?
We haven't set a target because usually if you look on our target to do it within 3 years, so most actually of that growth will come from acquisition still. And we have a very clear pipeline. We see very clearly how we can achieve those targets. When it comes to development, of course, those will add on significantly if you look especially in Riga, but those will probably come at the end of the period or later, even later than that period. So over the time, we will build up that portfolio, but it will not happen as fast. So developments will take longer time.
And for renegotiated rents for the quarter, it was flat in Q1. Could you say anything on what you think for Q2, 3, and 4 this year?
The market has been stable, but we can also see that there hasn't been that many renegotiations during the first quarter. And since the market is opening slowly from, I guess, now on and forward, the situation could improve, I would say.
So in general, I mean, we see a relatively stable situation in Vilnius. Our occupancy in Vilnius is at 97%, so it's still very, very high. And it's really hard will be hard to stay with that figure. Of course, vacancies in Riga are a bit higher, but those are a little bit self-inflicted in a way that we did some planning issues for the development of some properties, and now it takes a little bit longer to lease out, of course. But in general, maybe somewhat weaker development in Riga in general, but still we feel that the situation will improve once people are actually able to physically come and visit the property.
And in terms of Riga and the development portfolio, do you need a certain degree of pre-letting ratio before you sign contracts or before you start constructing the building?
Yeah, we generally prefer have a significant portion let out before we start constructing. Of course, we're looking into Riga right now, and we are in the process of letting the properties out. So we are in the process, but we didn't set a concrete figure, but somewhere around 50% at least.
Yeah. And on what kind of yield on cost could you say on average for development?
Construction costs are growing actually these days, so it's difficult to say. But we were planning it around 7% yield to cost on this property at least.
And the short-term yield outlook seems relatively stable. For more long-term, or if we say like this, what needs to happen for the yield to come down markedly in 2 years from now?
I think in general what we've seen is that if we look on the Baltics today, Vilnius is the biggest market today in terms of offices and has been also probably the most liquid over the past years. And the size, liquidity, and the number of tenants actually makes it much more you see high yield compression, so it's much more competitive, and of course you see the yield compression there.
Yeah.
And if you look to Warsaw, for instance, Warsaw has added quite a lot of capacity. It's a bigger city, and we've seen yields compressing both with a growing portfolio of properties. As well, we've seen also the positive rent development there. So it's not, we need basically higher volumes for higher liquidity, and then probably that will be reflected in the yields. So the growth of the market is actually very, very important. And as you could see on the graphs, I mean, it has been growing quite fast. And there is more add-on. Windows continues growing actually in terms of offices still nicely.
Time's up for today, unfortunately, but always nice to have you two on, and thanks for today.
Thank you very much. Thank you.
Hello, it's time for Fastpartner, the third and last real estate company to present today. I leave the word over to the Deputy CEO, Christopher Johansson. Christopher, the word is yours.
Thank you. Very much welcome to this presentation of Fastpartner. I'm Vice President at Fastpartner. If you would like to dig deeper into what you hear in the presentation today, please visit our website, fastpartner.se, where you can download our quarterly and annual reports. The beautiful photograph you see here is from the cover of our annual report and was taken from the roof of one of our properties in Solna. This building is part of a concentrated cluster of more than 100,000 square meters that we own in Solna. Next slide, please. For a long time, Fastpartner has worked to deliver the best risk-adjusted cash flow of any property management company listed on the exchange. Now we've taken the next step in this work. Moody's has rated us investment grade. In conjunction with that, we have issued an unsecured green bond for 1.25 billion for 4 years with a net interest margin of 112 basis points. Today, we have an average interest rate of 1.8% on our loan portfolio, which is worth 14.6 billion. So each basis point reduction of our average interest rate equals 1.5 million in profit from property management. And if we were to refinance our entire portfolio on the terms of the green bond, annual property management profit would increase by more than 100 million. So that's a big deal, and it will radically improve our financials in the future. But it doesn't stop there. The investment grade rating also radically lowers our refinancing risk. Next slide, please. Fastpartner has been publicly traded for more than 25 years and is on Nasdaq's large cap list. We own 208 properties with an aggregated area of about 1.5 million square meters. The value of these properties is about 31 billion, and the aggregate rental value is about 2 billion per year. Our property portfolio is mainly concentrated in Stockholm, but we have a significant presence in Sweden's 4 biggest cities and also Gävle and Norrköping. Having our property portfolio concentrated in major cities gives us multiple advantages. It makes property management efficient, and we do our business where the economy is growing, which also allows us to increase rents. This provides risk diversification while creating superb opportunities for finding growth through prime acquisitions. Next slide, please. As I said, we have a mixed-use portfolio with all kinds of properties. This graph shows how our rental value is divided among different categories. Right now, the fastest growing category is residential, where we recently completed about 200 flats in Märsta. Another steadily growing segment is our share of public service properties, schools and care facilities. This proportion will expand as we refurbish vacant premises and build new properties for this type of use. Our project pipeline also contains, in addition to residential and public services properties, a significant number of development rights for light industry and logistics focused on last mile. Next slide, please. To safeguard our cash flow, it's important to look after our tenants in the best way possible. We have our own property management personnel who interact with tenants daily and can identify their wishes and needs. This means we are close to our customers, and that's important because 50% of new rentals are generated through our existing tenants. Next slide, please. Clear, committed, connected are our watchwords. Being a tenant with Fastpartner should be straightforward and effortless. The tenant should feel assured that with us they are getting a best-in-class product in terms of economic efficiency and also sustainability in every aspect. Next slide, please. Our customers appreciate the work we do, which we see in customer satisfaction surveys, where we continually improving our position year after year. That is one result of employees who are satisfied with their jobs and who find the work they do stimulating. Last year, we were certified by Great Place to Work, one of the biggest and most widely recognized employee surveys. In this context, let me take the opportunity to also mention that we are a major sponsor of Fryshuset, a non-profit organization for youth. They do fantastic work with young people, especially during school holidays. Next slide, please. Now that I briefly presented our operations, I would like to update you on our current performance. We achieved our previously established target of 950 million in rolling profit from property management by a comfortable margin, and actually ended the year with management profits of 952 million. Looking forward, we are now currently delivering 990 million in rolling profit from property management. Last year, we achieved an impressive surplus ratio of 71.3%. All in all, last year was yet another good year for Fastpartner, and dividend was raised to an even 2 per Class A ordinary share. Last quarter, the average interest rate was 1.8%, and our interest coverage ratio increased and is now 4.2. Our loan to value decreased to 43.7%, and net asset value increased to 92.9 for each Class A ordinary share. Before moving on to tell you about our new targets for 2025, I'm going to briefly look back on the past year. What a year. First, everything was running smoothly. The economy was growing. Then a short article about the new coronavirus in China. Shouldn't be that awful, just a new variant of a cold virus. But then, total shutdown about a year ago. At Fastpartner, we called the management team to a digital meeting and made sure we could look after our employees and tenants. Then we tried to get a clear picture of our revenues and tight rein on costs. Last year turned out well for us, and the increase in the surplus ratio is partly thanks to better cost control. For me, it feels very reassuring that we have such a firm grip on costs. Next slide, please. Here are our business targets for 2025, which the board adopted on 7th of September 2020. The most important target by far is that we will continue to grow our profit from property management by about 10% each year. And by the close of 2025, we will have reached a rolling profit from property management of 1.5 billion annually. We say that we're going to be climate neutral in our operations by 2030, but I think it can happen even earlier. We have actually already reached several of these targets, for example, achieving an investment grade rating and markedly reducing our CO2 emissions. So to recap the targets for 2025, they are all based on sustainability and long-term stable growth. Next slide, please. If you use a simple model to extrapolate the impact of reaching the 2025 targets, you'll see Fastpartner owning properties worth of about 40 to 45 billion. For that, we're expecting to reinvest about 2/3 of the profit from property management each year. We're expecting rental income to increase as indexed in agreements, but we're not counting on any major changes in valuation yields. We have included the effect of an investment grade rating. Looking at our past performance, you'll see convincing evidence that we will be able to meet these targets. In 5 years, the annual growth of rental income has been about 10%, property values 15%, long-term net asset value 21%, and share price 12%. Looking at the 10-year period, the figures are even more impressive. Next slide, please. Of course, growth will not be continuous the way the model indicates, but will advance in stops and starts. This graph shows our history of acquisitions and investments, as well as how these two together have boosted our profit from property management. We have an opportunistic acquisition and investment strategy by which we evaluate acquisition opportunities when they emerge. If we do not find the long-term return we're looking for in an acquisition, we turn to our portfolio development rights. Next slide, please. One effect of continuously investing in and developing our properties is that we lift the level of rents, as this graph shows. This is a process of refinement aimed at achieving prime properties with better offerings, as well as better property portfolio concentrated in Sweden's fastest growing regions. The latter goal in particular is something not reflected in the external property valuations we do twice a year. In my word, it's a good argument for a share price that should include a premium on the net asset value of 92.9. Next slide, please. As I said at the start, we are very skilled at generating strong cash flow. That is clear from this graph. Here you can see how Fastpartner steadily and evenly delivers higher cash flow than the MCI property index on average. And why is that important? Next slide, please. We recently won a prize for being a mixed-use portfolio in the MCI property index that had the highest average total yield for 3 years straight. If you look at the total yield on properties shown in this graph, of the total number of properties in the MCI index, that yield derives partly from changes in valuations and investments, and partly from current cash flow. What is obvious here is that the first component varies greatly over time, while cash flow remains reasonably stable year to year. If a company outperforms in terms of cash flow year after year, like we do, it leads to a compounding effect, making the company a winner over time. Next slide, please. So currently we are putting in a lot of work to develop our office offering. We think that we will see a high demand for top quality office premises this autumn. The ideal offering will be a multi-tenant property where tenants can expand or reduce their hiring. They should be conveniently accessible by public transport and by car, include all sorts of services, restaurants, gyms, shared conference facilities, spontaneous meeting, etc. So COVID will make everyone think hard about whether they have the right office. As I said, this is our current focus, and work is underway on several sites, including Kista, Hemsta Works, Gävle, Liljeholmen, and especially in central Frösunda, Solna, which this next video will show. So can you please put on the video? Thank you. Sustainability work is central to us in everything we do. Each year, we reduce our CO2 emissions significantly, and most recently, we reduced them by about 40% for an equivalent space. By 2030, we aim to be completely carbon neutral in our property management. We are increasing the number of environmentally certified properties, and today more than 30% of our properties by value are certified. In addition, we also finance these properties with green financing. The current share with green financing is just short of 30%. Sustainability has more dimensions than just carbon dioxide emissions, though emissions are very important. Something we are very proud of in our property management operations is how we get involved in communities and make efforts to support small businesses where we own properties. For many of these small businesses, we are honored to provide them with increasingly larger premises. Each year, we offer traineeships, and many are located in our urban centers. We also have many employees who live where we own properties. Reusing vacant premises and repurposing them are two of the most climate smart things we can do, considering about 60% of a property's emissions during a life cycle of 50 years comes from the construction phase. Next slide, please. Here we have a quick look at the company's sustainability targets. Next slide, please. Fast Office, that is our co-working hub offering. And here we see a very strong demand at the moment. In Fast Office, we are trying out new ideas in property management and testing innovations in our offering to customers, such as having access to geographically expanded rental space. Fast Office is also a gateway for new graduates to our property management services. Next slide, please. Nowadays, the business world is brimming with great efficiency through digitalization. So it is with the property sector too. We see digitalization as a key to achieving a surplus ratio of 75%, but it's also playing a central role in achieving our environmental goals and targets for customer satisfaction. At Fastpartner, we have a completely digitalized customer journey. So it starts with the marketing, measuring results, targeting advertising. Then we have digital signed lease agreements, electronic invoices, digital signage, and digital keys, notice boards, and it continues over into the property management where we can boost quality, increase our availability to customers. So it's great, much efficient. Next slide. We have a large portfolio of development rights, including both residential and commercial. The portfolio is totaling 300,000 square meters. This allows us to find growth in other ways than by means of acquisitions. Next slide, please. The two biggest development rights projects that we are working intensely on right now are in Västberga and Bromma. In Västberga, we are developing almost 40,000 square meters of commercial space. In Bromma, we are working with a detailed development plan that will consist of a mix of residential and commercial space totaling about 70,000 square meters. We hope this detailed development plan will be ready in 2023. Next slide, please. In Gävle, we are working on an interesting project in Gavlehov that will allow us to build 35,000 square meters of mixed-use properties. Okay, next slide, please. So many thanks to everyone who has listened. And in summary, I'll say that when you invest in Fastpartner, you invest in a winning team with employees who are deeply committed, knowledgeable, and proud of what they do. If you want to keep up to date on the work we are doing, I recommend you to follow us on LinkedIn. Thank you.
Great, Christopher, thank you for your presentation. I'll run a few questions here from my side. Well, let's just quick on the development. You mentioned it in the end here, but You have now, total investments in development properties at 1 billion SEK, and that's roughly similar to what was in Q4 and Q3, but much more than just in Q4 2018, and before that it was just half and less. So should we expect your development portfolio to shrink, remain or grow from these levels?
So when we purchase properties, we always look out for the potential of finding building rights. So, but they are also key to our coming expansion of business. So we will, as we see fit, make use of these development rights.
And just in terms of yields, what kind of yields on average do you expect for your development portfolio, both the resis and commercials?
Yeah, of course, I can't give you a particular number, but of course the yields on the development projects we engage in are much higher than the ones you find when you do acquisitions, of course.
And could you indicate, if we're talking around 6% for the commercial portfolio on average, or is it way off?
I could say at least more than 50% higher than acquisitions, the yield on developments. And for us, many times these development rights, as I said, we have them for free, so we haven't purchased them. We find them in our existing portfolio of properties.
And the latest two acquisitions and the acquisitions this year were in Gävle. Could you explain a bit on your rationale for developing or for expanding in Gävle?
So we have 6 core cities that we are looking into when we do acquisitions. In each of these cities, we know the local market and many of the tenants. And these are, of course, Stockholm, Gothenburg, Malmö, Uppsala, and then Norrköping and Gävle. So for us, it's very natural to acquire properties in any of these 6 cities.
And could you say anything on the yield level in Gävle?
Of course, it's more attractive than in Stockholm.
Has the pandemic changed your view on any segments or geographies, both that you're actively owning now and that you could consider to expand into?
We are very confident that if you have a good offering in offices, you will be very competitive in the coming autumn here, and you will even be able to increase your market share, we think. But then the COVID it has made logistic properties extremely expensive. That's one thing for sure.
Christopher, time has run out, but great to have you on, and thank you for presenting today.
Yeah, thank you for having me. Thanks. Bye.
Welcome back to the ABG Investor Days. My name is Johan Brown, a retail analyst here at ABG. I now have the pleasure to welcome Morten Hellberg, the CEO of OrganoClick, to present. Please go ahead, Morten.
Thank you, Johan. My name is Morten Hellberg. I'm the CEO and co-founder of OrganoClick. Today I will go through a little bit about our business in general, but in particular about the development during the first quarter, and also with a focus on the directed share issue that we made last week, generating 70 million SEK in capital for us, and what we will do with this moving ahead. But first, 15 years ago, 15 years ago, I met two Swedish researchers, two scientists that were working at the Royal Institute of Technology and Stockholm University, and had since the mid-90s done research in natural chemistries. And why were they doing this? Well, they had realized that this would become a problem. Today, 8 million tons of plastic waste is released into the oceans annually, and hundreds of thousands of toxic chemicals. And what they were really looking at was how can we use natural chemistries in order to solve this problem. You can change the slide. They were doing research in a field called biomimicry. That is, you're looking at, in their case, how natural chemistries are building up structures in plants, in trees, and so on, and the chemistry behind the tree becoming so strong, or why leaves become water repellent, or why does some trees burn less good than other trees. From this fundamental research, you can change slide, Johan, they really had an ambition and a mission to replace plastics and toxic chemicals with bio-based solutions. And this is still a red line in our mission and OrganoClick's work, and has been so for the last 15 years. Please change. When I met them, they had developed a technology which we call modification of cellulosic fibers. That is, we can, by clicking on organic molecules to the cellulose fibers that are the main component in wood, in paper, textiles, non-woven materials, by clicking on organic molecules, we can change the properties of these materials to make them water repellent, stronger, fire retardant, depending on what type of organic molecule we are clicking on. So it was a very broad core technology that we started from. You can please change the slide. Today, 15 years later, we have developed a range of different products, all originating from this core technology. The first product area that we launched in 2012 was our wood protection technology, where we are replacing heavy metals and toxic biocides that are currently in use in pressure impregnation with natural minerals that we are attaching to the cellulosic fibers and creating a physical barrier in the wood instead of creating a toxic wood. And another area that we are working with is the textile impregnation, where the state of art until now have been to use a chemical group called Prevas or fluorocarbons, which have been shown to be hormone disruptive and cancerogenic, and are now on the EU phasing out list. And here we have developed a biodegradable solution where we are using completely biodegradable and non-toxic molecules that we are attaching to the fibers. And last but not the least, we have developed technologies which can replace plastic binders in non-woven textiles and in paper-based materials, where we are using biopolymers derived from food waste. So we're using food waste from orange peels, shrimp shells, oat husk, wheat bran, where we are purifying different polymers in the shells and from these plants, and are replacing these plastic polymers that creates the strength in these materials. Please change the slide, Johan. Last year we had revenues of 96.5 million SEK, a growth of 12% from the previous year. Saying that, we were actually affected quite hard by the COVID in the first quarter, where we had zero net growth. In the second quarter, we were starting to grow again, but the last two quarters we were growing with around 30%. So we really had a strong growth in the end of the year. Now in the first quarter, we continued with a very good growth of 33% in our segments which have been on the market for quite some time. We were also improving EBITDA again, and now in May we made a directed share issue of 70 million. Can please change slide. Today we're working within 4 different areas. We have the functional wood area, where we are targeting the building sector, working through building supply chains and targeting mainly the professional building sector, like architects, big building companies, and so on. We have our green coatings and maintenance business, where we have a broad product range of maintenance and wood protection products for the building industry, which is, you can say, like an aftermarket to the wood market. But we also have our textile impregnation products for consumers that is sold through retailers like outdoor and sport retailers. In the biocomposite and the non-woven and technical textile area, we are replacing the plastic binders that I mentioned previously with our bio-based binders to create different alternatives to plastic materials. And the strength with our technology is that we can use all our different functional technologies like water repellents, mechanical strength, fire protection, and rot protection in all our different business areas. So from the same technology, we get out a lot of products that are targeting several areas. Please change slide. If we go into the biggest segment so far, the functional wood segments, there, as I mentioned, we are replacing heavy metals and biocides with our natural silicon minerals and also some other minerals that we have been working on for the last 5 years, which I'll come to. We are targeting a large market. More than 700,000 cubic meters of pressure impregnated wood is produced in Sweden only. We last year produced about 10,000 tons, 10,000 cubic meters. So you can imagine that there are quite a lot of market that we have not even reached, even though this is our biggest segment. Please change slide. Looking at the Q1, we had a good growth of almost 40% in these segments, mainly coming from that we launched OrganoWood in the German market during 2020, and now the first year when our distributors have been able to work a little bit more on the market. Last year was really affected by the COVID for them, but this year we really see very strong growth on the German market. But also good growth on the Swedish market, which we are, of course, very happy on, that we are growing on existing customers. One thing that we are really looking forward to, though, is that we are now in a phase of launching our second generation OrganoWood technology. The first generation was launched in 2012, and we have now developed an improved technology, which is both an improvement in terms of the economics when we're producing the wood, but also an improvement in terms of the functionality. We have better properties in everything that we can measure, both the durability, the rot protection, as well as it will reduce the maintenance need for the wood as well. So it becomes much easier for the consumers and for the end customers to use. And here we have invested in a completely an extremely modern drying kiln together with our partner-based timber, which is producing the wood, and which was installed earlier this year. It was installed during the autumn, but we have now also taken it into production. So we are now just a few weeks away, I think, from launching the products finally. Can you please change the slide, Johan? As I mentioned, our main market here is the professional building market. This is an industrial hotel in Skellefteå that was built last year. The whole facade is made of OrganoWood, and also decking on the roof is made of OrganoWood. Otherwise, we are also very strong in the market towards the public sector, schools, preschools, this type of areas where you want to use non-toxic building materials. This is areas which we are also targeting in Germany, where we have a collaboration now with a distributor called Götz, which is one of the leading distributors in Germany, and they have 11 warehouses all over Germany, and all of these warehouses are now keeping OrganoWood in stock, and their sales force are really working to get into not only the professional building sector, but also the DIY sector in Germany. Can you please change slide, Johan? In our second largest segments today, the green coatings and maintenance business, we have a number of maintenance and wood protection products, as I mentioned. We have OrganoWood under that brand. We are selling a wood protection system to consumers so they can apply it themselves on their decking. The OrganoTex textile impregnation is used for impregnation of clothes, garments, and now also shoes. And the BioClean, there we have a range of maintenance products for cleaning your decking material, cleaning your roof, or cleaning your facade. Please change slide. Also in these segments, we had a good growth in the first quarter. We were growing with 25%. However, in March, we had an extremely strong sales. So we actually hit our production limit. So we had really problems to get out everything that we needed. So in April, we took the decision to go up to a third shift. We have previously been running production here, or the filling of the cans and bottles, in 2 shifts, but now we are running it in 3 shifts, and we are also running on weekends now in order to be able to supply for the demand that we saw. So from March and onwards, we've had really strong sales within this segment. In April, we also launched a new product line for the OrganoTex segment, OrganoTex Shoe Care. Until now, we've been selling products for impregnation of garments and clothes, but actually the shoe care market is much bigger than the textile impregnation market for clothes and jackets. So this is something that we have had a lot of requests from our resellers. We sell to, for example, Naturkompaniet, Alevalls, Team Sporty, and this type of actors. And we have, during the last 2 years, developed our technology so it can also be used on shoes. Just when we launched this product line, we also received 2 new resellers, Stadium and Högs. Stadium is one of the largest sports resellers in Sweden, and Högs is the largest reseller of horse products in Scandinavia. And in particular, in the horse product segments, they use a lot of shoe care products for their boots and so on. So we're really looking forward to work with Högs in the coming years. And in total, this added more than 100 stores and web shops for the OrganoTex brand in April, and we started to supply them in May. Also in April, we had the first supply of OrganoWood wood protection to Canada and the USA, where we have 2 distributors that are now starting to work on the American building and paint market. So we are growing in several aspects in this segment. So what we've had to made a decision to do early this year was to invest in a completely new, fully automated production line for filling cans and bottles, which increased our capacity with a factor of 3, without having to add any more people working with this, because this is completely automated from the start when you get the bottles onto the line, and it also packs the bottles on the pallets in the end. So everything is done by robots. So the operator have to do is to pick up the pallet afterwards and get it to the warehouse. So this will really reduce the fixed cost for us for producing the products, at the same time as we're adding 3 times more production capacity. So this is one of the aspects that we are now using, also the proceeds from the directed share issue, to really automate our different production lines, which will not only create high capacity, but also will create lower production cost for us. You can change slide, Johan. Yeah, this is the new shoe care line. So it's composed by a shoe impregnation for all type of shoes, both leather shoes and also textile shoes. And then we have the leather wax, which is made for leather, of course, but and in particular for the horse boots, which is a very big market for leather wax. And these products are bio-based and biodegradable, so this is pretty unique in the market. So we're really looking forward to see that come out. And as I mentioned, this is actually a bigger market than the textile impregnation market. Can we change slide, Johan? Moving on to the industrial segments that we are working on, the non-woven and technical textiles first. Here we are supplying bio-based and biodegradable binders. And as I mentioned, we're using food waste to produce these binders, which are replacing plastic binders in non-woven materials used in products such as hygiene products like baby diapers, medical products like face masks, hair covers, surgical gowns, agricultural textiles. It can be in napkins and tabletop products. So there are a lot of segments where you're using non-woven textiles, which is something in between a textile and a paper-based material. And here, the European Union Plastic Directive that was put in place in March 2019 is affecting some of these segments, in particular with the wet wipe segment, where you need to, or let's say all producers of wet wipes are now looking to phase out the plastic binders in order to get to, so they don't need to label their products as bad for the environment. And this niche segment, the non-woven binder, is worth about 3 to 4 billion SEK per year, but it's only about 20 large corporations that is the main customers for us. So it's a quite nice market for a company like us to target. We know all these 20 companies today, and we're working with many of them. You can change the slide, Johan. This is a very early segment, an early product area for us. We have been on the market now for a few years with some niche products. So the sales have not really picked up yet. But in February, we signed our first major agreement with a leading non-woven manufacturer worth 30 million per year. It's a 5-year contract, and it will be we expect it to be fully implemented in the beginning of 2022, when they will replace all their plastic binders with our bio-based binders for their main products. We have also, since earlier, we have 2 industrial non-woven customers, of which one of them is one of the 10 largest in the world, and they have launched one niche product, but they are now really going into volume products as well. So we believe they can be adding a lot of revenue until 2022. Today we have more than 30 customer projects in various phases, lab, pilot, and production phase, and 10 projects are currently in production tests. And I would say of these 10 projects, 3 is in the maturity, so we can probably. We believe that some of them can become a new major contract during 2021. I mean, if we are lucky, there can be more of them that can turn into contract. But we believe that we can at least have one major contract more in 2021. Please change slide, Johan. In our biocomposite area, where we are also replacing plastic polymers with our bio-based polymers, we work within 2 different niche segments today. We have, for example, the leading burial coffin producer in Scandinavia as one of our customers, Fred Alredens, why they are working with us is because they want to replace the plastic polymers or the plastic glue that you have in particle board with our biocomposite, because there is about 10 to 20% plastic polymers in particle board, which is 80% of the coffins in Scandinavia are made of particle board. So they have launched an eco coffin with our material technology. Then the second one is Briox, which is a leading supplier of acoustic panels. And they are also using today synthetic materials for their acoustic panels, but now with our technology, they have developed a completely bio-based and biodegradable acoustic panel. Can you please change slide, Johan? This is also an early segment, but we are starting to grow. This is a little bit more tricky in terms of production compared with our other segments, though. So we have seen a really high demand, in particular of the acoustic panels, but also the coffin segment is growing. But during the quarter, we have been limited due to some production technical problems in production. But we are now increasing production with more production shifts, because right now it's a matter of how much we can produce. This is the the main problem for us. So we have added extra shifts now in April, which we will be able to then, of course, supply more. But here we're also looking to automate more parts of the production, which is one of the aspects where we will use the proceeds from the directed share issue to really get more automated production of the biocomposite area. Please change slide 1. This is what it can look like when you're using the Briox acoustic panels. This is an office space where they put the acoustic panels on this wall, and large companies are now buying these acoustic panels, and so we have a really good order book here. Now it's a matter for us to produce and supply. Please change slide 1. Just looking a little bit historically on our financial development, we have been growing every year since we launched our first product in 2012. Actually, every quarter except one, we have been having a positive sales growth. And now we have seen really good sales growth during the last 3 quarters with more than 30%. So this is, of course, our ambition to continue to grow in high speed. Change slide 1. One thing that we are focusing a lot on is the gross margin. Gross margin from variable cost, because this is really what can give us good profitability in the end. And in 2016, we were mainly selling products in the functional wood area. But after that, we have been launching products in the green coatings and maintenance area, and now also in biocomposites and non-woven segments. And they have considerably higher gross margins compared with the wood area. And our long-term target is that we will reach a gross margin of around 50%. And we have now been growing the gross margin, as you can see, with about 1 to 2% per year during the last 5 years. So we believe we can continue on this journey by changing the product mix to more value-added products. Please change slide. In terms of the operational costs, we had during the year 2017 until 2019, they were quite steady. In 2020, we decided to increase focus on sales, and we employed more people within sales, and this increased our operational costs. Now, however, the level which we have reached now, we believe we can keep that for quite some time, and growing sales also, and growing production and supply. So now we see that we don't need to add a lot of more fixed cost in order to grow sales moving forward. Please change slide 1. Yeah, and this is also, of course, very important in order to improve our profitability. In 2020, we had a little dip in the curve of EBITDA improvement. We had, of course, a different target. We wanted to probably reach break even in 2020. However, the first quarter where we had a quite bad growth due to the COVID situation made that we didn't grow enough for the increased operational cost that we had added. Hopefully, we can now continue the movement towards more profitable operations, and looking okay now after the first quarter where we improved the EBITDA again. Please change slide 1. If you're looking into 2021, we have a strong focus on penetration in Germany and Italy for OrganoWood, and of course the launch, as I mentioned, of a second generation OrganoWood technology. For OrganoTex, we are really focusing on the Nordics, but also Germany and UK, where we have a good distributor that is now working towards the outdoor and sports goods retailers. In Germany, we are aiming to find a good distributor during the year. The OrganoWood wood protection launch in US and Canada is, of course, a major part of our focus this year. This is a huge market. We now have good distribution partners. So this is something where we're really looking forward to see how the sales develop during the next couple of years. Our non-woven biobinder customer development project is, of course, very important for us. And here, this is the area where we really believe we can take big jumps in revenue growth during the coming years. And not the least, we are now really working on building up more production capacity with a high focus on automation. And part of the capital that we raised will be to improve our processes in our current production facility. As I mentioned, we are working with an automated production line for filling cans and bottles, but we are also investing in a completely new production line for non-woven binders. We are a non-woven production line that has a capacity of 10,000 tons per year, which will double our production capacity in the current facility. And this line will also be completely automated, so it will require extremely little labor for producing our binders, which will reduce our fixed cost for production for the volume that we can produce. However, one part of the capital that we have raised will be now we're starting to look at building a new production facility, a second production facility, because the volumes in the non-woven binder segment is so big. So if we shall be able to be a real player within this segment, we need to set up a new production facility. We believe this will be also in Sweden, not in the Stockholm area though, more in an area where you have more industrial history and maybe also lower cost. But this is a project that we have started, and we hope that we can get out with more information regarding that during this year. So thank you very much for listening.
Thank you very much, Morten. So we have time for one question, and I want to talk a little bit more about the non-woven segment. And you mentioned the target about at least one new sort of commercial announcement about a new deal this year, with 3 being closer than the other 10 plus. Is it possible to talk a bit about the volumes, maybe on all the production tests in total, but also maybe if it's possible to get a ballpark number about these 3 that are a bit closer, so to say?
Well, yeah, as I've been saying before, most of these projects are targeting products which could generate for us in between 10 to 40 or 50 million SEK per customer project. So the average would be somewhere around 20-30 million SEK per project. Yeah, the ones that we are looking at right now are in that range. So that is about the range where we see most of the volume products in the non-woven segments. So that is also, of course, if you look at these 10 plus projects, that would be several 100 million crowns of project value. Yeah.
Thank you very much. Unfortunately, we are out of time, but I want to thank you, Morten, for presenting today, and everybody for listening in. Thank you very much.
Thank you.